What's up, guys? Welcome to the first session, first section, first phase of the Forex Masterclass 2.0. Without further ado, let's get right into this and not waste any of our time. So let's start with the very beginning. What is Forex? Forex stands for, as you can see here, foreign exchange, right? So basically, what we're doing or what foreign exchange means is if we're taking like the US dollar here, and we're exchanging it for the Japanese yen, or vice versa. We're exchanging the Japanese yen for the US dollar. You can take this with any currency, right? The euro to the pound to the euro, it doesn't matter. It's basically just the process of changing one currency into another. It's called foreign exchange. You also might hear it called Forex. You're going to hear it called FX. You're going to hear it called the exchange rate. Anything like that, we're going to refer to mainly just Forex, but this is what that is. Now, Forex does have, or the foreign exchange rather, it does have some real world uses: commerce, trade, tourism. These are three things. We'll dive a little deeper into these, but like we say here, international currencies need to be exchanged to conduct foreign trade and business. So what does that mean? Let's talk about commerce. Let's say that you're in the US. This is you got your cute little ears, you're sitting on a laptop, and you're in the US and you're trying to buy something. In order to buy something with US dollars in, say, the United Kingdom, this little mouse toy, you need to purchase this in Great British pounds. So there needs to be an exchange rate, right? There needs to be my US dollar is worth how much in Great British pounds, and there needs to be an exchange that happens there, right? Because their United Kingdom's main currency is not the US dollar, right? Trade. Countries specialize in certain assets, and they trade with countries that specialize in others. So a few examples of this, this is what global trade is, right? So Canada's number one and two export is oil and natural gas. So we're looking at oil and natural gas, and then Australia, gold and iron ore, and then we have China, labor. We have cheap labor from China. We have big gold mines in Australia. So these are just a few examples of trade that happens. In order to have these trades happen, there needs to be an exchange rate for the currencies, right? Because we need to purchase labor or buy labor in China, purchase gold, purchase oil, all of this stuff in whatever country it is that you're actually purchasing from. Now, tourism. When you think about tourism, maybe you guys have seen this before, like at an airport, it says currency exchange right here. This little chart right here, which usually is next to them, you can't really see it anywhere here, but they probably have it on some screen somewhere. This chart right here is telling you what the current exchange rate is, right? You look here, it says we buy Japanese yen for this much, we sell it for this much. It's called China's yuan. You buy it for this much, you sell it for this much. So I just want to mute that. So sorry if that just pops up in your screen real quick. I had some noise in the background. Let me turn that off. So muted that. Now, yeah, once again, we have the currency rate and the exchange rates right here. This is tourism, right? You might go here if you're in the US, you're going to Italy, you need to go get some euros, right? You're going to exchange your currency for another. This literally is Forex trading, right? It's just not how we're going to do it, but give you another example right here. So let's say you went to that exchange rate, right? You had $1,000 in US dollars, $1,000 cash. You're going to go get some euro because you're going to Europe. They give you 1,200. I'm sorry, this is the Great British pound. I think that's great. Let me double check that. I think I just screwed up that. That's the euro. My bad. So Great British pound. Let's go back to this. You have 1,000 US dollars, and you're going to be getting 1,200 pounds, right? 1,200 Great British pounds because you're going to United Kingdom. Now, what happens is, let's say you're at the United Kingdom, you don't spend any of that money, and you have that $1,200, and you go back to the currency exchange. Now you're going to get a different amount, right? There's a very slim chance the dollar you get back will be $1,000. The reason behind this is because the currency fluctuates every single day. Now it's these changes in what's called the exchange rate. This is where we make our money. Basically, what traders are doing is, if I think the dollar is going to lose value against the pound, I'm going to do something which is called sell. Actually, I would be buying the pound and selling the dollar. I'll show you exactly how we do this, the analysis we do. But in essence, there's going to be a shift in the dollar's value or a shift in the pound's value. We analyze that, and we can buy or sell the difference in those two costs, the two changes. And we use something called leverage or trading on margin, which makes us make an obscene amount of profits with very, very little change in the prices of the currencies. So we're going to explain all of that, but basically this is all it is. You're going to get a different amount when you bring your euro back or your Great British pound back for the US dollar. This is what the currency pairs look like. You're going to see pairs like this a lot. You're going to see USD CAD. This is the US dollar versus the Canadian dollar, right? Now, when the first currency in every single pair is called the base currency. The second is called the quote currency. So just to show you guys a few more examples, if we come here, we have UCAD, once again, Euro USD, GBP JPY, NZD, AUD, right? So this is the Great British Pound against the US dollar, New Zealand dollar against the Japanese yen. So we're going to be able to analyze, and I'm going to show you exactly how we analyze every single one of these currency pairs in order to trade them profitably. So I know this can look overwhelming, but just take this piece by piece because it's really not that bad. So currencies are traded against. Sometimes I speak ahead of myself. We're gonna have to get used to that. I speak ahead of the slide sometimes. This is just to keep me on track. Currencies are traded against each other as exchange rate pairs, which I just explained. Now, when we're talking about volume, what does the Forex markets have for volume compared to something like the New York Stock Exchange, which, if you didn't know, the New York Stock Exchange is the biggest stock exchange in the world. The daily trading volume for Forex is roughly around $6 trillion per day. Does that mean you're going to make 6 trillion in a day? No, but there is so much volume. There's so many more moves that happen that you get opportunity for, which is one of the reasons why it's so, I don't want to use the word lucrative, but you're already in this course, so you already know this is what you want to learn, right? But when we're looking at stock exchange, you get 2.2 billion per day versus 6 trillion. The reason is it's global, right? Look at all these countries you have. This isn't even all of them, right? We have like 8 that we mainly focus on, which once again, I'm going to go over, but you're only looking at the stock exchange where you have like 800 like smaller companies, some bigger companies in here, and it's mainly like very geography based versus the world and currencies. And you're talking about governments trading with other governments and impacting the actual currency rates, not just like a share price or something on Apple or a share price on Netflix or anything like that, right? As far as market participants go, the people who actually trade, the people who are in this, you have banks, you have hedge funds right here, private equity firms, stuff like that. And then you have you, me, retail traders. We are retail traders, right? So as a day trader, regardless of what your strategy is, if you're following the banks, technically, if you're going through this entire course where you get into fundamentals and stuff, well, you're following what the banks do, right? You're following the banks and hedge funds. We're following legitimate fundamental analysis, right? But you're still a retail trader. You're trading at home. You don't own a hedge fund, most likely. So we are retail traders. Once again, this is like semantics. It doesn't matter what you title yourself as. We're a trader. So that is what it is. Now, next up, we're going to talk about sessions and we're going to talk about times. Let's get right into it. All right, sessions and times. Let's get right into it. Once again, not wasting any time on this. So sessions and times when it comes to Forex, the biggest thing to know is that foreign exchange is worldwide, right? So because of that, Forex trading is actually open 24 hours a day, 5 days a week, closes on the weekends. It opens on Sunday, 5 p.m. Eastern time. It starts with the typically Asian session, which we're going to go over, and then it closes Friday, 5 p.m. Eastern time. Not all times are created equal. And I'm going to explain what I mean by that when it's like, yes, okay, we're open 24 hours a day, 5 days a week. Does that mean I want to actually be trading for 24 hours a day, 5 days a week? No. You want to be able to identify the best opportunities. And we're going to show you obviously exactly how to do that. There are 3 major market sessions. Asian/Sydney. This is typically more likely than not, you're going to hear it referred to as Asian. That's what I always call it. It's what most people call it. London European session, once again, typically called London, and then you have New York US session, mainly called a New York session. So for the remainder of, if I'm just ranting or I'm not, like if I'm talking fast, you hear me speak about any of the sessions, I'm going to call it Asian session. I'll call it London session. I will call it New York session. So I don't call it Sydney European or US, but we will cover some of the countries that are actually opening during those sessions. The first one being Asian Sydney session. Now you have China that starts to open up. You have Japan, you have Australia, New Zealand, Russia. You don't necessarily need to memorize all of these. It's not that big of a deal. And it is kind of like a staggered, like you have one that opens, another one that opens, another one that opens. Asian session is typically the least volume session. So when we're trading this, we usually need to have an opportunity a reason for it, meaning like economic data, some headlines or news needs to come out. There needs to be a reason to be trading any of these times. The time, this is an Eastern time, so maybe you have to do some math here, but 6 p.m. to 4 a.m. Eastern is give or take Asian session. Like I said, it scatters, right? Because sometimes like China might open first or Australia might open first, then New Zealand, and then China might still be open at 4 a.m. Eastern, but Australia might already be closed, right? So you're going to have a little bit of an overlap and a little bit of a staggered effect here. So it's not exact, but give or take 6 p.m. to 4 a.m. Eastern is Asian session. And then we have an overlap here. This is going to be London session. So the London session, United Kingdom opens up, Germany opens up, Switzerland, France, some of the bigger European countries. So we have this happening here. And this is typically 2 a.m. to 12 p.m. More the 2 a.m. to 3 a.m. is more of like a pre-London session. You do get some volume there, but really it's 3 a.m. to 11 a.m. is when I look to trade anything from this, and I'll explain what that means a little more. But typically, once again, you have scattered countries, right? They're not all, sometimes it's an hour difference. Like, for example, I'm in the East Coast of the US. If I go to the West Coast of the same country, it's still the US markets, but it's a 3-hour difference, right? So you have hourly differences here that are going to vary. Nothing's going to be exact. And then going into the New York session, this is the United States, Canada, Mexico, South America, basically the Western region of the world. And this is going to be 8 a.m. to 5 p.m. Eastern. This is typically the highest volatility and the most market participation. Oh, but a yawn, excuse me. Oh, so this is typically the highest volatility and you get the most market participation here. This is just a little visual here to give you an idea of what the overlaps look like, right? So we have Sydney here, Tokyo, London, New York. And once again, Sydney, Tokyo, like Asian session, I just call it Asian session, 6 p.m. to 2, 3 a.m., 4 a.m., whatever it is you want to call it here. And then we have London open. And so we have an overlap here. And then you have another overlap here. Typically, these times, if I were to circle them like this time right here, and this time right here are typically the times when I see the most volume. Unless if I have a reason, I'm usually not trading outside of these times. Like the 5 a.m. to 7 a.m., I'm usually leaving it alone. Then I'll be on the markets at 8 until like 11 a.m. And then, yeah, later in the day, I kind of leave it alone. Sometimes, once again, if I have reasons, you'll understand what reasons mean, hopefully, the further we go through this. But typically, the goal, the currency you're trading is more likely to see its biggest moves while its own country is operating. And the reason for that is this: the banks for that country open, economic data usually comes out, right? You have like inflation, unemployment data, GDP, a bunch of these things. You have news that comes out, right? Because the politicians are awake. You have events, political events, you have meetings, what have you, for those individual countries. For an example, just to like show you, like typically during Asian session, 8 p.m., 9 p.m. my time, I typically see a lot of headlines coming out from Japan. The Bank of Japan is almost always talking around that time. They do talk during New York. Like I said, New York is the most market participants. I see Russia, I see Ukraine, I see the United Kingdom, the Bank of England, Japan, Europe, like they're all talking during New York session because it's the highest volatility there. But during their own individual sessions, you do get opportunities there as well. So it's just important to be aware of all of it. So volume matters. You want the volume to be in your favor because the goal is to trade when there is the most volume in the markets, which is why I was showing you here. I like the overlaps, right? Now, don't get me wrong. There might be a catch or two in between here if you can catch it, but the overlaps will give you the most volume, right? So volume is your friend. It gives you the chances for higher probability trades, and it will give you better entries. Next section we're going to talk about is some trading styles. So that covers the times, right? We understand sessions, New York, Asian, London, all of those sessions. Let's get right into the styles of trading that you can get into now. All right, let's get right into trading styles. So there's going to be 4 different styles of trading that you're going to hear or you're going to do yourself. And the first one is scalping. Then we have intraday, we have swing trading, and we have positional trading. We're going to talk about all 4 of these. We will get more in depth as we go, but at least let's get like a little bit of a surface level education here on what these are, right? So scalping is considered short term. It could be anywhere from 5 minutes to 1 hour. or it can just be one session's worth of volume, right? You could be trading just New York session, just London session, just get a scalp. You're in and out of the markets. Now, don't get too focused on like it needs to be 5 minutes or an hour. If you're trading over an hour, you're not scalping. Like, who cares? At the end of the day, this is just terminology. It's really not that big of a deal. I'm going to show you how you can get different types of trades, or you're going to learn how these actually play out. And yeah, that's it. Just when you hear people talk about scalping, it's typically a short term in and out. I'm not holding this trade forever. And then when we talk about intraday, we're usually, right, intra means in. So we're talking about within a day. You could be holding the trades through more than one session. Maybe I took the trade through London. I'm expecting it to continue further. So I'm going to hold it until New York session and going into New York session to see if I can get any continuations and just keep that trade open, right? So that's intraday. Swing trading is longer term, right? So swing trading can be days, it can be weeks, it can be months, and it's the best opportunities is going to be when we see a huge shift in market expectations. Super important with this one right here. You need to see something change for one of these currencies or assets that we're going to be trading, which we're going to talk about how to identify those too. But for swing trades, the markets aren't going to just move in one direction for a long period of time just because it wants to. There's going to be a reason behind it, and you're going to learn all those reasons as we get into this. So typically swing trading would be something at least longer than a day. But once again, you don't need to get too caught up in like whether I'm a scalper or a swing trader. We're going to talk about that too. So positional trading is based off price level and macro analysis. This would be something like, hey, the world locked down for 2020 in March because of COVID. I'm looking at oil to do this for the next 2 years. Or sometimes it could even be seasonal. Typically, if you were to look at seasonal analysis of like commodities, which we're going to get into, something like oil, typically the demand for oil will become higher as the winter comes. So typically we do see prices of oil increase during the wintertime because the demand of it goes up, which we're going to talk a little bit about that too, demand, supply and demand, commodities and all that. But yeah, you have seasonal analysis, could be months, could be years. I mean, I don't like putting time limits on this stuff. It could be weeks, it could be days. I have no idea. I don't think you need to focus too much on this. Just positional trading is more of, I think the biggest thing, if you hear someone talk about positional trading, they're talking about macro analysis. There's a reason that they're looking for it. They're not really looking at the charts. They're not looking at much else except like, this is what I think is going to happen to oil over the winter. This is what I think is going to happen to the US dollar because of this. And I'm just going to hold this position and see what happens over the next year, something like that. Now, which style do you choose, or how do you choose a style? It's really going to be based on your risk, your patience, and your own analysis. The market environment conditions are also going to play a big part in this. Like I said, when it comes to like swing trading, the markets aren't going to move in one direction forever because you want them to, right? There are times when it's a scalper's environment. There are times when maybe we can catch some swing trades. You need to see that shift in the market, right? Now, the markets could be indecisive or ranging. That's typically when we're looking at scalps, right? I'm just in and out of the markets, if we can even catch anything. Do we have high impact data or events coming up? We're going to talk about that during the fundamental analysis, as well as sentiment, intermarket, all that stuff too. But this is very important. Monetary policies and all this stuff, which I don't want to use the big words yet. We're going to learn about all that. So high impact data or events, that's also going to depend on, that's going to fall into your analysis, right? What we're looking at. So the next section we're going to talk about is what types of analysis are there? All right, so let's talk about types of analysis that we can get into. There are 4 major types. We're going to talk about all of them. We're going to go pretty deep. Each, if you haven't gone through the library, content library yet, like you have one section for all of these. So the fundamentals is going to be number 1. We have intermarket analysis, we have sentiment analysis, and technicals. So if you know me from social media or anything, any other courses you may have taken, I call this the FIST framework, right? FIST, fundamentals, intermarket, sentiment, technicals. All of these are, to me, extremely important, right? So you always get this question here, which one is best? I like to look at, I love this image. So if you're sitting on one and you don't have the others, you're going to fall off your goddamn chair. You're going to fall off your profitability chair. You're not going to do well as a trader. You need to be well-rounded. You need to understand all of this, right? So none of them is more important than the other. You have to have all of these styles of analysis. And I'm not going to dive too deep into all of these, but they all play a part in your, like I said earlier, right? I get ahead of myself in the slides. They all play a part in your analysis and your profitability. So we won't spend a whole lot of time talking about them here because you have entire, like phase 6, 7, 8, 9 is all four of these. So we're going to go very deep into those. Let's talk about the assets that we can trade, and then we're going to move on to phase 2 after that. Lesson 1.5, assets we can trade. So we're going to, once again, we're going to dive deep into this as we get further in the course, but I want you to have this foundation so you at least aren't lost. The things that we're going to be looking at trading: currencies, commodities. Now let's talk about currencies real quick. This is, like I said in the first section, Great British Pound, US dollar, the Swiss franc, the Japanese yen. I'm going to show you every single currency, at least that I focus on. There's 8 of them. The main ones, they're called the majors. That's what we mainly trade. Commodities. We're going to dive deep into this too, but these are things like natural gas, oil, gold, silver, iron ore, copper, stuff like that. Mainly I trade gold and oil, sometimes silver, but mainly gold and oil for the commodity space. And then equities. We have an entire section on this as well as we get a little deeper into this, but these are things like the US 30, the NASDAQ, the UK 100, also called the FTSE 100, the DAX 40, which is Germany's stock market, right? So that's what equities are. That's what we're going to be looking at too. These are the main assets that we're looking to trade. These are the ones that I focus on, and this is really what we're going to be learning here. Now, there are other assets you can trade. There's a ton of things you can trade. Individual stocks, things like Apple, Tesla, Netflix, right? You can get into doing that. Cryptocurrencies, Bitcoin, Ethereum, Dogecoin, if you really wanted to. I don't mess with cryptos. There is no real fundamental analysis that you can do on them. You can just buy and hold. So to day trade these, I'm not a big fan of. Buy and hold, maybe. Like stocks, I do like buying and holding them if I have a reason to. If I see potential in any of them, I don't typically do it as much. I mainly stick with what I'm an expert at. So I don't mess with these too much. And then you have options and futures. Now, I can't even really talk too deep into this at all because I just don't mess with it. So that would be a completely different course. There's less volume. There's less analysis you can do with that. The things that I do, I'm great at, and you can make a lot of money doing it. That's what we're going to stick with here. By the way, I just saw it right now. Don't ding me on this. There's a typo there. It's supposed to be an E right there. Cryptocurrencies. So you know what I mean? I'm not going to change it now. We've already committed to this. So anyways, going into the next section, we actually have phase 2, right? So we're going to talk about brokers and metatraders. And that's what actually you're going to be using in order to take your trades and get your trades executed in the market. So I'll see you guys over there. All right, welcome to phase 2. Let's get right into introduction to brokers. We're going to talk about what are brokers, how to test them, what they are, and I said that. So let's get right into what brokers are. What is a broker? A financial services company that provides traders access to a platform for buying and selling foreign currencies. That's a really nice definition if you're on Google, but let's get a little more into it to actually understand what this means. Here's a little graphic if you need it. Here's the broker, and it connects to you. So basically, a broker is where you deposit your money, and you're going to use that brokerage account that you make in order to sign in, which I'm going to show you how to do all of this. You're going to use that to sign into your terminal, which is called MetaTrader. And then that's where you're going to actually execute. You're going to hit your buy, your sell, and actually execute your positions or your trades on, right? So that's what a broker is. Now, this is a screenshot of MetaTrader. We're going to talk about MetaTrader the next section, but let's talk about how brokers actually make their money. And we need to show you a screenshot to make this a little more visual. So this, you can see here, it says GBP JPY. This is a chart of the Great British Pound versus the Japanese yen. This right here, just to break this down, because we're going to talk a little bit into this, that 5, this is called a lot size, right? So this is where you would decide your lot size, which we're going to talk about, so don't worry too much. Just giving you a little familiarity with it. This is the sell button. This is the buy button. So let's see how brokers make money, or one of the ways. It's called the bid-ask spread. So a buy is called a bid, a sell is called a ask. So don't worry too much about that. But basically what it means is there is a spread. If you look at this, GBP JPY is priced right here, 156.722, right? So that's where the price of GJ is. I'm going to call it GJ, GBP JPY, same thing. But the sell price, look at the sell price, 156.72, right? So it is 722. So, okay, so there's not a difference there. And then let's go to the ask. The ask price is 156.735. So as it's pushing up, if I were to hit buy right now, it's actually going to enter my position at whatever this number says here, regardless of what it's actually at here, right? So it's actually going to enter my position at 156.73. Let's just, right? The difference of 0.013, which is 1.3 pips. We're going to talk about pips. We'll talk about how to measure them and all that too. But pips is a unit of measurement. That's what we talk on. You'll hear people say, like, I caught 20 pips, I caught 30 pips, I lost by 30 pips, like whatever it is. It's going to be the measurement that we're looking at when we're looking at this. But what happens is the broker, when you're entering these positions, they collect the spread amount when your position closes. They take the difference, win or loss. They are making their money at the end of the day. The broker is always going to win, regardless of whether you're actually getting winning trades or not. Another way that they do it is called fees and commissions. So you're going to get a commission or a fee per transaction, or depending on the lot size you use. So most brokers will either have zero spread, meaning like this one here, it'll actually enter exactly where it's at, but they'll have a fee for the lot size that you use. Once again, that's that number that you use up here. The bigger the lot size, the more money you're risking and the more money you're making, basically. So they have fees and commissions for that. And then additional fees to trade exotic options. So I don't typically trade any exotics, but these would be things like emerging markets. If you're trading maybe the Chinese yuan or Italy, or you're doing some type of exotic. I don't mess with exotics. We're going to focus on the 8 majors. That's the best ones to go against. I'm not doing the Russian rupee or ruble or whatever it is, a Turkish libra, I think it's called. I'm just not playing with that. You can actually apply a lot of the things that we talk about here and put it into that, but we'll focus on these and we'll start with that. Regulated brokers, right? You have 2 different types of brokers. You have regulated, you have unregulated. We're going to focus first on regulated, what it means, why they're called regulated, and the pros and cons of each of them. Now, the purpose of them is to protect you from undisclosed financial risk, abusive practices like price order manipulation, and fraud. Basically, there's a lot of rules around them. So regulations and governing bodies vary from country to country, depending on where you are. If you're in the US, it's actually very strict. If you're somewhere in the Bahamas, or if you have a broker that's on some random island, it may be very, very different. So there's that. Rules include being registered, licensed, regular audits. And more strict rules equal more costly to do business, which means if you're a regulated broker, you have to abide by a lot of rules, and all these audits means you have to have your I's dotted, right? Dotted your I's and crossed your T's. You're going to do all that stuff. It's going to be more costly to run that broker. So the pros, you get more protection. It's much less likely that you're going to deposit $10,000 into a regulated broker and you're going to lose that money because the broker disappeared. I've seen that happen multiple times down here. Now, granted, I use an unregulated broker right now, but I have seen it happen where a broker just kind of disappears. The cons, some of the bad sides, is that you get lower leverage. We're going to talk about leverage and trading on margin in the next couple of slides. And there's also higher cost to operate. So because it's higher cost to operate, you might get more fees and you can't leverage as much. So you can't make as much as easily. You basically need to have more money in your account to trade. But I'll explain exactly what that means when we get into leverage. Unregulated brokers, typically light regulation or none at all. They're an unlicensed company and not regulated by any regulatory agency. The pros, because they're cheaper to operate, you get better leverage. You also get tighter spreads. Remember we talked about the spread difference, the 1.3 pips we were looking at before? You actually get, the spreads might be a little better because of they're cheaper to operate. Now the cons is there's higher risk. So if you're going, we'll talk about testing them at the end of this. We'll talk about how to test brokers. But yeah, there is risk to us if you're just jumping around from unregulated to unregulated broker. They can disappear and there's not really anything you can do about it. The one thing to note is that even if you're looking at a regulated broker, they can still be licensed in jurisdictions that have very little requirements and rules. Like I said before about the Bahamas, or like, I won't get into Jamaican Islands, maybe, like I won't get into specific countries because I don't know their actual rules. I don't own, at the time of this recording, I do not own my own broker. So I don't know all of their rules specifically. Maybe one day it'll happen. I'm just not interested right now. But there are, depending on the jurisdiction, like I said, it's one of these things that you don't have to think too much about. We'll talk about how to test them. Don't overthink this stuff. If you get referred to one, or if you check some out and you have a lot of friends using it, or you know people using it, there's someone maybe put their face on it and they stand by it. That's actually one of the ways I've seen them. I saw one person get kind of scammed out, but like for the most part, you really don't need to worry too much. If you're really that nervous, just go to a regulated and you'll be fine. Now, lot sizes. once again, I just want to clarify this, like, don't overthink it. This is a lot of information you're going to be getting, especially if you're brand new to this stuff. Like, don't think that because you're getting into trading, you're going to get scammed. Like I've been using an unregulated broker ever since I've started trading. I have not been scammed once. Now, when it comes to like people, I've been scammed by specific people, but not necessarily brokers or anything like that. I've never personally experienced it. So at the end of the day, go with your gut. Now, talking about lot sizes here, this is something that I'm going to give you. This is going to expose you to lot sizes, but I don't, once again, like I don't want you to have to think that you need to memorize this stuff, because I'll be honest, I've been doing this for a couple of years. I don't have any of this stuff memorized. You don't need to memorize this stuff, but you do need to understand it. I understand what a micro lot, a mini lot, a standard lot is, right? With experience, it's just going to come more natural to you, but this is what lot sizes are, right? So you have a micro lot. It's going to, remember that showed you that 5.00? That would be what's considered a standard, right? It says 1.00. You can change it to a 5. Mini lot is going to be a 0.1, like in the right after the decimal, which would be the 10th. And then the hundredths would be a 0.01, 0.02, 0.05, whatever. That's going to be called a micro lot. So when you're looking at this, I'm going to give you a better example than just this chart, but standard lot gives you access to 100,000 units of currency, right? So a one lot actually means, if you're taking one standard lot here, it actually means you're controlling $100,000 worth of whatever currency it is that you're trading with. That's what leverage is. That's what trading on margin is. Lot sizes are your main, this is a big point right here. Lot sizes are your main way for controlling risk management in your trades. If you, right, like, we're going to show you how to measure them. You're going to figure out, like, there are pip calculators. I'll tell you right now, just in case I don't have it later, Forex Factory, not Forex Factory, my FX books. Just go on Google and search pip calculator. My FX books has a whole library of calculators. It'll show you how many pips means how many dollars for every single currency pair you're going to be looking to trade. So that's very important. But the lot size that you're using is going to be the main way for controlling your risk management. If I'm using a 0.01 or if I'm using a 5.0, it's a big difference in what I'm risking. And depending on my account size, that's how I'm going to decide what lot sizes I'm using, right? My risk management. So going a little deeper into lot sizes, let's say we enter GJ at 156.0, and let's say price moves to 156.5, right? That's 50 pips. Remember, I mentioned pips before. That's going to be measured in 50 pips. I'll show you how to measure pips in the trading view section. So, which will be phase 3. Let's say you took a one lot. Remember here, it says 1 pip equals a $10 change. So we took a one lot, and we caught this 50 pip movement. We entered buys here. It went up 50 pips. We took a one lot. That's $500, right? 50 pips, $10 per pip, 10 times 50, $500, right? 0.1 lot would be 50, right? If we go back to this again, it's 1 pip, $1 change. And then you can look here, 1 pip, 10-cent change, right? So you can kind of do the math if you're doing it in your head as we're going along. A one lot will be $500, a 0.1 would be 50, and a 0.01 will be $5. So you can see the difference here. Now, that means you're also risking more, right? Because if 50 pips goes in your favor, you won $500. If 50 pips ends up going against you, you lost $500, right? So you always need to keep that stuff in mind. We'll talk about how to actually analyze and catch these trades, and so that you have a higher probability for it to go in your direction. But this is still important to know. The lot sizes is going to determine actually what you're risking. So talking about leverage, this is also called trading on margin. It's the ability to borrow capital in order to gain a larger exposure to the Forex market with a relatively small deposit, right? Like I showed you before, 1 unit of currency in a standard lot, you're actually controlling 100,000 of whatever currency it is you're trading with. Higher leverage gives you control of a larger trade size. I kind of alluded to that already. So a few things here. We're just going to show some graphs. One lot equals $100,000, like I showed you before. And now this is what, when you're looking at leverage, like if you're opening a broker and you're going to a brokerage account, it's going to ask you leverage, right? In order to take a one lot, you have to have this leverage here. It's called 400 to 1, 200 to 1, 100 to 1, or 50 to 1, right? So in order to be able to control $100,000, meaning take a one lot trade, you need to have, if you have a 400 to 1 account, $250 deposit, $500 for 200 to 1, $1,000 for 100 to 1, $2,000 for a 50 to 1. Makes sense? Now, don't worry too much about all that stuff because you're going to see it as you're opening a broker. Most people I think I have a 500 to 1 that I use or 400 to 1. I don't use high leverage though. I'm not over leveraging my account. It's just that was all that was available. And the leverage is there if I ever need it. So just because you pick a high leverage account, if you do, it doesn't mean you can only deposit 250. You can deposit 17, 20, 30,000 and still get a 400 to 1 account. And you can still use good risk management, right? But the leverage opportunity is there if you want to use it. It's just a lot more risk. You can flip an account faster, you can grow an account faster, but you're also losing and blowing accounts faster if you take a lot of losses. So this is just a little percentage graph here. 400 to 1, you only need 25% of the margin required for a total transaction. Once again, I don't want to confuse you with all of these crazy numbers. Not that big of a deal. Basically, just understand 50 to 1, low leverage, 400 to 1, 500 to 1, high leverage, right? You can take bigger lot size trades with a smaller deposit amount. Pros, once again, bigger profits. Cons, bigger losses. I kind of, like I said, I get ahead of the slide sometimes because I just rant, but hopefully it's still helpful to you guys. Talking about live versus demo accounts. You're going to have two different types of accounts. The biggest difference, a demo account, you can make, when you're opening a broker, you're going to choose, do I want a live account or a demo account? A demo account just means you're trading in live markets, like you're actually taking real trades on MetaTrader, but it's fake money. You can make a $10,000 account, you can make a $500,000 account, a 300, whatever you want. It's going to be real trades, but it's fake money. Honestly, if you were to ask my opinion, the only benefit to demo is to understand MetaTrader, which I'm going to show you MetaTrader. So if you have never used MetaTrader before, I would make a demo account, go to a broker, make a demo account, and all you need to do is play with the buttons. It doesn't matter if you're taking losses or you're screwing around, you're entering crazy trades. You just need to learn how it works. I would definitely recommend going to a live account immediately. Once you understand how it works, this is trading in the live markets with real money. The reason is you're not going to learn anything with demo other than how to use it, right? So the risk management, the psychology, the trades that you'll hold, the trades that you'll close, the type of money, because if you're going to put in $1,000 on a live account, but you're trading with a $500,000 demo and you're taking like $20,000 losses on a demo account, you're going to freak out when you lose $5 on a live, right? There's no relevance between the two. You can't, there is so much, and we're going to go into psychology in phase 4, but there's so much psychological barriers that you're going to have to break. And you're only going to do that by trading live, by really, really getting into it. So that's just my opinion. Demo is just to learn the basics and then get right into a live account. Now, testing a broker. If you find a broker that looks safe, you want to use them. Maybe you had a few friends that referred you to them, whatever the case, and you still want to test them before doing it, just open a live account with them, make a small deposit. After you make that small deposit, go open and close a couple of small trades, and then request to withdraw the entire account, everything. Pull it all out. Make sure you actually get your money back, right? How long did the withdrawal take? Typical is 24 to 48 hours. Anything above that, if there's like something fishy going on or it's taking weeks or something, like there's an issue, maybe they're not giving you your money, like whatever the case, don't use that broker. So if you're going to test brokers, do it with an amount that like you're okay with being like, taking this kind of a risk with. That's just what I would recommend. So the next section is going to be intros to MetaTrader. The broker needs to be connected to your MetaTrader, and that's exactly what we're going to cover next. Section 2.2, intro to MetaTrader. Let's get right into it. This is exactly how you're going to be actually exiting and entering your trades. So what is MetaTrader? Basically, I've said this before, it's a platform used for opening and closing your trades. You're going to have access to MetaTrader 4 or MetaTrader 5, and your broker is going to dictate which one you choose, right? So whichever broker you choose, they're going to have a specific, whether we only use MetaTrader 4 or 5, it's going to be up to them. Like, for example, my broker, Dominion Markets, uses MetaTrader 5. I like MetaTrader 5 better, so it works out great for me. I'll show you exactly what that looks like. So they're available as a desktop and mobile app. I don't look to enter or exit trades on mobile, but I do manage it. Like, yeah, maybe sometimes I'll close a trade. I'll set alerts. We'll talk about that a little more. But I like my room. I like my environment. I'm very strict about like where I trade. So it's usually always on a desktop, but I do have it on my phone as well. And I'll make sure we put the links down below to download. So in order to connect your broker to MetaTrader, let's say you've picked a broker, you've deposited some money, or you have a demo account even, how do I actually connect it to MetaTrader? So I'm going to go over the steps here and I'll show you how it's actually done because I have a demo account open right here. So the first step, we're going to go to File, open an account. We're going to search for your broker. You're going to click next. You're going to connect with an existing trading account, and then you're going to use a login and password. So if I show you what that looked like, we're going to go to File. I'm going to go to Open an Account. I'm going to find whichever broker it is. Let's say it's Dominion Markets. I'm going to hit Next. And now I'm going to go down here, connect with an existing account, and I'm going to put in whatever my login and password. It'll email you. Your broker will email you a login and password. So you use that to get in, and then you'll have your login up here. This is your account number, and that's pretty much it. You can see this is a demo account right up here because it says, literally says demo account right at the top. So looking at MetaTrader, this little section here is called the Market Watch section. This is where you're going to have your list of currency pairs, any other tradable assets, commodities, equities, whatever it is. You can put them here. Now, in order to add them here, all you're going to do is you're going to click this little add button here. You're going to type in the pair and hit enter. So let me show you exactly what that looks like. I don't have it open, but we'll do Market Watch and view. Let me open the navigator too. So I'm going to go here. I already have a bunch here, right? You can ignore everything in the middle because I'll talk about that after. But let's say I want to add something. I'm going to click that little add down here. And let's say I want to do a GBP pair. So I put GBP, and now look at all the ones that come up. So I can keep typing if I want. If I want GBP JPY, and now there's just one there, I can click it. And if I hit enter, it already tells me I have it here, right? It's blinking. So I already have that. So if I wanted to add something new, let's see GBP, we'll do like Ethereum. Ethereum versus GBP, I hit that. It's typed in, I hit enter, and now it's added to the bottom. Now, if I want to open that chart, all I do is I right click and I hit chart window, and now it's right here. Okay. We're going to get a little more deeper, but just showing you exactly how this little section works here. Now, the navigator panel, it's going to be this part on the bottom left. This is really just where you're going to see your accounts. There's no limit to how many accounts you can have here. You're going to have indicators, which we'll cover a little more in the technical analysis section, as well as expert advisors and scripts. These are like bots, algorithms, stuff like that. I'm more of a manual trader, at least as of right now. I haven't built any bots yet. So this is doesn't really apply. I've never really even used it. I don't even use indicators. So we'll talk more about that on the phase 6, the technical analysis. But really the most important thing really is the account section, because that's where all of your accounts are. And I'll show you what it looks like on the real one too. So you don't see just a screenshot. If I hit accounts, indicators, it'll open up. I won't open accounts because I actually have my accounts in here, my other live accounts, but scripts, like you can just play around with this if you really wanted to, but I really don't mess with it. Actually, the only EA I do have here is Magic Keys. So I have that on here. That looks like, I don't think you'll see it. Yeah, it's this little thing here, which I just close out anyways. So don't really sweat that too much. Trade panel, this thing on the bottom here, right? It shows your balance, it shows your equity, it shows your exposure, how much exposure you have to the markets, your free margin. I have a screenshot coming up where we'll break down all of this on our other different account and show you what it looks like. You also have history. So if you look at this demo account too, I can see if I click, look, this account started at $5,000. I was playing with it. I was showing someone before on how to take some trades or whatever. So obviously there was a loss there because just messing around. If I hit history, it shows me right here, profit, negative $297. The trade that I took was negative 225, but you can even see here, negative 225. How come there's negative 297, right? Remember I told you before about how brokers, they make their money on commissions and fees. It doesn't tell you what the commission is here, but that's because of the commission, right? You're going to be actually losing or gaining a different amount than you actually have here for your profit. News tab, mailbox, all of this stuff down here. Really, I go to trade. You can look at exposure too, to play around with. Really, trade and history are the two things I look at the most, and that's about it. I don't use news on here. I have a news terminal. This news here probably isn't that reliable, to be honest. Mailbox I don't really use. If you want to check it, cool. I've never found anything important in any of these. So typically, trade and history are the only two important things you need to really worry about, at least just for. I've been doing this for a couple of years and I've never had to worry about anything else, and I'm a profitable trader. So I don't think it matters that much. Now, this is a screenshot here. We have a couple of things before I'm going to go through the slideshow so I don't get ahead of myself on this, but available equity is any available funds to open further positions, right? So that is going to be right here. And before I want to break down everything else, but let's go through this slide to make sure that's available equity. That's what you have currently. And then used margin. Deposits used to keep positions open and held by the broker. That's going to be this right here. You have used margin and then you have free margin. This is what's available to take more trades, right? So does this stuff, like you're not going to be watching this that deeply. I'm just breaking it down so you know what it is. But we'll break down, yeah, here we go. We'll break down a little more. So this will make it more easy, the things you really focus on. Look at the balance, 304,424, right? Your equity is 302,247. The margin, 1,300, free margin, 300,000, margin level. Don't worry too much about the percentage level on that. But what you want to see here, or at least the things you focus on, if you're watching your own accounts, like push up and down, your balance, this balance is going to be your running profit or loss, right? So what it means is my equity, you can see I have negative $2,000 in this trade, right? That means this, you're actually going to see balance going up and down. So this balance is going to be dropping and going back. Like if this goes to zero, this balance is going to go back up to 306,000. Make sense? It's actually going to be moving in real time. Actually, no, I said that backwards. I'm sorry, I said that backwards. Scratch that. Scratch that. The balance doesn't move. It's the equity that moves, right? You can see how it says 302,000. If this goes higher, if that goes to zero, then you're going to go back up to the 302,000. Make sense? So I said that too fast. The balance is what you have. The balance will change when I close this position. So if I close that negative $2,000, now my balance is going to show 302,000, which is what's here. This is my available equity to enter more trades. This is my current account balance, because this trade I haven't won or lost yet because it's still holding. It could still go in my direction, right? So just you're getting a little bit of drawdown. So that's all that means there. Now, looking over at the chart panel. The chart panel is literally just where the charts are that you want to view. You can place one chart, you can place multiple charts here, and I'll show you what that looks like here. I typically like to have these closed because I have all of my charts. I open all my charts and I minimize them here. It's what I like to do. I have them in alphabetical order. Like you can see AUD pairs, CAD, Euro pairs, all the things that I trade. So, and then equities here, and we're going to cover all these. But you could, if you wanted to, I can have like a chart here. I can have another chart here, and I can play with it. I can go like that. I can, whatever you want to do. I don't do any of this stuff typically. If I'm trading two pairs or I'm looking at two different things, maybe I'll do that while I'm trading. For the most part though, I leave it all like this and I don't really mess with it. If I'm going to look to trade a pair, I'll do this. And I have the chart right here. So we'll talk about the next slide. I think we talk about actually customizing these. So let's get into that so I don't get ahead of myself. Let's talk about a few things here, right? So I'm just going to show you live on the actual account. I'll put it in the background. So template, timeframes. We're going to talk a bit about timeframes when it comes to TradingView, but if you want to change timeframes here, it's pretty simple. It's right here. You have M1 means 1 minute, M15, right? 15-minute, hourly, 4-hour, daily, weekly, monthly. I'll show you when we get into technical analysis, you're going to learn a lot about the candles, what this looks like, what this means, what these candles are, what the timeframes are, all that stuff. But just showing you how to change it, that's it right there. Creating templates. If you want to create templates, like let's say I want to change colors here, and because these colors are specific to just how I like it. If I wanted to change colors, I go to properties, and now I'm going to get this little thing here, and I can change all the colors, the candles, the background, whatever I want. You can edit all of this. Then all I need to do is I'm going to right click. After I have all my colors set up, I'll right click, go to templates, and then I'm going to put save template. And then I can save it, whatever I want, right? So if I were to upload a template, or if I was to load a template right now, like these, some of these come with the MetaTrader when you open it, but let's see what main looks like. These are the old colors. Like you saw a screenshot of this earlier. If I go back up here, oh no, I'm sorry, it was on the brokers, so it's not here. Yeah, so the old colors I used to use is blue and red, but now I really like just the black and white ones. It's cleaner for me. So I have this saved, black, white, bam, done. And that's it. That's when it comes to templates, how to place a trade. So when you're actually looking to place a trade, exit a trade, really, this actually won't be here when you first open MetaTrader. So you have to right click and you're going to go to one-click trading. See how it just went away? So I like doing that. It's the easiest thing to have right on the chart, one-click trading. And then literally all I'm doing, if I wanted to buy, I'm going to, once again, we're going to go over how to actually buy and sell, like what the analysis looks like. But if I'm just looking, okay, I want to buy, I hit buy. And that's it. You can see the buy just entered. It says here, type buy, GBP USD. It starts you off. Remember I told you about the spread, right? It bought at a different price, which means that you start automatically in drawdown. It's nothing crazy, but you start in drawdown. Now, when it comes to, do I have stop losses? Yeah, stop losses and take profit. If you want Now your stop loss, you should always go based off market structure, which we'll talk about in, once again, technical analysis. If I'm going to buy, all I need to do is grab that green line and drag it down. You see this red line I have? And then I just let go, and that's it. If I hover over it, it'll tell me how much I'm going to lose when it hits my stop loss, negative $17, right? Now, if I go the other way, I'm setting what's called a take profit. Let's say I want to go to these highs right here. All I do is drag it. You can see it says TP, SL, stop loss, take profit. Now, if I hover over it, $17, right? So this is what would be called a one-to-one RR, which means a one-to-one risk reward. I'm risking $17 to gain $17. That's pretty much it. Buy orders, sell orders, buy limits, and sell limits. Honestly, I don't use these. Let me show you first how to close the trade. So it's literally, you just hit this X right here. And that's it. Trade's been closed. And now if I go to history, negative $1.20, right? Just took that live. But look at the difference if I do like, that's a 0.2. What if I do like a 5.0? Watch the drawdown. I want to sell this time. Looks like it's starting to drop. So we'll see if that plays out. But it's at negative $35 instead. Before was at what? Like a negative 80 cents. But now the difference is if I grab this little line, which you can't see because price is hovering over it, but if I grab it, drag it up, now that's the stop loss because I just entered sells, which means I want the markets to go down. Now my take profit is going to be down here, right? So $1,100 now, even if I go to the same area, now it's $480 instead of $17, right? I come back up here, roughly where the stop loss was, 850, right? Big difference. Markets, I mean, today's a holiday as of recording this, so really not a lot of volume today. Anyways, I'm not really looking to trade today, but that's pretty much it. Another thing you might want to know is how to take partials. So I don't want to take too long on this to make this video long, but basically, let's say I have a 5 lot on here, I want to take 50% of my profit. I'm going to double click this. I'm going to hover. It has to be under market execution. I'm going to go to volume and I'm just going to do half, 2.5, and I'm going to hit close. That's it. Now it just dropped in half. And now if I hover over this, now it's 425 instead of 800. And now my loss is less too, right? I just cut that position in half. Once again, if I want to close, hit the X and that's it. Okay. So yeah, as far as buy limits and all that stuff, I don't really do that. But what you would do is you go to new order and you go to pending order. You buy limits, sell limits. I don't even want to give you advice on this, to be honest, but basically all it means is like, if I set a sell limit, it's like, okay, it's going to enter, it'll automatically open a position for sells if it hits this. Like, I don't play with these that much. I won't even talk on them. I don't think it's worth it. I'm very profitable not doing any of that stuff. Most people who are guessing do that kind of stuff. That's not my game. So I won't play with them. I don't touch them. I don't mess with it that much. That's it. Let's get into TradingView and let's actually talk about how we analyze the charts and what TradingView looks like in real time. All right, TradingView, let's get right into, a lot of this is going to be actually on TradingView, but I have a little checklist here. We'll cover some things. So what is TradingView? Mainly, you look at technical analysis here, we mark up charts like it says here, and it's a visual representation, right? It's actually what you see here where we see the candlesticks, this little line going across is just an alert. I'll show you that too. Oh, excuse me. And that is basically what TradingView is. This is where we're actually doing our analysis. We're marking up charts. We're looking for our entries here. And I'm using MetaTrader to take my trades. So yes, I have 2 charts open. This is the main one here. And I'm just hitting buy or sell on my MetaTrader. Now, there are things you can do, which I don't typically do. You could just use MetaTrader to enter your trades and just look at those charts. I like the versatility that TradingView gives you. There's a lot more cool stuff you can do. I'm very visual. There's a lot of charts you can add. There's so many things you can do that makes it a lot easier. So yeah, you can also actually TradingView, as of the recording of this, you can have a broker in TradingView and actually connect a broker so you can enter and exit your trades on TradingView. Not a bad idea if you want to do that. I personally do a lot of live trading calls. I do a lot of, so like, I share some of my accounts with people and I show my trades, but typically I'm not showing my account balance to everybody. So I don't take any trades live on TradingView. I have it on the side of my Zoom call, whatever it is that I'm doing, but we take those trades live. It's just, I don't show my account balance depending on what account I'm trading to everybody, not really everybody's business. So anyways, looking at TradingView, let's get right into some of the things here, the candlesticks and timeframes, right? So in the middle, like I showed you before on why isn't this working? Here we go, got a little arrows. Like I showed you before, we got candles like we showed on MetaTrader, same thing. Time frame, same thing. You can change your time frames up here. We'll talk a lot more about what these time frames mean on technical analysis, but it's still good to know that they exist. Now, this is just a little list. I want to show you things you can do. Now, This might be something you kind of brush off if you're brand new to this, because this might not mean that much to you, but just to show you some of the things you can do with TradingView, like now your charts aren't going to look like this at the start. You'll notice that the black and white candles are the same color as I showed you on my MetaTrader, because I like to have them match, right? So what I did right now is there's a little eyeball here. This is just like areas I have marked up on the charts, and I can hide it if I want to, right? So there's that. Then you have your drawing tools all over here. You just hit this little arrow. So if you find the ones that you use the most, you can actually hit a little star here, right? Whatever you use the most of. I think I have a few things, all these stars. And then if I want to have a little like favorites bar, you see the star on the bottom left? If I hit that, now all the ones I just hit the star on are now here. So if I like to use these rectangle tools a lot, which you can see on the bottom, I do these a lot. I can have it here. I have these lines here, whatever I want. Like you can do all of that cool stuff right here. I don't really use that as much anymore. I trade my charts are very clear, very clean. So I'll show you what that means when we get to technical analysis too. But just to cover some of this stuff, indicators, watch list, replay feature, compare button. So I'll show you the watch list because that's important too. You get that right here. So when you're actually adding your pairs, it's similar to MetaTrader. You have a lot of now you can see my OCD here, right? All of my stuff is color coded. I have some indicators up here, like this is a Swiss franc, the yen index. All this stuff we'll cover as we get further, but I have color codes. You can just right click. You can change the colors of all of them. So if I click one of these, it'll change this chart over. Another way to do it, you can mess with your watch list. You can have a plus button here. It's this button right here at the top right. Or you can just type in right up here. If I put in GBP, whatever, like remember we did ETH GBP, I can do that here. I can click this, and now you can see in the background, it says ETH GBP. So as if you want to customize any of this, you go to settings, you can change all of your colors here, your appearance, your symbols, you can just play with it. You can save it as a template if you want. Once again, you can see my black and white template that I use. Same thing. I'm very consistent with all of that. When it comes to having your charts look like this or having like a lot of charts like this in one, this is just different versions. I have a pro version for TradingView because I like to look at multiple charts, which we're going to explain why I do that during the intermarket analysis, sentiment analysis, when we get a little deeper. So don't worry too much about that. If you have just one chart right now, completely fine. And I'm going to show you how to actually mark all of this stuff up. Make sure I don't miss anything here. Compare button. Compare button is actually a really good one too. If you want it, which isn't if you're brand new, once again, not that relevant, but if you want to compare like, okay, this is the NASDAQ, this is a US equity, which we're going to cover later. If I want to compare something to it, say I want to put the US dollar against it. I'm like, oh, what's the US dollar look like in relevance, in relation to NASDAQ? There's a little plus button right here. I click that, and I'm going to put in US dollar, which is DXY. This is the code for the US dollar. See, it says US dollar currency. I'm going to go to new price scale. If I go to same price, it's going to match it. It's going to like glue it to this one. I don't want that. So I want new price scale. And now the dollar just showed up, right? So now this one here, I can even change it. If I double click it here, I get settings that come up. I can go to visibility. I can change the color of it. I can go to yellow, whatever you want. So the compare button's really cool. I'm going to use that probably a few times throughout the course, but that's how you do it. If I want to get rid of it, I just hit this X and now it's gone. And that's pretty much it. So TradingView, if you don't, this is a desktop app, just so you know, you can go online, just tradingview.com. I'll put the link here. Very important for trading. Like it's super, super helpful. You can use the app. I prefer using the app because I have all of my tabs up here for all of my charts. Just like how I have my MetaTrader, you see my OCD kicking in again. It's in alphabetical order, right? So I have my equities and commodities first, all my commodities here. And then I have AUD pairs, CAD pairs, Euro, Pound, Japanese Yen, NZD, and then all my dollar pairs. So I'm very I always know where everything is at all times. So this is just a quick intro to TradingView. If there's any questions, I wanted to breeze through this, but any questions, I'll just hit me up, find me on social media or something. But that should at least give you an idea, because as we get a little deeper into this, you know what TradingView is, you know how it works, you know where the tools are, how to find them, all of that stuff there. So let's get on to next. Actually, let me double check, make sure I'm not skipping anything here. Get the look you want. I told you about creating templates. Okay, let's get on to trading psychology. That's going to be phase 4. All right, Psychology 101. Let's put the volume up a little bit here. Psychology 101. A little bit of an introduction here to trading psychology. I want you to understand it's going to be an ongoing process. if you get nothing out of this, you should understand that this is always going to be something that you should be coming back to and improving on. Everyone's starting point and journey will have some uniqueness to it. Now, I talk to a ton of traders, a ton of people every day, and there are similarities in some of the problems, but your specific relationship with money, the specific account size you're using, your goals, your motivations, they're all going to be a little different. Your mindset around money, all of this stuff is going to be different. So there is some uniqueness to each individual person. But like I said earlier, this subject should continuously be improved on as you progress. This isn't something I have a couple bullet points we're going to go over with each little video here for psychology, but I'm willing to bet that like you're gonna find one thing that you have an issue with, and then you need to work through it. And then as you grow, you're gonna find more. And I'm pretty sure I mentioned that here too. Whether or not you're new to trading, you'll find roadblocks with every new level, which is exactly what I was getting at. Every time you reach a new level, you're going to find roadblocks, and everything we talk about, you're gonna end up running into probably again when it comes to some problems. As long as you never stop learning and you focus on just having progress over everything. That's something I live by, is like, I want progress over everything. It doesn't matter how much it is, as long as I'm going this way, right? As long as I'm going, I don't know if you see my camera while you're watching this, but as long as I'm going forward and up, I'm happy. That's what matters, right? So just focus on progress. We're going to touch on a couple of things that I find to be some of the biggest problems with traders. If you're brand new to this, you're going to run into all of these very quickly, but you need to keep coming back to some of this stuff and being like, okay, well, what does Josh say about this? Or what, maybe I found a book I like on psychology, like whatever it is. So first things first, let's talk about fear of missing out. All right, so first thing, well, second thing actually, FOMO, fear of missing out. What is FOMO? I kind of just said it. It is the fear of missing out. So this can cause a lot of problems. It'll cause you to chase trades. It'll cause you to take bad entries. It'll cause you to trade when you shouldn't. It'll cause you overall to keep you from being profitable. The fear of missing out is usually, it'll occur when moves happen and maybe you miss the move, so you end up taking a bad entry. We'll talk about good entries and bad entries as we get early down the line in this course, but overall, it's just important to understand FOMO can really, really, really keep you from being profitable. You'll end up getting emotional. Like, it's one of the things you really want to avoid is taking trades that you shouldn't. If you end up feeling that feeling, that FOMO feeling, it's like, just get out, leave the markets alone. You know, one of the ways that actually a couple ways that I talk about, or that I think maybe you'll find helpful on your journey. Once again, I want to clarify, like, everyone's journey, especially, I'm not a psychologist, right? So everyone's journey is going to be unique when it comes to this, but I like to share some things that at least help with me. Start thinking on a longer time horizon, right? The markets were here before you, and they're going to be here after you. They aren't going anywhere. Promise. The move today that you missed can be caught tomorrow. The move today you missed can be caught next week. Just like there was a move last week, there's going to be a move this week. So just don't let FOMO make you risk capital or your money that you weren't going to risk to begin with. You know what I'm saying? So that's the biggest thing. Like, just remember that the markets aren't going anywhere. There are so many times where I miss a move and I'm like, man, I wish I took this. I don't want to chase it now because my entry is going to be bad. I'm going to be risking too much. If I take a loss here, I'm going to leave it alone. And overall, on a longer time horizon, on a long enough time horizon, I'm always profitable as long as I can avoid this one mistake, and it's having FOMO. Next thing, I'm going to talk about growing and flipping accounts. All right, let's get right into growing and flipping accounts. Let's just dive right into this. Flipping accounts. This is something what most people try to do, tend to do. Most people get into trading, right? Because you want to make money online. So people think that the overnight success is, I won't say it's unrealistic, but I would say it's the least probable. So what does flipping an account actually mean? You're going to start with a small account, $1,000, $100, $500, $2,000, whatever it is. Small is relative to the individual. But you're going to expect to turn it into a huge amount. And now that's fine. In and of itself, I don't see any issues with starting with a small account. I didn't circle that well, huh? Starting with a small account and expecting it to turn into a huge amount. This is where the problem comes in a short period of time. Remember what I was saying in the last video? the last lesson talking about thinking about avoiding FOMO by looking at a longer time horizon. Because when you're looking at flipping an account, it's going to make you over leverage. Remember, we talked about leverage and taking higher leverage risk. You're going to be risking too much per trade. You're going to be taking risky trades and you're going to blow accounts. When you blow an account, it means you blew the account. You have no more money left in the account where you can take any trades. And you got to deposit back into it, whatever the case. So this, in my opinion, it's just not the way to do it. I'm not going to say you can't do it. Typically, in my experience, the people or the times that you see, like how I took a $500 account to 50,000 in 2 weeks, is going to be like clickbait, right? You know, it's just, this is a career for me. I'm working into turning my accounts into the billions, into the hundreds and hundreds of millions, and it will take time, but I'm willing to do that, right? So I like growing an account, and I'll talk about the difference or what I believe growing an account should actually be. Now we're going to start with the same thing. You can start with a small amount. You can expect to turn it to a huge amount. I see no issues with this at all. That should be the goal. You should be looking to get a huge, ridiculously large account and keep growing it, because relatively speaking, 1% on a $10,000 account versus 1% on a $100 million account, very different numbers, right? You can live off of a much bigger an account much easier. This is the difference. A longer period of time. This is going to help you with patience. It's going to help you with your consistency as well as your psychology. In my experience, your psychology around holding trades and taking losses will be better. If you're looking to flip an account and you're over leveraging, that means when you take a loss, you're going to blow 50, 60, 70% of your account because you risked so much. It puts you in a really bad spot mentally. In my opinion, it's not worth it. Once again, that's just my opinion. And how would you grow an account? So here's what I would say. Start with any amount. Doesn't matter if it's $1,000. Doesn't matter if it's $20,000. It can be anything which way or the other, right? So for this example, I mean, actually, when I have one-on-ones, people that I work with personally, I have some guys who have $15,000 accounts that they start with. I have some people who have $2,000, $3,000 accounts. And I know people who start with a 50 to 100. Typically, those people can't, I'm not working one-on-one with them because they can't afford the one-on-ones, but they're going to be starting with 1,000, and that's fine. What they're going to do, what you want to do is start trading with the $1,000 and just start trading. You're only risking $20 to $30 per trade, right? 2 to 3%, give or take, is a general rule of thumb. Now, this is just a guideline, right? Some might be $10 risk, some might be $40 risk, right? But you don't want to be risking anything. I wouldn't be risking $100, $150 on a $1,000 account, right? So recap. We're starting with $1,000. Once again, use any number you want. This is just an example. You're going to start trading. You're only going to risk $20 to $30 per trade. Then I want to create a consistent deposit schedule. So if you're still working full time, just go with your paycheck. Whenever you get paid, put $200 every 2 weeks. Put $100 every week. Put $300 every month. You know, whatever it is. I want to treat this account like an investment account. I promise. This sounds weird, but it is going to help your psychology so much. It's like, I know so many people who like, they'll put in $2,000 and like, I'm just going to see what I can do with it. And it's like, yeah, but if you took a $2,000 account and you were trading it, and yeah, hopefully you're still profitable, right? If you're still learning, like, it is what it is, but let's say you're still profitable, you're still going. After 6 months, these accounts will be $30,000 to $50,000. I don't want to say guaranteed, but like, there's a very high probability you can grow these accounts. Patience is all you need. That $1,000 account, if you're depositing $200 every 2 weeks and you're trading, maybe you're getting $50, $60 wins, that $1,000 account after 6 weeks will be at $5,000. And now you can raise your risk, right? Now I'm going to be looking at another 6 weeks. That $5,000 account could be at 12, could be at 15, maybe it's only at 10. It doesn't matter. The point is, like I said before, progress. Your experience will come, but it's when you start flipping or over leveraging and when you take ridiculous trades that you think it's going to blow your account up is when you really end up taking some ridiculous losses. So this is something to really be careful for. You know yourself better than I do. I can just tell you, I would really, really prefer to see people grow their account versus just trying to flip it, go buy something crazy and then go flip accounts. That's no way to live. Like, gain the skill and use the skill to really grow something big. Once again, that's just my opinion. That's my perspective on it. You may have a completely different outlook. In that case, over leverage your ass off and just keep taking risky trades. And hopefully you don't blow all your accounts doing that. Not something I would do. Next thing I want to talk about is understanding patience. So let's get right into that. All right, 4.4, understanding patience. There's going to be a little similarity here to avoiding FOMO. So when we're talking about patience, like I said, similar practices, right? When you have FOMO, it's because you don't understand a few things. And one of the things that like I always want to remind myself where anyone is understanding that opportunities are always going to be there. Like it's just like what I said with the FOMO. The markets were here before you, they're going to be here after you. More opportunities will always come. So when you learn how to identify those opportunities, uh, you can, when you learn how to identify when those opportunities come, sorry, I stuttered on that one. When you learn how to identify when those opportunities come, you can make yourself available for them, right? So that's what we're going to be talking about when it comes to all of this analysis that we're doing. We're basically just trying to follow the markets. And all we want to do is go for a ride, whether we're going for a ride to the upside or to the downside, right? So patience is a big deal because there are going to be days where sometimes you sit on the charts for 2 or 3 hours and you really don't take anything. Or if you do force something, you end up taking a loss. And then you try making up the loss by revenge trading and doing all this stupid stuff that you just shouldn't be doing. So patience is super important. Understanding that opportunities will always, always, always come. If you have a daily goal of like, I need to make $500 a day, remember, like it's an average, right? $500 a day could mean that one day you made 300, one day maybe you made 900, one day you made 1500. It's going to be an average overall. There are going to be some days where it's bigger moves, some days where you get nothing at all. So patience, it's the one of the biggest things, and like you're going to hear it all the time, but like it's something that most people forget and just don't think about when you're actually trading, because you think opportunities come every single day. It's not always the case. So next thing we'll talk about is accepting risk. So let's talk real quick on accepting risk. When it comes to accepting risk, there's a few things that we'll just kind of rant on real quick. And one of the things is when you enter a trade, you're opening yourself up to a certain amount of risk. Now, everyone knows this, or everyone understands this. Whenever you talk to someone about trading, they're like, oh, but it's risky. The thing is, you control the amount you're risking. Every single trade you take, you control what you're risking. Remember when we went over lot sizes and risk management real quick on a couple phases ago? You're going to control that depending on what lot size you take, right? So you decide how much the market has potential to take from your account, right? So one of the things that, and I'm guilty of this in the past too, is when you're entering a trade, you need to consider the loss, not just the wins. One of the things people do all the time is they'll take a trade and they're like, oh man, if I win this, I'm going to get $1,000. But they never think about maybe the $1,500 loss because their stop loss is too big, or their lot size was too big, or anything to that effect, right? So some of those things you're just going to be really aware of. So when it comes to the trades that you enter, think about the loss. I don't want to say manifest the loss, right? Because I'm a big believer in manifestation, and you attract what you like attracts like, right? So that's another thing to think about when it comes to like goal setting and the things that the actions you take every day. But understand the risk. That's the best thing that I would say, right? You're accepting risk. So if you get drawdown, or if you see a negative number in your account, like it's part of the game. Unfortunately, it is. As long as your wins are consistently bigger than your losses, you'll be fine. But losses, there are days where I take 2 losses in a day, and then the next day I come back and I end up winning it all back. And now I'm back to square one and I start building again. Like sometimes the losses are going to happen. It is what it is. You're going to hear it everywhere. Everyone says like losses are part of the game, but I'm willing to bet the same people who say that actually get pretty upset when they take losses. Most of the time it's because they're kind of just guessing in the markets, hoping to win, don't know why they lost and all that stuff. So hopefully we're going to fix all that here. You're going to understand exactly why you're taking your trades. If you do take a loss, you know exactly why you took that loss. So that's just my quick little rant on accepting risk. The last thing we're going to talk about is being teachable, which is a super, super important topic. All right, let's talk about being teachable. You're already in this course. You're already going through some of these videos, so you already have some understanding of this. So I already applaud you for that. I'm a student of life, like big time. I am always, always, always searching for new information from reputable sources, right? So life is a journey. It's a journey full of lessons. It's a journey of learning from all of those lessons, right? So like I just said, I'm always open to learning more. I always want to keep finding more information, because this is one thing I always like saying, like the person who comes to me and they're like, I already know everything. The person who knows everything will never learn anything, right? If you believe you're the person that has nothing new to learn, if you believe you're the person that already knows everything, you're never going to progress. You're never going to get better, right? And that's, You can go find the most wealthy people you know, whoever it is that you look up to. I'm willing to promise you, and I will bet anything that they are a constant student of life. Some of the wealthiest people I know are always trying to find that next level, right? Now, that goes with being said, if you're always looking to learn, it does not mean you're accepting all new information as fact, right? Just because I want to learn all the time doesn't mean I'm going to listen and believe every single thing I hear that's new information, right? I question everything and I'm always curious. So those are the two things that I'm always like, you ever heard, what's the statement? It is trust but verify, right? I trust it, but I'm going to verify the information, something sort of like that effect. So I'm not taking all new information and be like, yeah, that's a fact. I'm going to live my life based off of whatever new perspective I just gained. Like, try to validate some of the stuff. Make sure the person you're learning from is at least reputable. And yeah, basically, don't be ignorant and don't be gullible. That's really the only things. Like, you're already in this course, you're going through this, you're learning, you're trying to get better. Like, if you're going to go through this information, like, you're going to get some really awesome information. So I really applaud you for even going this far, getting into this course. We're just getting started. This is the halfway point. So with that being said, we're going to start getting into some juicy stuff. Let's get into the trading plans for phase 5. All right, trading plans. So this is just a quick introduction to trading plans, what the purpose is and the benefit of them and why I love having them. So the best thing about becoming a profitable trader, if you were to think about this for a minute, what's the best thing about being a profitable trader? Why did you get into trading, right? Probably money, but freedom, right? You get the freedom to do whatever you want. I don't commute to work. I don't commute to an office. I am sitting in an office right now inside my condo in Miami. I didn't drive here. I woke up and I walked to the room, you know? So what about the worst thing about becoming a profitable trader? Because there's pros and cons with everything, right? The worst thing about becoming a profitable trader is the exact same thing, freedom. The problem with this is there is no rules. We don't have any guidelines. There's no one telling us when to stop trading. There's no one telling us when to stop being greedy. There's no one telling us when we should or shouldn't trade. We have to create our own plan, our own rules, our own guidelines, right? So I like to call them guidelines more than rules because everything shifts, everything changes. I like to be versatile with the market. So it does depend on some things. So guidelines. So a trading plan is your 10 commandments, right? It doesn't have to be 10 things, but these are your 10 commandments. These are the things that you're going to follow. This is how I trade. This is how many losses I take, all of that stuff. Once again, consider your guidelines to trading. I said this earlier, and I still stand by this. I get ahead of the PowerPoint sometimes because I go on my rants. But yeah, it's your guidelines. These are guidelines to your trading career. It can be fluid as you go. Once again, I've already said this, but there are fundamental basics you should be sticking to if you want to be consistent for the long run. So I'll give you an example. We're going to go through how to create one. But for me, I never take more than 2 losses in a day. If I take 2 losses, I'm done trading. And that way the markets will never take more money than I allow it to take, right? That's one of my rules. So we'll get into like questions you should be asking to yourself, but I want to be consistent and profitable for the long run. This is a lifelong thing for me. I need to create those rules and I need to stick with them. So what are some of the things in the plan? And what our next section, we're going to go over specific questions, but let's just talk about some things that you would have in the plan, your long, short-term goals, profit goals, risk management goals, like how much do I lose? How much am I risking per trade? Your daily wins, daily loss limits, which is what I just told you, etc. So with that being said, let's get right into actual specific questions. And we even have a downloadable cheat sheet that you can use for creating your own trading plan. All right, let's create a trading plan. Let's get right into this. Let's actually create what your success is going to look like in the next 90 days, 1 year, 2 year, 5 years, right? So creating a trading plan. One of the things like I teach this in my private group in our community, Wall Street Runs, is like, I believe there's more than to being a trader than just being good at trading, right? So the 4 things that we focus on, it's not part of this course, but markets, mindset, movement, and mastermind. With that being said, markets is the charts, it's trading. Mindset is psychology, which we talked about in phase 4 a little bit. Markets, mindset, movement is fitness, health, wellness, mastermind is relationships. So 4 things: markets, mindset, movement, mastermind. That's our core 4 in Wall Street Grunts. So the reason I bring that up is because I even go over this when anyone who starts one-on-ones with me, I start with this. Who is my higher self? What I want you to do, and this is super important. Like I said this before, like is like. You will attract the vision that you put in your head. I want you to close your eyes, take some time to yourself and think about who is the person you're trying to become. man, woman, whatever, does he or she, what do they wear, right? What do they look like? Are they fit? Do they have tattoos? What kind of shoes do they wear? What kind of pants do they wear, right? Give them the elevator look. I want you to look up and down on this person. I want you to think about what they drive. Who is in their life? What kind of friends do they have? Everything. I might have more questions like this. Once again, I might be getting ahead of myself here, but yeah, that's what I mean when I say like, who is my higher self? It's super important because it's gonna help you. Like, give you an example. As of the recording of this very video, I do not have any type of like company where I am managing other people's money, but I'm going to. It's a plan for me. I will be opening like some type of a hedge fund. When I'm trading, if it's like a holiday or if it's a time when I shouldn't be trading, I always think about like, man, if it's my own money, I'll risk it. I'll do something, whatever. But I think about like, what if I'm running a hedge fund? What if I'm like dealing with other people's money and I'm managing other people's money? Would I be doing this right now? The answer is almost always no. So I always think about my higher self and I'm like, what am I trying to work to become? And what would that person be doing right now? So super important, very important question to answer. And like I said, I might have gotten ahead of myself in some of these. What does he or she do daily? Do they work out all the time? What do they eat? What don't they eat? And what do they avoid doing, right? Are they avoiding drama and gossip and all of that remember when bullshit? Are they not going to the club, right? What do they avoid doing? Seriously, like take some time to think about this. Who is my higher self? What do they look like? What do they wear? What's their daily life like? What do they do every day? Are they working out every day? Are they fit? What do they avoid doing? If someone comes up to them and starts trying to talk all drama or some negative stuff, whatever it is, are you getting into it with them? Or are you saying, you know what? Hey, I don't have time for this. Like, have a good day. I'm out, you know? So think about that stuff. What are my long-term goals? 5 to 10 years. This kind of goes into the higher self too. And then what are my short-term goals? What do I want in 6 months to 2 years? Because when you're creating goals, I do it in 90-day maps. So I'll start 90 days out, but I have my 5-year goal too, right? I just told you I want to manage other people's money. I'm going to open hedge funds, do all this crazy stuff, get into the bees, become a billionaire. But the short-term goals need to be there because you need to break these huge goals into smaller goals, right? 90-day goals, 60-day goals, 30-day goals, and then daily tasks, and then hourly tasks. You know, me recording this video right now, I've time blocked a week just to record videos. No one's around me. My phone's on silent. I'm here with you right now, right? This is an example of one of my short-term goals to finish this course, right? So that's one of the things that you're watching me do in real time. So creating your higher self. This is actually going to go into creating a plan. I have these backwards, huh? This should say creating a higher self, not creating a plan. And down here should say creating a plan. So I got those backwards. You caught me. What is my starting account size? Once again, you guys are going to have a cheat sheets, like little downloadable cheat sheets with some lines you can fill in, have these questions. If you want to create your own, that's fine too. But there's going to be a downloadable cheat sheet here where you can just print out, fill in on a computer, whatever it is. I refer to my goals and my guidelines all the time. What is my starting account size? Am I starting with $1,000? Starting with 5,000, 2,500? If you're already trading, then just write down whatever it is that you have right now and create that plan to start growing it. Will I follow a monthly or bi-weekly deposit schedule? This, I believe I talked about this in the psychology section about flipping versus growing accounts. This is something I highly recommend to people. I can't recommend this enough because instead of, if you start with, let's say $2,000, let's say $1,000 to keep it even in like lower number, right? $1,000 you deposit into your account. If you lose $100, but you're putting in 200 every 2 weeks, it's not that big of a deal. And some people have an ego about it because they think, oh, if I'm a good trader, I should be able to flip an account. Yes, sure, whatever. But you should be able to agree with the fact that trading is very difficult on your psychology. Every time you take a lot, I know at least for me, what I used to do is when I would open my MetaTrader, I still do it. I'll check my history and I'm like, man, did I take a bad trade last week? Did I do this? Did I do that? And now I'm like, fuck, I got to make all this stuff up. You need to have your mind in a clear, in a higher vibration, right? You want to be vibrating at a higher level. You want to be working at a higher frequency. In order to do that, you have to clear yourself of any negativity. In order to help, I'm not going to say this as a guarantee, but in order to help clear yourself of any negativity is to at least know that you're treating your trading account as an investment account. I'm going to grow this to $100 million, even if I'm only depositing $200 every 2 weeks. It doesn't matter. I'm going to get there because eventually, here's the thing. Eventually, you're going to get to the point where those $200 deposits are not impacting the account anymore. If you start with like 1,000, if you start with like 2,000, yeah, $200 is going to help. It's going to be what on a $2,000 account is 10% of the account, right? So if you put in another $200, you just increase the account by 10%. So if you keep doing that, it's a big deal. But if you're at like $60,000, $70,000, $200 isn't going to do all that much, right? That's less than a trade. So my point is start doing this because it's really going to help your psychology. Now, you don't have to. I highly recommend it. I just gave you all my reasons why. What is my monthly profit goal? This goes into everything else we're talking about, right? Like how much do I need to make a month, right? So when it comes to this, is got like growing and scaling accounts is an entirely another course in and of itself. But growing accounts is all you need to do is pick the goal, find out how much you need to make per month, or what your daily profit goal is, and then just break it down. Just like you would break out your weekly, your daily goals, and then see how much it is that you need to make in order to hit that every month. When will I trade? What days, what sessions will I trade? It's supposed to be a little apostrophe here, a parentheses. You caught me again. I get typos. I'm not perfect. So when will I trade? What days and what sessions? Am I only going to trade Tuesday, Wednesday, Thursday, London session? Am I only going to trade Monday to Friday? For me, I trade every session. Whenever the opportunity is there, I'm available. That doesn't mean I take trades, but I am always on the charts waiting for that opportunity. Asian, London, and New York session. Mainly London and New York. And Asian session is actually, I'm on the charts, but mainly I do like market update calls with my private group. What pairs am I going to trade? And include your lot size, right? If I'm going to be trading GBP, JPY, and I'm only going to be doing a 0.5 lot, I better not be taking 1.5s, 2.0 lots. And then I come back and look at my trading plan. And I'm like, man, I lost so much, but I broke my plan. I wasn't supposed to be doing this because what people do, like I think I said this on the psychology side, like people focus on the amount they're going to win. They never focus on the loss. So they'll end up increasing their lot sizes, maybe to make up a loss, previous loss or something. And they don't realize like you can lose this trade too. So always include your lot size and stick to it. If you were to ask me when you should start increasing your lot sizes, I like to create milestones in my accounts. So once again, let's say you start at $1,000. I'm going to be trading like a 0.2, 0.3s, something like that. And then I'm not raising that lot size until I get to $3,000. Then I'll go to like a 0.5, 0.6. Then I'll wait until I get to 5, then 7,500, then 10,000. Then I'll keep raising my account as I get my lot size as I get higher in the account. I'm not going to do it because I've been trading for so long, because I'm confident, because my confidence has nothing to do with the fact that I can still take a loss, right? Losses will still happen. So I don't raise my lot sizes until I get to a certain, like I said, a certain milestone in my account. How much will I risk per trade? Completely going to depend on you and the account size. So typically, from a percentage perspective, people like to do anywhere from 1%, 2%, or 3% of your entire account size. That means you're risking $10 on a $1,000 account, right? That means you're risking $20, right? $20 on a $2,000 account. That'd be 1%. $40 would be 2%. So that's typically how people do it. I think it's a safe way to do it. As you gain experience, maybe you can take riskier trades depending on what's going on, but it is a good rule of thumb. And you're going to hear a lot of people say that. I think it's kind of like the industry standard. So that's trading plans. You have the cheat sheet, you have the downloadable. We're going to get into the nitty gritty. Phases 6, 7, 8, and 9. I want you to really, really, really just be with me on this, because now we're going to get out of theory. We're going to get into reading charts. We're going to get into fundamentals. We're going to get into central banks. We're going to get into how the markets are connected. We're going to really start to geek out a little bit, right? So I'm going to do my best to simplify the most of this stuff, but let's get into this. Let's do it. I've hyped you up enough. Let's go. All right, let's get right into technical analysis. This is the beginning of phase 6. We're going to get right into some nitty gritty stuff here and get real tactical. So what is technical analysis? Really, the textbook definition is going to say something like this. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. That's really great if you go to Investopedia or if you go to Google and you Google what is technical analysis. But let's talk about plain English. Technical analysis is just reading charts. All you're doing is reading charts. If this little guy here Mr. Trader Joe Schmo over here says, hey, I only trade technicals. That means they exit their trades literally just based off of looking at a chart. And that's it. In my opinion, it's not a way to be profitable. Some people do it. It's not for me, but you're going to learn technicals do matter. This is the first part of your foundation, right? So this is what a chart looks like. You can see we're going to go over why I have this circled here. This is what I would call a support area, but this is given, we're going to break down what this big candle means, what these little lines mean. We're going to break down why there's a square here, what it looks like when it goes higher, when it goes lower. Like I'm going to break all of this down. It's going to make so much more sense. But right now, this is what a chart looks like, right? You can see here at the top left, it says British pound, Japanese yen. If you guys remember, this is GBP, JPY, also known as GJ. That's all this is, okay? So the theory behind technicals states that past price points can help predict higher probabilities for future areas. All that means is that if, let's say this is, let's put a little, you're gonna learn what support and resistance is if you don't already know. Let's say this is an area, right? Now, if the markets, the structure, all those candles you just saw, which once again, I'm going to break all that stuff down, all those little lines you just saw. Now, if the markets go up to a certain area and let's say it rejects it, the theory behind technical states, it's more likely, the higher probability, like this is future area, that if it hits that area again, it's very likely that I'm going to see the markets do it again. Unless if something happens where I have a reason for it to break higher, and then that's where I'm going to be looking to enter at my position because it broke higher above that area. So that's going to be what I call an area of interest. Also known as support and resistance. We're going to break all of that down. But the theory behind technicals basically states it's because something happened in the past, there's a high probability it's going to happen in the future. That's really all it is. This helps us identify, I already mentioned this, areas of interest, reversal points, reaction areas, breakout areas, right? And I already showed you like a couple examples of that. If I had this area right here, we can see a reversal. It's going to be my area of interest, right? Or I can see a reaction, maybe it just holds, and then I can see a breakout, right? So that's what I'm going to be looking for, that this is my area of interest, right? And I'm going to show you how to identify all of that. If price reached here in the past, it has a higher probability of doing it in the future. Once again, I get ahead of the PowerPoint sometimes, but you still understand. Now, the purpose behind technicals, I'm going to make sure I don't talk too fast on this. I don't want to lose anybody here, but the purpose behind technicals, you're looking for your entries, you're looking for exit, you're looking to exit your positions, your take profit areas, which is where you're going to close, right? Or your stop loss areas. So entries, exits, take profit, stop loss. That's what the purpose behind technicals really is. Now, the next thing we're going to talk about is we're going to break down all these little things you see here, the candlesticks, all these red and blue things, candlestick anatomy. We're going to break down what all those candles mean and how we can learn to read them. All right, let's get right into candlestick anatomy. I want to start this off with talking about a little bit of history of candlesticks, where they come from, just because, honestly, I think it's a pretty interesting story, but it'll only be like the first two slides, don't worry. I think this is important. The Japanese began using technical analysis to trade rice in the 17th century. For those who don't know the 17th century, that means the 1700s. The concept of candlestick charting was created by, I might butcher his name, Munehisa Hama, a Japanese rice trader. At the time, rice was a commodity more relevant than physical cash and was traded before gold or silver. So obviously rice, extremely important. This is actually, you know how you have, if you don't know this, you have like the New York Stock Exchange. I talked about that in the phase one. This is a Dojima rice exchange. So this is just a painting because they didn't have cameras then, 1797 to 1858 when this exchange was around in Japan when they were trading rice. Pretty interesting. So Mr. Hama began tracking the price of rice at the start of the day and the price of rice at the end of the day. So it would look something like this. You have, let's say, now obviously we weren't using US dollars, but let's say for sake of the example, we'll say price opened, the day started and rice was at $2 for the day, $2 per pound, whatever they use for a unit of measurement. Let's say it was $2 per pound, and now price closes at $5 per pound on the day, right? So now I have this, what we're going to call a candlestick. We have the low, we have the open, we have the close, right? Price open, price close. Those two things are going to be important as we move forward. Now, over time, he began to recognize patterns because he had charts. Basically, what he was doing is, I'll show you, actually, I have a visual here. He was able to determine shifts in prices before they happened. So let's say here, once again, let's say we had the open here. close here, $2 to $3. And then we open the next day, let's say Tuesday now, we open at 2, we close at $4. And then at $4, it drops drastically, drops to $4 back to $2 on Wednesday. But let's say he notices every time we hit $2, we end up climbing. And then this time we had enough to break the $4, right? So that tells me, hey, $2, pretty good time. Probably I want to get into buying rice. It's a good price. $4, maybe I'm going to see, if I see a continuation or I keep seeing rejections around this time, he's going to notice patterns. Now, this would call daily candles, right? This is the candle for the open of the day, the close of the day. We're going to talk about time frames, right? Because this is what we use now, but we use it digitally. We use technology to actually look at these candles, and we can go down to the seconds, the 1 minute time frame, the 5 minute, the 30-second, the hourly, that we can still do daily candles. So this is a daily candle, right? Makes sense? He was able to identify patterns, and he was one of the first people to do this. Mr. Hama gained samurai status as the result of this. Basically, overall, his intelligence, high level of respect. This was one of the biggest things when he recognized this. As far as it coming to the US, the Japanese actually kept the candlestick charts a secret until the modernization of banks and computers came in the 1980s. Basically, they didn't have a choice, right? Because there was a cross-pollination of financial institutions. What we now look at as Forex, they couldn't really hide what they were doing once we started cross-pollinate all the institutions and we became a global industry, right? Technology made it available to everybody. But you look back at this, like, this is 200 years. The Japanese were doing this before the US even realized what was going on. So why are they important? They're a visual representation of what's going on. Like I just showed you before, Mr. Hama was able to identify at $2 for rice. There's maybe a reason to get into buying it. Like, that's the low. It's probably not going to keep dropping. I've seen it reject this $2 mark so many times. I'm going to start buying rice now, something like that. So we do the same thing when we're looking at charts. They're a visual representation of what's going on. They can be used in combination with indicators, moving averages, support and resistance. I'm going to show you all of this. Honestly, the main thing I really use is support and resistance. But we will talk about indicators, which is moving averages is an indicator. So they all kind of fall together. But support and resistance is the main thing that you're going to see that I like to use. When you understand candlesticks, they're going to help you identify changing factors in the market and seeing how buyers and sellers interact with each other. This is kind of like sometimes I don't know why I type some things out and put them here, because this is kind of like a mumbo jumbo textbook example. Basically, you're going to be able to see what's going on. Like, just to make it real, you're going to be able to see what's going on in the markets. You're going to be able to react accordingly, right? This is how the markets moves. I say this all the time. Whenever, like, if you have any understanding of fundamentals yet, I always tell people fundamentals is why the market moves. Technicals, which is what we're talking about now, this is how the market moves. You actually visually see it. You don't really visually see fundamentals, but that's what's going on behind the scenes. That's why the market moves. And technicals, once again, is how. This is what a candlestick looks like. So I know before I showed you, it only had this little rectangle here, but you're going to have these little sticks. They're mainly called wicks, but the real name is called shadows. Then you have the body, and then once again, shadows. You're going to hear the majority of people call them wicks. We have candles, we have wicks. Candlestick, wick. Really, we're not going to call it the body. I mean, I do call them candlestick bodies, but for the most part, these are wicks. I don't really refer to them as shadows, but if you ever hear someone call them shadows, that's what they're referring to. Now, the main uses, they're going to help us identify chart patterns, which we're going to go over a little later. Buyers or sellers strength, which we're going to cover in this PowerPoint here. Volume and momentum, which we'll touch on as well. So those are the things that we're mainly going to be using these candlesticks for. You have two types of candles. You have bullish and you have bearish candles. We have a high point and a low point. These are the wicks, right? So what happens is, let's go back to this real quick. When a candle opens, let's say this candle is remember the $2 to $5 one? So let's say that happens. We open at $2. But let's say throughout the day, let's say rice goes down to $1.50, right? So the candle goes like this, and then it starts climbing throughout the day, right? Because price isn't just going to go to $5 and that's it. But let's say we start at $2. Let's say it goes down to $1.50 for the day, and then it starts to go higher. Let's say it hits like $7 for its peak, and then at the end of the day, it goes to $5, right? So what happens is we opened at 2, we closed at 5, right? But for the daily low, we hit $1.50. For the daily high, we hit $7. Do you understand? So that's what creates these wicks. The candle body is the actual closure. The wick is what price reached, but didn't close and ended up coming back down. Understood? So that's what you're going to see when you see these wicks here, the high point and the low point. Now, the biggest difference between the bullish candle and the bearish candle is that the bullish candle closes above the open. What that means is when the candle opens, the close is higher than the open. Makes sense? Just like the $2 to the $5. Now, when you talk about a bearish candle, it means it closed below the open. So say we opened at $2, but we closed at $1. We closed at 50 cents. Now you're going to have a bearish candle. One big thing to note when it comes to bullish and bearish candles is that the color of the candlesticks do not matter. You can change candlestick colors left and right. You can do, I'll open my charts real quick to just show you. Mine are black and like a dark gray, or blue, grayish, whatever, white and gray, whatever color you want to call this. This is what my candles look like. So the colors aren't that big of a deal. You do whatever you like to see, whatever you like to do. Some people stick with the green and red. I used to do blue and red, which I don't know. It's on here, right? If you look at one of my older charts. Oh, nope, it's not this one. It's 6.1. So the last one, you saw the picture of a chart, right? Blue and red is what I used to do. So that's the biggest difference is the highs and the lows, where it opens and where it closes for bullish and bearish candles. This, once again, here we go. So here's a chart. This is, you can see here, let's look at this candle, right? It opened down here and it closed. And now the next candle, look at that. It opens here, it pushed down, came back up, pushed over, and then closed here. But it also, you can see a little wick at the top, right? So it came down, closed that. Next one here, you can see they all line up, right? If I was to look at like when this is a bearish candle, the dark ones, it closed here, opens here, close here. The next candle opens here, close there, opens there. Understand? Like this one closed all the way up here. This one opened here, but you can see it's a bearish candle, which means it closed down here. Makes sense? And you can see in the back, this is the 10-minute time frame. So that's what that 10 is in the back. This is GBP, JPY still. And then let's talk about body sizes. This is when I'm talking about buyers and sellers strength, right? So if you have a long body, it typically signals strong buyer's pressure. Same thing with short would signal seller's pressure. So we have short bodies, long bodies. So you can also call this going long or going short, but we don't need to get into that too much. But typically, I like to look at candle body sizes. It's very important. This is when I'm looking at entries, and I'll show you that when we get into like finding entries later in the session. But long bodies are telling me buyers are in power, or long bearish candles are telling me sellers are in pressure. Does that make sense? Like I can see if I go back to the chart here, this is the same chart, but different. Now we're going to look at it a little differently. Instead of focusing on the bearish and bullish candles, I can see if I look at this overall, look at how much stronger the bullish candles are overall. And then you get this kind of corrective pullback, right? So I'm looking at more buyer strength here overall. Couple pullbacks here, one or two bearish candles, still takes off to the upside, right? So I can see buyer strength is taking over, even though we're getting little pullbacks on the seller side, right? And then one more thing to talk about is going to be these long wicks. When you see something like this, now typically I do like to focus more on candle body sizes. This tells me more than anything, but it's still important to look at wicks too. It's possible signs of rejection. So what that means is, if we take a look at this chart one more time, look at this long, like if I'm in, let's say I'm in buys somewhere here. Let's say I entered buys here. I'm taking it higher. I keep going. I get this candle, but I see this. I'm like, that's a really big rejection wick. It flipped bearish, and I think it's going to pull back. So am I okay with holding it and it pulling back? I don't know how deep that pullback is going to be. You can see it did pull back and then continued up, and then look again. Another weak body candle. It doesn't matter if it's bearish or bullish. Get that weak candle, you get another pullback, right? So that's not always guaranteed. You got it again here, that wick, and then we get a pullback. So, but you can see here, it didn't really do that. You got the wick, and it really just consolidated, still continued higher, right? It didn't actually pull back that aggressively. So those are important to pay attention to when you're looking at these candles. But overall, you still need to remember the bigger picture when we're looking at technical analysis. The next thing we want to talk about is market structure and how we can identify different types of trends. All right, 6.3, market structure. Let's get right into this. Understanding market structure. So this is super important, and it's a critical component to understand because this will allow you to use the right price action strategies in the right market conditions. So when we're talking about like the candles, remember we were talking about like strong candles, weaker candles, some of those little wicks that we got here, right? The rejection candles, those matter most if we understand where we are in the markets and the market conditions. So it's going to tell us basically this right here. It allows us to use the right price action strategies. So technicals is, if you're talking about price action, it's technicals. It's the same thing. The moves that price is making is the technical analysis. So when you master this, you're going to be able to answer a couple of questions. You'll know what the markets are doing. You're going to know who's in control, the buyers or the sellers, and you're going to know when the right time is to place the right time and place to enter or exit the markets. And also, one of the biggest things is when you should stay away. That is one of the biggest things most people struggle with, is that people think that they need to take a trade every single day, or they always need to catch something, or the market's always going to give me something. It's like, that's not really the case. So understanding when to stay away from the markets is extremely important. We have three types of market structure that we're going to cover: trending, consolidation and raging, and choppy. So when we're talking about trending, there are two different types of trends, right? We have bullish trends, which is basically just pushing up in a repeating pattern of higher highs and higher lows. Now, this is what you want to remember: higher highs, higher lows, bullish trend, right? And I'm going to show you some visuals on this. We're just going over the names, right? The terminology. Pushing up in a repeating pattern, right? It's a trend, so it's a repeating pattern. Now, when we have the second type, it's going to be bearish, right? So we have bullish, we have bearish. Just like we have bullish and bearish candles, we have bullish and bearish trends. This is going to be pushing down in a repeating pattern of lower lows and lower highs, right? So bullish, higher highs, higher lows; bearish, lower lows, lower highs. Now, what does that actually look like? This is a bullish trend, right? So if we remember, it was higher highs and higher lows. So we're going to start with a low here, and now we have a high, right? So that's going to start the trend. Now we have a higher low, a higher high. Now we're trending, right? We have higher highs, higher lows. We get our pullback, our impulse, and then we have our pullback. Here's another higher low, and then we break that and we have a higher high, right? So that's going to be our series of higher highs and higher lows. This is what that looks like on a chart. You have your low, your high, your higher low. Here's your higher high here. You have a little bit of a wick here. This is kind of consolidation here, but you got your higher low with that wick. And then you have a higher high printed up here. And that's pretty much it, right? So you got, it's not going to look as clean, right, when you have this, but it is what it is. You can't force the markets to look the way that you want them to look. These are what higher highs and higher lows will look like. Now, a bearish trend is the exact opposite. We have lower lows and lower highs. So we'll start with the high now, and we're going to come down and create a low. Right? And now we have a pullback, which gives us a lower high, and then a breakout to the downside, lower low, lower high, lower low, right? So the same thing, opposite, that's all. What does that look like on a bearish trend, right? Remember, lower lows and lower highs. So we have the high, we have the low. Now we have a lower high, a lower low, lower high, right there, lower low, lower high, lower low. Now, one thing I want to show here, which we're going to get a little deeper into, is look at the transition here. Let me get rid of some of these words. If I were to draw this out, right, you got your low, your lower high, your lower low, your lower high, right? If we were to do that, right, and you have your downtrend right there, look at the difference or the change in price action, meaning like the seller's strength. Look at the size of the candles. Look at the strength of the buyer's candles that come in, and look how the weaker bearish candles come in, right? Look at the shift. And now the strength comes in. Do you notice anything else? Now, I haven't gotten into shifts of structure yet, but look at what happens if I draw this. Now we start creating lower lows and lower highs, and we've broken that structure, right? So you see it both in structure. When we start breaking this, you also see it in price action, buyers and seller strength. This is why identifying the shapes, not the shapes, but the sizes of the candles are important when you hit those support areas or whatever. And I haven't gone over support resistance yet, but basically, there's your bearish trend. You even have a shift of structure here. The shift of structure is kind of like some extra sauce because that wasn't meant for this one, but you can see it happen right there. These are higher highs. I mean, your lower lows, lower highs. Here we go, shift of trend. So here's another chart here, kind of showing the same thing. If we see where we're coming into, we're coming in a high here, right? We break higher again. And then we break that support area that I have marked off here. We pull back a little, and you see the shift in seller strength come, right? So you can see it right here where you break below. You get your little corrective pullback. You can see really weak bullish candles. really strong bearish candles, right? So what I'm going to be looking to get in, once again, these are my areas of interest, right? You look at how many times price reacted here. Look how many times price reacted here again, right? It's holding this area, right? I haven't gone over support and resistance yet, but this will make a lot more sense if you don't know what that is as we get a little deeper into this. So how do you trade trending markets? The first thing you want to do is identify the trend. The next thing you want to do is trade with the trend. So if you're looking at this, I'm looking at a shift of structure here. I'm not looking for buys until I come back and actually come back up. Really, this area, I'm still looking to take this lower, right? Still looking to take this lower. It's not until I break higher here. Now I'm like, okay, maybe we're about to shift out. I'll start shifting my bias. So the first thing you want to do is identify the trend. Second thing, I want to trade with the trend. Once again, this is just technicals. We still have to apply fundamentals, intermarket analysis, sentiment, all this stuff to it. This is just looking for the actual entry on the technical side. When is the right time to enter a trending market? You need to understand two types of price action moves. I kind of touched on this a few times already, but basically you have two types. You have impulsive and you have corrective, right? So basically the goal is to enter after the corrective move and before the impulsive move. Let's see if I have a chart here. Here we go. Perfect. I kind of already touched on this. So you have your higher highs and higher lows, right? And you can see this. Oh, here we go. You can see the strength in the bearish candles. And then you end up not breaking this area here. I'm looking to get into sells here, right? If I were to draw this line straight across again, we break this area. A little bit of a corrective pullback. We got all those wicks. Remember the wick rejection areas? That I don't typically look at those for entries, but now I see the strong bearish candle. Now I'm taking that down, right? So I'm trading with the trend. I'm looking at price action. I'm looking at the support and resistance areas, which once again, don't worry too much about that because I haven't actually gone over support and resistance yet. And yeah, that's pretty much it. So we talked about trending. You have your bullish and your bearish trends, right? Consolidation. Can any of you think like what do you think would happen for consolidation? Like just think about it for a minute. Consolidation and ranging might make sense to some of you, really. It just means the markets are moving sideways. That's it. You're not creating any new highs. We're not creating any new lows. We're holding a consistent support and resistance level. I probably shouldn't be saying support and resistance so much because I haven't covered support and resistance yet, but basically it's like the high and the low. So we're going to talk about that in the next section. But this is it. We're ranging. We're going sideways. We're not really moving. We're not doing that much. And that's pretty much it. We're just bouncing. So if you were to trade this, let's see if I have it in the next slide, you're high, you're low, and that's what it looks like in the charts. How to trade a range. Here we go. Yeah. So if you're going to trade this, typically the two things that one of the main things I want is I want the range to be big enough that I can actually get in and have a good entry somewhere down here. If the range is tight, like let's say you're looking at a smaller range. Let's say you're looking at like this, right? I can't really see a good entry anywhere, like maybe that to take it up, right? But this, I wouldn't be comfortable entering sells here after this candle closes because it's so close to the zone that it can just reject and come back up, right? So that, remember we talked about risk to reward, you're looking at a higher stop loss than you are a reward, right? Your win is going to be that small, your loss is going to be that big. So I don't like doing that. I want the range to be big enough, and I'm only going to enter at the high or at the low. Or if I see a breakout, right? That's the only time I'm looking to enter. I'm never entering in the middle of a range. It's just one of my rules. Some people might like to do it. I never enter within a range. Next thing is choppy. Now, choppy, just to be straight up, I don't trade this. I don't. Typically, when the markets are choppy, it's when the markets are indecisive. You end up getting like some really strong candles, like what looks like a good entry. Maybe if you hit the support area, it's going to go up and then it just comes right back down. Sometimes it'll hit this, it'll go down, and then it'll come right back up. So it's choppy markets give you crazy candles. You get strong bullish candles here, really strong bearish candles, strong bullish candles, strong bearish. It's just bad. You want to take this. You want that, right? That breakout right there. That's what I want to take, right? I don't want to take anything inside this range. I'm going to wait for that breakout. I'm going to take that to the downside all day. Super, super simple. And the next thing I want to talk about, even though I've said the word 40 million times during this, is let's get into talking about some support and resistance and what that is. All right, support and resistance. So let's get right into this one. What is support and resistance? These are areas where buyers and sellers either exit or enter or exit, however you're reading this, exit or enter their positions. We look at these areas for our areas of interest to find our entries. I mentioned areas of interest quite a few times now. This is what we're looking for. Once again, price reversals or breakout continuations. When you think of resistance, you can think of it as the ceiling, right? It's where price is going to hit, and it's likely, not always, it's likely to reject, right? And that's resistance. Or when you think about support, you think of the floor, it's where price is likely to come down to and rebound. Or sometimes it'll break lower. Like we're going to talk about both and how we look for entries there. That's called a breakout entry, right? So, excuse me, those are the things that we look for, support and resistance. You'll also hear these called supply and demand. When you think about demand, if there's a lot of demand for something, and we're going to cover this in the supply and like commodity section, when there's a lot of demand for something, the price of it goes up, right? So that would be a demand zone would be the support area, right? The bottom. It's when it hits it, it's like, oh, it hit a demand zone, so it went higher. It hits a supply zone, it goes lower, right? So if you have a ton of supply here and all of that supply, the price of something goes down as supply of something goes up. So you have supply and demand zones, they call it too. So demand is the low, supply is the high. I don't call it that. I like support and resistance. Just in my mind, it makes more sense. They mean the same thing, though. Supply and demand, support and resistance, same thing. So how to identify support and resistance? These are just some rules that I like to do, and we're going to mark up charts together later. Support and resistance can be identified at the swing points. These are areas of interest for taking entries, and the goal is to identify the corrective move and enter before the impulsive move. Remember I was talking about trending markets? So here's an example of, you can see a few things here. For one, you can see a shift of structure, right? If I was to look here, what that is you can see how we kind of consolidate here for a bit. We break out, and now we shift, consolidated, break out, pull back, and we're holding that bullish market structure. But we were leading into it, we were actually creating lower lows and lower highs, right? And now we never broke any lower, started consolidating, and then broke higher, right? So this is a big shift of structure that we see here. But in order to identify the support and resistance, I'm looking at the candle bodies. And remember when I said before during technicals, this is still technicals. The beginning of technicals is that past price, there's a higher probability that future price will react. This is in August, right? If you look here, this is the 4-hour time frame. So you look, this is in August, all the way back. This is August 2022. This is, here we go, December. This is December 2022, January 2023, February 2023. A year later, right? You can see we reacted here. Same thing. Now, if you look at this, this is called resistance, right? It's the ceiling. It broke above the resistance, and now it's holding it as a support, but it's still reacting to the exact same area. You can see it again here, right? It's a resistance, breaks up, comes back down, has a little fake out there, and then it reacts again, fake out again, and then it finally breaks above. So price in the past will react in the future, right? But you can see those swing points there. This is the same thing, but going in a downtrend, right? You can see those shift of structure. You can see the swing points here, here, here. Basically, I put all these lines ahead of time for the support and resistance areas. You can draw the line all the way out, and there's a very good chance that down the line, price will come and hit that area again. This is what ranging markets look like. Once again, these can be tough to trade. It's not as bad as choppy. You can kind of, I would say it's subjective between ranging and choppy, but for the most part, if the range is big enough and I can get an entry somewhere down here, I'm taking it. If I can get an entry here, I'll take it. But I prefer this, right? The breakout of the resistance, and now it holds support, and then it goes higher, right? So this is a really good area to look for. If you miss this breakout, you can still get in. Remember I said opportunities always come. If you miss, like let's say you didn't get in here because it tapped this area so many times. So it's like, how do you know that the one time you get in, it's finally going to break out, right? Usually fundamentals will help with that. But if you miss this, the pullback, you can get right back in at the exact same area and take it all the way back up, right? These opportunities come. And it even did it again over here, dug a little deeper, still continued higher, right? We ended up getting a shift of structure over here, but whoops. Oh man, I hate that button. Sorry about that. I was hoping I was going to go this entire time with never pushing that button. Let's see if some of you guys catch that. Tag me in it if you did. Anyways, yeah, that's what ranging looks like. How to mark up support and resistance. Once again, just guidelines by me. I want to look at candle closures more than wicks. Candle closures mean more to me than wicks do. And I want to try to match multiple touch points. So if I go back to like this, I want to match multiple areas. You can see there's always somewhere where it touches multiple times in order to confirm it's a good support and resistance. Once again, we're going to mark up charts together in the finding entry section, 6.8. So we'll actually look at some entries and we'll mark up some charts. So let's go into time frame correlations. It'll be a really quick lesson on that one, but there's definitely a couple nuggets in there that I think is going to be super important for. Okay, time frame correlations. This is something that I see a lot of people really screw up on. So let's talk about this. What are time frames? Each candle represents a certain amount of time, right? We've talked about this before when we were talking about the history. You have the daily candles. What we get to look at through TradingView, we have 12-month, 6-month daily, 4-hour, 1 hour, 5-minute, 1 minute. You have a bunch of things. You have the 35, the 45-minute, like you have a ton, right? These are just a few examples. Looking at higher time frames, if you ever hear someone say, I'm going to zoom out, I'm zooming out of the markets, it just means you're looking at higher time frames. Same thing, if you're looking at lower time frames, it's kind of a way to zoom in, right? Sometimes you'll hear people say, which I say all the time, you're getting too zoomed into the markets. It means you're looking at lower time frames. You don't know where you are on the higher time frame. You don't know where you are on higher time frame market structure, all of that stuff. So time frames and understanding it, very important. Number one rule, regardless of the time frame you're looking at, the asset you're trading has not changed. If you're looking at gold on the hourly time frame, it's going to be the same gold as it is on the 5-minute time frame. GBP, JPY, GJ, UJ, whatever it is. It's going to be the same thing. Now, this is an example of GJ, GBP, JPY on the hourly time frame. Now, that area that I have marked where I'd be looking for the sells to break lower, it's the exact same thing on the 5-minute time frame, right? You can see the same area, same drop, and same thing here, right? It's just they look different. You see multiple candles because it's going to take what? How many 5-minute candles would it take? Like 12 5-minute candles just to make one hourly candle, right? Hopefully I did that math real quick on the top of my head. So you can use them. I love using lower time frames for better entries. You can see here on the hourly, your entry would be somewhere down here if you waited for like a candle closure here. And then on the 5-minute, my entry is going to be look how much closer I am to that yellow line at 160, right? My entry is at 159.98 versus 159.6. There's a good 25 pip different, give or take. Just doing the math on top of my head. There's almost a 30 pip difference. So you can use a lower time frame for better entries. Here's some examples. These are actually entries that we've taken during some of our live calls, 15-minute versus 3-minute. This was during the Reserve Bank of New Zealand rate decision. So we're going to go over rate decision, interest rates, and all that. So if you look on the 15-minute time frame, if you're waiting for like a 15-minute closure, you're waiting for candle closures or something to confirm that push, you're going to miss. Like, look at the support area we have marked off here. You're going to be entering way up here versus a 3-minute. My entry is here, right? I'm looking at this candle closure above these highs. And I'm going to go over entries as we get a little deeper. And then on the last section of this is going to be finding entries. But my entries are just so much better because I'm looking at lower time frames and I'm still remembering, I'm still looking at the same support and resistance. I still have the same areas marked up. I'm just getting better entries because I'm looking at candle closures in the lower time frame. That's for entries. Now, this is the same trade. And well, let's look at exits, right? This is the hourly time frame. We end up hitting this resistance area up here. And I'm like, okay, this might be an area I want to take partials or like take profit rather. And if I'm looking to get out here, but I want to see like, is it going to break higher like it did here? I want to watch price action. Now, you don't see much here, right? You just see a wick. You see this candle. If you wait for that candle to close, it's like, oh man, I closed all the way down here or all the way down here. But let's go to the lower time frame. Now look at this. If I'm looking at this right here, I can see I hit that area and look at the difference. Once again, I'm looking at price action. I'm looking at buyers and sellers strength. Look at the shift of structure right here. You get the weaker bullish candles. When we hit that area, it fails to break any higher. Strong bearish candle, strong bear. I'm getting out here, or I'm taking some profit off the table here, or maybe even here. Instead of looking at this where it's like, oh, I don't get out till all the way down here when that candle closes, right? Looking at the lower time frame is going to help you to be like, okay, it's rejecting there. I can see it in the lower time frame, shift of structure. I'm getting out, right? You could technically do it here too, if you really wanted to. So just a few different ways to look at that. So all in all, higher time frames are good. Lower time frames are good. I like the lower time frames for better entries. And we'll talk about some pros. The higher time frames I like for stronger support and resistance zones. I have a full cheat sheet, which we're going to go through too in one of these lessons coming up. So you'll be able to see the whole top-down analysis. Higher time frames, stronger support and resistance. I get to identify strong TP zones. Like if I go to this, I got this area off of a higher time frame, right? This isn't a 3-minute support area. I got it from like the 30-minute or whatever, or the hourly, which I'll show you how to do that. I just want you to understand first, time frame correlations. Looking for entries on different time frames, super important. Higher time frames, stronger support and resistance zones, identifying strong TP zones, identify overall trend, buyers and sellers pressure, right? Lower time frames, better entries and exits, like I just showed you. You can also identify a shift in buyer or seller's pressure earlier. That's exactly what I just showed you, right? Next section, let's get right into indicators. Indicators and chart patterns. I don't use many indicators. I use a few chart patterns. So we will go over some of these just to give you kind of an introduction to these. If there's any that you're super interested in, actually, this is going to be just indicators. The next section, we're going to talk about chart patterns. So this shouldn't go into indicators. I mean, this shouldn't go into chart patterns at all. This should be just indicators. So what are indicators? They're an additional tool that seeks to predict how the market will behave. Typically, they're lagging and not as accurate as price action trading. So I do like just support, resistance, and price action, buyers and sellers strength, stuff like that. Some people like indicators. I think it creates a dependency. I don't like to have a dependency on stuff like that. I prefer to have what I would call like a clean chart, a naked chart, whatever the case. So there are different types of indicators. You have trend indicators, momentum indicators, volatility indicators, and volume indicators. Now, this is just going to be an introduction to indicators because you will find a million custom indicators and algorithms and all this stuff that people think is going to make them profitable. I have yet to see some actually be that consistent. So let's go over these though. Maybe you'll find something you like. Moving averages. Now, the idea behind a moving average is just basically saying that, okay, when we're above the moving average, that is a shift of a trend, right? So it's easy to say when you look back, like, oh, look, we're above the moving average here. You should be buying GJ and getting into it. You know, look at the run that it had. Or then looking here, like, oh, it broke below, you should be selling it. And it's like, okay, that's cool, I guess. My argument to this stuff is always like, why wouldn't you buy it here, right? Or what about buying it here when it ended up pulling back and that would have been a loss for you? What about buying it here, right? And when it pulled back and another loss for you, right? What about, okay, here, okay, it played out. But what about buying it here where it just consolidated? It might have stopped you out if it broke the support area here, right? Or better yet, what about getting into the sells here as it broke lower? Or getting into the sells here as it broke lower super aggressively? Or what about here? Yes, it played out real quick, but came right back up, right? Another one right here, getting into sells. Why aren't you selling any of these, right? Selling again here. So selling again here. My point is, after the fact, it's easy to say like, oh, look, you should have bought here and you could have bought here and you could have bought here. But look at all of the other times that you would have been looking if you're only looking at the moving average. Maybe you like to combine this with something else. That's fine. It's for me, once again, support and resistance, price action, market structure is so much simpler, especially when we start applying fundamentals and intermarket analysis to this stuff. It makes things way easier. I don't like relying on this kind of stuff because fake outs and like I said, I think it creates kind of a dependency. So if you like it, it's called moving averages. And sometimes it's called smooth moving averages. You can change the day, the time on it. Do a little bit more research because honestly, I don't want you to use it. I don't like to use it. And this, like I said, this is just an introduction to it. Now we're going to talk about something called the relative strength index. Now, this is going to be a momentum indicator, also called the RSI. So this is going to be, don't get too overwhelmed with this definition, but I do want to share with you like how people teach this, and then we'll talk about the theory behind it. So this indicator, it calculates the cumulative, I can't even say the word, and I wrote this, sum of up days and down days over the window period and calculates a value that can range from 0 to 100. So the only thing you got to worry about that is we have a range from 0 to 100, right? If all price action is to the upside, the indicator will approach 100. This is considered overbought, right? The RSI indicator basically tells people overbought or oversold conditions, which is if all price action is to the downside. A reading of 50 is considered neutral. So this is what that looks like. You got this little graph down here. And technically what it's saying is as price is going higher, this means you're overbought. So what people like to do is they'll say, oh man, it's overbought or it's oversold. If we're breaking 100 or we're getting close to 100, right? You can see the 90 here. If we're getting to 100, I need to sell this. Look how much it dropped. But GJ never really dropped. Like, yeah, I had a pullback, but like you never broke structure. If anything, I just waited for the pullbacks to get back into buys. So this is most likely the markets were closed, Asian session, consolidation, something like that. So this overbought condition, this oversold, like here, like this is just a lot of volatility and ended up coming back up and just staying flat. So most likely something just happened there, a statement or news or something. But for the most part, I don't like this. I also don't like using this. That is what people basically do. They look to sell the markets if it's overbought. They look to buy the markets if it's oversold. That's pretty much all the RSI is. Bollinger Bands. This is going to be, where are we at here? I'm going by this list here. So a volatility indicator. At least I'm pretty sure I'm going by this list. So Bollinger Bands, This tool takes a standard deviation of price data changes over a period of time. It then adds and subtracts it from the average closing price over the same time. So once again, the definitions can be overwhelming. Here's how people look to trade it. It's kind of like having two moving averages on the outside of it, and then you have like a median one here. So they just look to see where it hits the outside, and then they sell it. Look to see where it hits the bottom, and then they buy it. And it's like you can back test it here. Okay, it hit it here, I need to buy. It hit it here, I need to buy. Like, if you like it, great. But like, why didn't you sell here? Like, what happens when you get that sell or a buy here? After the fact, it doesn't look horrible. This would have been a buy again too, technically. Once again, I don't trade this if it's something you're interested in. Like, I don't like adding all this crazy nonsense to my charts. I love horizontal lines. Support and resistance, market structure, take the buys, take the sells. Easy peasy. Don't need all these squiggly lines here. Once again, this is just me. I know this is an entire section of indicators. I'm not trying to push you away from it. I just want you to understand that, like, this isn't necessary. This creates so much dependency on some stuff. This is a volume indicator. This is very simple. Now, basically all it does is these little bars get bigger when there's more volume. If you've gone through the beginning of this course and you paid attention, you know that you don't need this. Is it going to mess you up? I mean, once again, I don't think it even matters. Like, I can see the size of the candle, right? Look at the size of this candle and look at the size of the candle there. I can tell you there's volume. I don't need to know, I don't need an indicator to tell me there's volume. Once again, that's just me, just common sense to me. And then the last one we're going to talk about, I think we have, is the fib. So also called the Fibonacci. The only thing this does is, and once again, if you want to learn this from somebody, by all means, go ahead. All it does is measure the pullback. So I know this is a little difficult to see. I'll actually open my trading view and I'll open it up. I think my colors I used to use it a long time ago. Yeah, see, my colors are different. It doesn't match my chart. So what basically all it does is you need to identify an impulsive move, and you're going to start the fib at the low, right? This blue line right here, I know it's hard to see, but that says 100%. That's the bottom or the start of the impulsive move. And then you're going to find the high, right? So in order to place a fib, you need a low and a high, right? Because I'm gonna start the low, I'm gonna put it at the high. So it looks like this. If I go to my chart real quick, and let's say I'm gonna put it from the low, let's say the low here to the high here. This is why I don't like fibs, because it's so subjective. Some people don't know what time frame to do it on. Some people don't know if you should go to the body or to the wick, like whatever. So let's just put it, just so you can see how it's placed. Right here. I'm going to go to the low here. I'm going to go to the high here. Now I know there's some black lines here. It's kind of hard to see, but basically that's all I did. The 100, the blue there, and then you have the blue there. That's a 0%. So the only thing a fib does is, you see all these percentages, 50%, 38%, 27, I think percent, 78%. These are just, it measures the percentage of a pullback. And typical people like to say like, oh, the 61 is the zone I need to look for, or like 78 or like 50%. Cool. If that's how you like to trade, that's fine. If you ask me, I would much rather just do this. I'm going to draw a support line right here. And this is the area, give or take, that I would have alerts on that I'm looking for a pullback, and I'm going to start taking the buys back up. That's it. And I'm targeting the previous highs, right? Unless if I see, like you can see here, the shift of structure, maybe I'm going to get out of the trade, but it's still held. I can get right back into the buys again, right? So for me, once again, I don't like to rely on like, oh, it only hit a 61%, I need the 78, or it hit 50, I need the 61. It creates so much dependency when you can just look at support and resistance and price action. And that will give you everything you need, I promise. So if you like fibs, great. It's not for me. I just don't like the dependency, like I've said a million times, and that's just how I like to look at it. Next thing we're going to talk about is a couple of chart patterns, which ones I do use and which ones I stay away from. Okay, so what are chart patterns? Let's get right into this. I'm going to talk about some that I use, some that I don't use. The majority of them I don't use, but let's break them down anyways. They're a recognizable configuration of price movement that is identified using a series of trend lines and or curves. One of my favorite examples is they're doodles that look cool after the fact. Most people, like, I don't know, like, I'm not against them. You'll see some that I like, but for the most part, once again, like, I can't help but say, like, people overcomplicate this stuff. Technicals is one of the easiest parts of trading. No need to overcomplicate this. With that being said, let's break down, and I'm going to use screenshots from what I find online, so that way these aren't chart patterns that I found and I'm like, look at this and blah, blah, blah. This is what other people are actually teaching, and then we're just going to break them down. Now, the types of patterns we're going to talk about, we have continuation patterns and reversal patterns. Reversal patterns, there are two there that I use, which we'll talk about as well. But continuation patterns, we have pennants, flags, wedges, triangles, cups, and handles. You're going to love that one. So let's look at some examples of pennants. So basically, a pennant is a type of continuation pattern formed when there's a large movement in a security. Security is just an asset known as the flagpole. So basically, they're considering this the flagpole. And then you have some consolidation and then a breakout. And the breakout is your entry. They're calling this a pennant. I believe I have another example here, right? You see the flagpole. You have your resistance coming in lower. You got like a wedge being formed, a bull, pennant, and your breakout. This is just consolidation to me. Like I'm just looking at this and I'm like, okay, you get your pullback, you get your consolidation, you're looking at price action. It's like, okay, buyers are in play. We broke above the previous, like, let's take the buys. You know, and we're going to go over entries in the next section. But like I said, I think people like to overcomplicate these things. I'm still going to go over them just to show you, like, we have a flag, kind of the same thing almost as the pennant that we saw. You have a flagpole, you have what they call a flag, which is like this, I call it a pullback. And then really, like, if I was trading this, I would just, this is kind of choppy in here, right? Let's use a different color. See if I can make this a little more easy. This is kind of choppy in here, right? I'd actually just be looking to wait to see closures above the high. It even retested it there and continued higher. That's it. Like, you don't need to be like, oh, which pattern is this? This is the bull pennant, a bear pennant. Is that the flag? Well, where's the flagpole? A flag exit, like flagpole length, chart. Like, I don't know. If you can be profitable, you can actually, which now I'm going to want to get ahead of myself because I know what I have at the end of this. So let's talk about wedge patterns, some wedges. Once again, supposedly you have this high, you have this low here, and it's getting smaller and smaller. And then when you catch that breakout, you're looking at the buys, right? So I think I have one for gold on here too. Here. Now, my problem with stuff like this is this kind of stuff always looks good after the fact. You're like, okay, you should buy here, you should buy here. Oh, look how much it would have paid off. But I'm sitting here and I'm like, well, why wouldn't you have done this? Right? Why wouldn't you have done that? And why aren't you buying here? And then you get this pullback, which maybe this would have stopped you out. Like, who knows? Like, really, it didn't break structure. But my point is, like, they always pick the best entry, the best time to get in. Like, when realistically, you could have drawn this so differently. It's very subjective. One of the reasons I don't like patterns, chart patterns, things like the fib too, it's so subjective to the individual. I like to play in what's more consistent and congruent multiple times over. So it is what it is. That's just, like I said, this is just how I look at some of this stuff. Triangle, you're going to see a lot of similarities here. Might look like a wedge, kind of looks like a pennant too. So the idea here is that you're getting some type of a wedge form. You're getting, like, the highs are getting lower and the lows are getting higher, right? Forming this wedge, and then you get the breakout and then it takes off. So it's once again, like, why is the line here? Why didn't you do this? And why didn't you enter on that candle? Because this would have been a loss, right? Good chance you would have had your stop somewhere here. You would have taken a loss here. But instead, this screenshot wants to say that this is the entry because look at the candle after it. So once again, it's just, I never like technical back testing. I never like technical screenshots and stuff like this because people always make it look like it's always a win and it's so easy and it's so simple. Watching this stuff in real time, it's like, man, where do I put the line? Where do I put this? What if I do this? Right? Why is it have to be like here or here? Why is this the entry? Why didn't you buy here? You know, so once again, I know I'm kind of bashing chart patterns. It's just like, it's just not something I like to do. Cups and handles. This is a crazy one. This is like, I don't know who trades this or what people are doing when they're looking at this stuff. When we see this cup here, the pullback, the breakout, it's like, I'm assuming they're looking at this as the entry. But it's like, if I was looking for buys here, like, I'm entering like here. I'm entering here. Like, I can already see consolidation. I see the shift. Like, I see the bearish market structure. I see consolidation. I can see the shift of structure happening here. I'm already buying. All this is a consolidation, a pullback, and a continuation, right? That's all that is. So the fact that you need to wait for all of this to happen, that pullback, and then take the breakout, like, I don't know. I hope you see what I'm seeing where I'm like, this stuff is crazy to me. You need to have some picture form, like, overcomplicating simple things. It just doesn't make sense to me. That's just me. Let's talk about reversal patterns. Head and shoulders, double top, and double bottom. Head and shoulders, once again, almost as crazy as that cup and handle one. Supposedly you have a head here where this is just a loop to the upside, I guess, like a higher, it's a high, and then you have two little shoulders here, and that's supposed to be a break to the downside, right? That's a reversal. So to me, I hope you're following this. It's just a shift of structure. Like I'm in cells here, right? Like I'm already seeing the break of support, the pullback, the break again, and then we're just consolidating or breaking again. And then here's your another entry. But like I don't need to identify a shoulder here, a head, a shoulder, and then take the cells here. I identify the break of structure here. Makes sense? I hope that makes sense. I think I have another one here where it's a little crazy. Yeah, this is the kaboom screenshot. Same thing here, right? Like it's like the back, the screenshots always look great. Look at this move that I caught. That's crazy. And like if you look back, how come the shoulder here is like consolidation, but the shoulder here, it's just a wick? It's like, but the shoulder here, it's like, what are you considering a shoulder? Once again, maybe you can find an expert on this. I don't like what I see. I think this is too subjective. It's just not for me. But you know what isn't subjective? A shift of structure. You can see the support here, right? I can see the shift in seller strength. I can see the pullback. I can see stronger bearish candles, consolidation, another pullback right to this support area. Bam, right? That's my kaboom. That's where I'm taking sells. I'm taking sells. Sorry, I get passionate about this stuff. I'm taking sells here. I'm taking cells here. I'm taking cells here. I'm not waiting to find shoulders and heads and all this stuff. Once again, this is just me. I'm not a fan of it. I think it overcomplicates something that can be so simple because I promise you, when we get into fundamentals, talking about central banks and monetary policies and like interest rates, like you can get overwhelmed. Don't overwhelm yourself with this stupid stuff. Just my opinion. If you do it, don't take offense to what I'm saying. It is what it is. This is just how I like to trade. So double top, this is actually something I do like to trade. Double tops are valid for buyer's exhaustion and reversals. This would be an example of a double top right here. I like this. Once again, though, yes, this is technically a chart pattern. To me, like it's just a shift of structure. I'm not breaking higher. I look at this, like I wouldn't be selling here because I'm still in bullish market structure. I'm selling here, right? That's where I'm going to look to sell because now I've shifted out of structure. Right? It's different. If you're in bearish market structure, like I'll give you an example. If market structure is doing this, we get your, let's do this. If you get your higher highs and higher lows, I mean, your lower lows and lower highs, right? We're going bearish and then we're looking for a double top. You got this, and then you come here. Let's say you only come a little bit and then you get a double top here. Okay, that's a good reason to look for sells, right? Right here. But this is actually just a shift of structure. And the shift of structure isn't valid until that break right there. Does that make sense? Right? Because this is technically still an area to continue looking for buys until you break lower. Now you're breaking out of that structure, the bullish market structure. You start creating lower lows now. Cool? We cool on that? Double bottom is the exact opposite, right? This is, once again, it's a little subjective. Like you're not going to get a clean double bottom, but this could technically be considered it right here. You got the wicks here. You hit this area. It's a support area. Get the double bottom. I got this candle here, that breakout. That's my entry right here. I want that strong bullish candle. I want to hold that support area. I'm taking this here right up to the next area, at least to one of these zones that I have marked off from the previous like 30-minute hourly candles, right? So that's what I'm going to be looking for my good entries. Double bottoms, double tops, great things to be looking at. If you'd like to go down the rabbit hole, this is one of the things I almost talked about, but I wanted to wait till I got to the end. If you want to go to down the rabbit hole and confuse yourself or overwhelm yourself even more than you might already feel looking at some of these chart patterns, you can go look at something like this. Oh, right? Because I actually have like, man, I don't think I have it anymore, but I bought books when I first started trading on chart patterns. My God, there is like, if you go to Head and Shoulders, but right here, here's a good example, inverted Head and Shoulders. You have an inverted Head and Shoulders, you have an inverted reversal Head and Shoulders, you have a bullish, a bearish Head and Shoulders. There's like inverted wedges, like descending triangles, ascending triangles, descending, ascending wedges and flag. It's like, come on, it's higher highs and higher lows in market structure. That's it. If you want to go buy an entire book on this stuff and really like bug yourself out, feel free. But I promise you're just going to overwhelm yourself on stuff that just really isn't that necessary. Let's get into talking about entries because that's important. Okay, here we go, finding entries, and we'll do a quick top-down analysis here for technicals. So when I'm looking to find entries, before taking an entry, I need to identify at least one of the following: order blocks, and I'm going to show you screenshots of like examples of all this. I want to see order blocks, a shift of structure, which I've been talking about pretty much this entire time, breakouts above or below if I'm looking for sells, the previous structure. I always want price action in my direction of the trade before getting in. If I'm looking for buys, I don't want to see strong bearish candles on my entry. If I'm looking for sells, I don't want to see strong bullish candles on my entry, right? I want that candle to be a reason, or the break of structure to be a reason why I'm getting in on this, right? I need to see that shift of structure. So this is an example of order blocks, right? You can also look at order blocks as consolidation, sideways movement, whatever it is. I like to call them order blocks. Typically, in this example is actually not the best. I think the next screenshot's better. Gold isn't going to give you that many clean order blocks. The markets will never give you anything exactly how you want it. But this right here, right there, I see the consolidation. These are the buys we actually took maybe a week ago now. And then this candle here was the entry, and then just taking it to the upside. Now, when I talk about intermarket analysis, because I'm looking at gold, I was also looking at the US dollar. I was looking at something called the US 10-year, the yields. There are other things I was looking at, but just speaking strictly on technicals, I like the consolidation. You can see this little block I have here, right? It's a support area. That means in the lower time frame, this is a 3 back here, right? On the 3-minute, it came lower. On the higher time frame, it came back up and closed above, and then it just started consolidating. And now I see the consolidation at a support area and take it right back up, right? I'm just going to be patient and wait for that. I don't want to enter and get faked out taking sells here as it's breaking lower because it's a lower time frame. I'm at that support area, right? And then I see that consolidation. I'm not going to buy here. I'm going to wait for a confirmation, which is this right here. I need to see that shift of structure, the consolidation, the order block, and then the break above, right? So that's an order block example. This one's even better. This is on GJ, I believe. Yeah. So you can see like the clean body candle bodies here at the highs, clean candle bodies here at the lows, right? That breakout. And this candle right here is why I'd enter. That candle was our entry. Stops above the previous highs because I'm going with market structure at all times. My stop loss is always going to be placed above market structure. Where does price need to break in order for this trade no longer to be valid and we break out of that structure, taking it back higher, right? So this is what I'm going to be looking for, is an order block or consolidation like that right there. Shift of structure, never going to be perfect. But these were actually, we took the sells here and I ended up getting back into the buys somewhere around here. It's kind of the same thing as that 3-minute, the lower time frame, it broke lower. We got some consolidation, but really what I'm looking at is the shift in the seller's strength shifting into buyer strength. Because my bias, at least at the time, my bias was still looking for buys on GJ. I just scalped the sells here because I had a reason for it, but got right back in the buys. I didn't get in the buys at the lows. I got in the buys when I see the shift of structure. You got to be patient. If you look, this is the 5-minute time frame. That means that this was at 2 a.m. Yeah, this was unemployment data we had for the UK. So it was at 2 a.m. and it wasn't until like 3:15, 3:30 that I actually got back in on the buys. An hour and a half later, I finally got back in on the buys, right? So you do need to be patient. If you just look at this, like, oh, buy and hold, it's like, okay, yeah, but you hold this for 3 hours, right? Just keep that in mind. Most people are going to get a couple of pips here. It's going to go up and they're like, oh, I'm done. I'm done with the markets. It's like, look how much more it went, right? So that's not always going to happen, but it's always good to at least zoom out a little bit. And then we're talking about breakouts. This is an example in the 3-minute time frame. So you'll get this in the 10-minute. You'll get this in the 15. You'll get this in the 30. I typically look at the lower time frames for my entries, but this is a good breakout here, right? That candle breaking out above the previous highs, previous support area. Take that to the upside, especially because my bias is looking for those buys. So that's a good breakout entry. Now, time frame correlations. This is like a higher time frame or top-down analysis. This is just typically what I look at. Feel free to screenshot this if you want a copy of it. Maybe I'll put a copy of it inside on this page and you can download it. So I'll just get rid of the Wall Street Grunts is my private group. So we'll have to get rid of that there and change it to Operation Wall Street for this course. Monthly and up time frame. Typically, this is macro analysis. I really don't use it that often. I use it to back test fundamentals or something like that. Very, very rarely. Daily, same thing. I really don't use it that often. I very rarely find myself even looking at those timeframes too much, unless if I'm talking for something for like that happened like months and months ago, I'll go to those timeframes. Typically, the 4-hour, the hourly, and the 30-minute is the most that I use, and I use those on the helps me identify market structure, buyers and seller strength, areas of interest, and my entries depending on analysis. So the entries are always going to change. There isn't, if I can give you like a checklist of like, you need to have this, and this, and your entries will always work, it's impossible. So if you're looking for that, I'm sorry. This is the closest things you're going to get is like, you need a process, but you also need to be versatile. You need to be able to adjust in the markets. At the end of the day, that's just what it is. Like there's no ifs, ands, or buts about it. You're not going to have 7 check marks, 7 confluences, 7 confirms every single time. I want to know, like I gave you my rules here. This is something I follow very strict. I need to see something, a shift of structure, order blocks, or breakouts. And price needs to be moving in my direction in order to take that trade. Those are pretty good rules. And if I follow that along with this, it's going to work out pretty well. So typically my entries will be on the 30-minute and below, typically 15, 10-minute, 5-minute, sometimes a 3-minute, like I showed you on gold. But you just need to understand what it is that you're trading when you're getting into those, because it could be risky. Depending, the lower time frame is always riskier, just because it's not as strong. But the higher time frame, you have much bigger ranges, like I was showing you in the time frame correlations video. So, and just to give you a quick example, I'll show you like how I would mark it up. Like what I would do, we still have the fib on here. If I was to mark up some zones here, like I would start on the 4-hour. Like let's go to a pair I don't normally trade. I'll go to like Euro JPY. I don't trade it that often. I'll start on the 4-hour here. And what I want to do, I'll actually delete. Maybe I can remove all the drawings. Let's delete everything. So now we just have a crazy empty chart with a bunch of lines and candles here. Now, what I want to do is I like having my trading view with the crosshairs. You see how you can adjust this little icon I'm using, how you have the dotted lines? Because what I'm doing is I'm moving my arrow, my mouse up and down, and I'm like, okay, I'm looking left and right, and I'm like, where can I identify a zone that lines up in multiple areas? Right here is one of them. Right. So now I take out my rectangle, and what you're going to see is like when I set my rectangle, it's going to automatically extend to the right. You can change all of your settings. See, it always goes to the right. I don't have to extend it or do anything crazy. So if you want to do that, you're just going to double click it. I think it's under style. Extend to the right here. I can even extend it to the left if I want. So it goes both ways. So extend to the right is cool because now it's going to go forever. Like if I ever see another area in the future, it's going to hit it again. I already have this area marked off. So what I'm looking at here is a couple things, right? I can see once again, I'm trying to match up them as close as I can. I like candle body closures more than anything, but it's kind of a bigger zone here. I can see like if I go mainly based off of this right here, if I go off of this right here, I can see the candle bodies closures here. Candle body closures here. That's my first match, right? And now I drag it over. I'm like, okay, I got another touch here. I kind of got a touch right here. It's a little messy, but it's there. So give or take, I would just try to go like in the middle of this zone. The next step to take this further would be to match it up with an even number or like something like a quarter point, like 250, 0.5, 0.75, or an even number. Kind of hard because you're going to get even numbers everywhere, every 10, 50, every 20 pips or so. So yeah, that would be like the first area I'd be looking at. And let's say I was looking to enter, or I'm doing analysis on Euro JPY. Let's pretend I'm going to look for buys or sells or something. Now I'm going to find another zone. So here, I can already see this zone right here. So what I'm looking at is these highs to start. I can see the highs again. I can see the lows here, and we're currently sitting there. So that's where I'm going to be looking. I don't like, remember, these are my areas of interest. So if I'm looking, now what I'm going to do is, let's go back to my PowerPoint. I marked it off in the 4-hour. I'm going to go down to the 30 in the hourly just to see what it looks like. Let's go down to the hourly. We've already had an hourly closure below, but I mean, as far as the time goes for today, I'm not looking to trade this or get in on this because it's just, time is another rule, right? I'm not trading at the end of New York session. It's currently like almost 3 p.m. my time right now. So we have the hourly, and then when I'm going to look for entries is going to be the 30-minute and below. So what I'd be doing is I'm going to be looking, I'm going to go down to the 30-minute time frame, and now I'm going to be looking this. If markets were open and I was looking at Euro JPY for sells, I like this for an entry. That's a good 30-minute closure, but still, I don't like the 30 minutes for entries. I'm going to go down to the lower time frame, and I'm going to go down to the 10. I'm going to the 15. I'll keep changing time frames trying to see what I like. Now, this doesn't look. Now I can start adjusting some areas because I'm like, okay, I want to see breakouts below these lows here. Like this would actually be a pretty good entry here. The problem is it's not Euro JPY. This was New York session. For one, the timing isn't good. So you get fake outs, you get consolidation. It's really not a reason to be looking for it. But this is what I'm going to be doing. I'll be marking up these zones And knowing I wasn't trading Euro JPY today, I'm not touching this. The yen was actually kind of screwed up today, the Japanese yen. So like, I'm not looking to trade Euro JPY. Euro's been a little messed up too. You can see how strong this is here, how weak it is here. Very choppy price action with the euro. So it's not the best example. I want you to focus on how I'm marking areas up and identifying zones. We start in the 4 hour, right? And then I'm going to go to lower time frames and actually look for entries. Right now, Euro JPY isn't the best thing, but really all I'd be doing is I'm going to look for sells here. I'll be looking for buys here, breakouts. And if it holds this, I'll be looking for buys here. I don't typically trade Euro JPY. I'd have to have a reason to do it, but that's what I'd be looking for when I'm looking at my top-down analysis. I'm going to zoom out first, see where I am, and then I'm going to zoom in and actually start setting some alerts, looking for entries. If you want to know how to set alerts, let's say I want to take sells if it breaks lower here. I'm going to right click here, add alert, and that's it. And then I just hit create. And now I'm going to get that alert formed right there, right? You can see alert. So I'll remove it. It'll even go to your phone if you have the TradingView app on your phone. So I think, yeah, you should be able to download this. I'll make sure it's on here. That should be everything though when it comes to like higher time frame top-down analysis. It's really not that difficult. Don't overcomplicate this stuff. What you really want to know is the direction. When you create a bias, it's going to be the fundamentals, the inner markets, the sentiment analysis, and stuff like that. The technicals are just going to be finding our entries, understanding where we are in the higher time frame, and understanding market structure. So the next thing, that's phase 6. Congratulations, you've completed phase 6 technical analysis. Now we're going to get into some of the gushy stuff, some of the geeky stuff, and now I'm going to transform you, hopefully, into an economic geek. So let's get right into it. All right, so this is going to be your introduction to fundamentals. We're going to go over the core concepts and we're going to dive a little deeper into each of these things. So fundamentals, what is it? Here's a definition is type of analysis that's based on looking at the intrinsic value of an investment. So if you were to look at, let me say that a little slower so that way I don't lose you. It's a type of analysis, right? We know that. It's based on looking at the intrinsic value. I mean, you can remove the word intrinsic. It's looking at the value of an asset. How are we determining the value of something? That's the fundamentals, right? This is looking at companies, right? This is actually a legitimate analysis sheet that I've done for dissecting or determining analysis for the fundamentals of companies. So we have industry analysis, business model, financial strength, whatever. Basically, if you think about like earnings reports or something like that, we need to evaluate what a company is worth. That's called fundamental analysis for companies. Now, we're doing this for currencies, assets, commodities, stuff like this. So how do we find the fundamentals of Forex? The first thing you want to understand is, what are we trading when we're trading Forex, right? What are we trying to find the value of? What do all of these have in common? This one here, Euro USD, NZD JPY, what do these have in common? Think about it. They're all currencies, right? So we need to determine how we're going to find the value of currencies. So how do we find that? We need to look at the economic conditions that affect the valuation of a nation's currency. Remember, these are like the US dollar is the nation's currency. The Canadian dollar is the currency for Canada, right? An entire nation. So we need to find the things that actually impact an economy's or nation's currency, right? What makes that currency valuable and what hurts its value? Typically, it's going to be the same thing that makes it valuable as well as hurting it, but we need to identify both directions, right? You typically have 3 major factors. These are the things that we're really going to focus on, and we're going to go deep into fundamentals on this. First one, oh, I'm yawning, excuse me. Sorry about that. Hey, this is live. I'm not editing it. So the first one is central banks. So we're going to talk about central banks. We're going to talk about what a central bank does is it controls monetary policy. They control interest rates and monetary stimulus, also known as money printing. Monetary policy, interest rates and monetary stimulus both fall under a central bank's monetary policy. We'll go a little deeper into that later. The main purpose of a central bank is to maintain a balance between employment and inflation. We have an entire section on central banks. This is just an overview. Economic data is going to be the second major factor that we're paying attention to, right? So the first thing, central banks, then economic data. These are things like inflation, unemployment, retail sales. Basically what it does is it paints a picture of the overall health of an economy, right? This is a big puzzle piece that we're looking at when we're looking at economic data. It's telling us the health of the economy. The third major factor, political and geopolitical events. These are things like physical war. These are things like trade wars These are things like political drama. These things do impact currencies. These things do impact risk sentiment, which we're going to talk about during sentiment analysis, but these things do impact currencies. So first, let's dive right into central banks. We'll go a little deeper into how they operate and how they impact a currency. All right, central banks. So this is going to be, yeah, I need you to focus with me. I'm going to do my best to make this good. It's very visual. So this should be the best central bank class, course, whatever that you ever get, because it's a little visual, but at the same time, this is a lot of information. It might be a lot of new information to you, right? So just stick with me on this. Let's get to this. What is a central bank? I'll tell you right now, before I even get into the PowerPoint, this is going to be one of the main things that impact currencies. You need to understand central banks, monetary policies, all that stuff. This stuff is super important. It's basically a financial institution that controls the production. Well, I don't know if you heard that noise. My MetaTrader just restarted on me. So a financial institution that controls the production and distribution of money and credit for a nation or group of nation. Basically, they're the bank that gives money to a country, right? That's pretty much all it is. It is the country, like the Federal Reserve is the United States bank. Now, the difference between a central bank or a private bank, excuse me, I yawned again. The difference between a central bank and a private bank. Central banks can issue banknotes. Now, banknotes is just a fancy term for money. Central banks can create money from nothing, from thin air. Private banks cannot issue banknotes. If you ever look at like the back of a US dollar or the front, whatever you want to call it, it says US Treasury note, right? So it is a banknote. That's what US dollars are. So a central bank can create money from thin air. You have 8 major central banks, at least that we focus on or that I focus on in my trading. The Federal Reserve, Bank of England, Bank of Canada, European Central Bank, Reserve Bank of Australia, Reserve Bank of New Zealand, Swiss National Bank, Bank of Japan. Fun fact, if you want to know the difference between the flags on these two, the only difference is that there's a missing star here for New Zealand, and New Zealand has a white outline on their stars. That's the difference between New Zealand and Australia, because I always get them confused. They look very, very similar. They're actually not even that far off from when you look at the Bank of England with the design that they have, but they're definitely set up a little different. So fun fact, since I'm showing you the flags. Now, a central bank's purpose, we touched on this a little bit in the last section, but they provide the country's currency with price stability by controlling inflation. They also have an impact on the labor market data, but they are trying to control inflation. They manage inflation by controlling a nation's money supply. This impacts its strength. Think about supply and demand, right? When you increase the supply on something, you will hurt its value. When you lower the supply on something, they will increase its value, right? We're going to go a little deeper into that later. This regulation process is called their monetary policy. I said that in the last section, right? Their interest rates and monetary stimulus is all falls under the monetary policy. Okay. Now, the majority of things we analyze always, this is what I was saying in the beginning. Everything we analyze comes back to a central bank's monetary policy. When we're looking at economic data, the question is, what's the central bank going to do with this data? Are they going to raise rates? Are they going to lower rates? They're going to change their monetary policy. We'll get a little deeper into that too. But just understand that like everything we're looking at, this is how we decide our swing trades, our smaller, our scalps, like our trades, right? The central bank's monetary policy, is it going to change with economic data? Now we have 2 different types of monetary policy. We have expansionary and we have contractionary. So we're going to dive a little deeper into both of these. Expansionary, this is typically used when there's an economic slowdown, high unemployment, and possible recession. The goal is to stimulate the economy by increasing economic activity. And we're going to have some examples of this. Just understand the theory first, and we'll talk about real world examples in this same PowerPoint. So don't worry. Long term, this policy can result in high inflation and a devalued currency, right? So higher inflation, devalued in currency. They're doing it because there's an economic slowdown. They're trying to stimulate the economy, right? So those are the things you want to know about an expansionary economy. This is also called monetary easing. This is, I might have these words here, actually right here, yeah. Quantitative easing, monetary easing, easy money, and also called dovish. So dovish means an easy monetary policy. Now the expansionary response, what does the central bank actually do when we're in this environment that we just talked about, the slowdown in job, they want to stimulate the economy. and it can result in high inflation. What is the central bank actually doing? They're printing money. Quantitative easing is literally just the central bank printing money. And they lower interest rates. They bring interest rates. They don't have a specific number that they'll bring it to, depending on the situation, but they will start lowering interest rates. Once again, we're going to show you some real world examples here. So now let's go talk about contractionary. That was expansionary, right? So let's get into contractionary. This is what used when a country has rising inflation and or a strong economy. The goal is to slow growth of money supply and combat rising inflation. So we have high growth, we have high demand in the markets, maybe retail sales are getting out of control, which is increasing inflation. When you have a lot of demand in the market, you have people spending a lot. It typically increases the demand of things. When you increase the demand of things, the price of them goes up, right? So when the price of goods and services goes up, you're going to increase inflation. So this is the environment we're talking about, right? The country has rising inflation and we have a strong economy. Long-term, this can result in an economic slowdown and possible recession. So basically what the Fed is going to do is they're going to now have a contractionary response. This is also called hawkish as opposed to dovish. Tapering is another word, which we'll talk about a little later. And hard money. Monetary tightening is another word that they would use. So contractionary, monetary tightening versus monetary easing, hawkish, hard money versus easy money. That's pretty much the contractionary versus expansionary. There's a few different words that you'll hear referring to this. So let's talk about the contractionary response. The response that a central bank would do when we're in this situation here is they're going to remove printed money. They're going to raise interest rates. And we're going to talk about how they remove money when we actually in this slide, how they actually stimulate money and how they do all of that. Just worry about what it is that they're doing, what their response is, right? They're raising interest rates and they're removing the printed money. They're trying to remove money out of circulation so that way they can decrease inflation, right? Because once again, if you are to lower supply of a currency, you increase its value, you increase its strength, right? Raising interest rates does the same thing. It makes the US dollar or whatever currency more attractive to foreign investors, which we'll talk about too. So let's go over a few examples. 2020 COVID lockdowns. If you've been alive and you're taking this course, I'm assuming you have an idea of what happened with the COVID lockdowns, right? An entire nation locks down. Economic activity comes to a complete halt. Thousands losing their jobs every day, right? So think about this. We have an entire nation that's not working anymore. We have economic activity slowing down and we have everyone losing their jobs. Not everyone, but you know what I mean. We have quite a few people losing their jobs. So I got ahead of myself. The central bank response would be expansionary, right? Let's go back and look at this. Expansionary, typically used as an economic slowdown. They want to stimulate the economy, right? Long-term, it can lead to inflation. Depending on when you're watching this, you already know what this is going to lead to, right? So let's go COVID lockdowns, expansionary. This is what they did. Interest rates went to zero and the Fed started injecting, I think they were actually at 120 billion. They were doing 120 billion and then 80 billion per month. They were injecting over $80 billion per month. And I'm going to show you exactly how it is that they do that, what the process is called, but that's an expansionary example, what they were doing, right? And long-term, this policy, well, that wasn't supposed to disappear yet, I don't think. Long-term, this policy can result in high inflation. This is what we were talking about, right? High inflation and a devalued currency. This is a chart for inflation. So you look here, 2020, right before the lockdowns, we're at 1.1%. And now look, December 2021, March 2022, look at inflation. We went from 1% to 6.5%. We ended up peaking over 8%, but don't need to make the chart too big. You get the idea. Inflation rises, right? And now I think the next chart will have the dollar. Yeah, so let's look at the devalued currency. This is the dollar, right? The DXY is the dollar index chart. Once again, 2020, this was COVID, the spike here, so we kind of ignore that right now. But overall, over the next year, we just lost a ton of strength in the dollar, right? Inflation was rising, the currency was being devalued. Once again, it goes back to this. Interest rates were at zero. Fed started injecting 80 billion to 120 billion per month. They increased the supply of a currency, therefore they devalued the currency. Makes sense? Let's give another example. Late 2021, 2022, supposedly COVID's over. We really don't know. Things are like starting to open back up. So most nations open back up completely. Inflation is still increasing, right? Like I just showed you, at end of 2021, going to 2022, inflation's getting high. Job demand is starting to increase. As the nations open back up, job demand comes back, right? So now I need to start hiring people. So now we have jobs, the demand increasing, which means we have people working. Inflation is still increasing. We've just injected a ton of money into the economy, and the nations are open back up, right? Contractionary. The central bank's response is going to be a contractionary response because, once again, they want to fight inflation, and we have a strong job market, right? This is what they ended up doing. Interest rates went from 0 to 5%. Fed started reducing the 80 billion per month. That's tapering, right? So I'm going to explain this a little deeper later, but we'll talk about it real quick now. When they're injecting 80 billion per month, which is going to be called bond buying, I'll talk about that in a minute. When they're injecting 80 billion per month, what tapering is the next month when they started tapering, they're like, okay, we're only going to inject 60 billion. And then we're only going to inject 40 billion and then 20 billion. And they keep lowering the amount until they get to zero. They can't just rip the Band-Aid off because they believe it'll cause some problems with the markets. So they need to slowly taper off. That's exactly why it's called tapering, okay? So that's when they're removing the amount of money that they're injecting into the economy. They just can't do it all at once. So this is what the interest rates look like. You have March 2022, started raising rates, went up to 5%. This is a contractionary response, right? This is the DXY. The dollar chart again, look at what happened here. So tapering was announced, we stopped dropping, right? When the Feds stopped injecting all of this money into the economy, we kind of got sideways for a couple months, right? We didn't go bullish, we didn't go bearish, we didn't gain strength, we didn't lose strength. We just kind of went sideways. And that wasn't until like December, January when they started talking about rates, and then March when they actually raised rates. Now we took off, right? Dollar gained a ton of strength. Make sense? Make sense, yeah? Here's a couple central bank tools. These are the main tools that they use. We talked about quantitative easing, quantitative tightening, tapering, and money printing, right? We've talked about these two things. This is done through bond buying, which I'm going to show you how that works too. Also interest rates, right? So the two things that they use is quantitative easing or quantitative tightening, call it money printing, and raising and lowering interest rates. Interest rates really being their main tool for fighting inflation. So let's talk about bond buying. This is, let's see what I have here. Before I get ahead of myself, I'm going to see what I have here before I start talking. The Feds can't just give the US government money. The Feds can't go to the government and be like, hey, we're your bank. I'm just going to give you $1 billion, right? Instead, they have to purchase something called bonds, treasuries, same thing. Basically, you can look at bonds as a loan with a promise to pay back. That's all it is. So what happens is we have the US government here on the right and the Federal Reserve on the left. The US government is going to give the Feds, Federal Reserve, Feds, same thing. They're going to give them bonds. And the Federal Reserve is going to give the government cash in terms of those bonds. And the bonds are going to have terms attached to them, which we're going to talk about a little later too. The bonds have like an interest rate, they have a time limit, they have all this stuff attached to it that determines how much the government needs to pay back. The government uses this money now for government programs, stimulus checks, pensions, etc. So this is how they inject new money into the economy. The government basically creates this IOU, and it's on the government's terms. They give it to the Federal Reserve. Federal Reserve says, here's $1 billion, or here's whatever it is that you are asking for. Here's just an example of some headlines that we get from them, right? This is when they were increasing the bond buying. You can see here, system open market account holdings, treasury securities, right, bonds, by 80 billion per month, and agency mortgage-backed securities, MBS, by 40 billion. This is what I meant. This is the 120, right? They were doing 80 billion of treasury securities, and they were buying mortgage-backed securities for 40 billion per month. So don't worry about what mortgage-backed security is. Just it's a bond. They're purchasing bonds. They did 80 billion and then 40 billion, right? So we were doing 100. This is right here, effective March 2021. This was a year after COVID lockdowns. They were injecting 120 billion, and you can see here, if we go to this headline here, the funds rate in a target range of 0 to 0.25%, right? So we're still at 0% with interest rates too. Very low interest rates, very high money injecting. So we'll talk about more bonds, sentiment analysis. We'll talk about intermarket analysis too. So raising interest rates, how does this impact the currency? It makes the currency more valuable, right? Because higher rates is going to attract more foreign capital, and it leads to an increased exchange rate. So remember the exchange rate, we have like USD, JPY. As the dollar becomes more valuable, you're going to see UJ go higher because it's increasing the exchange rate. It's making the dollar more valuable against the yen. Before I get ahead of myself, I want to see what else it says. Causes economic activity to slow down, right? So when we think of, let's talk about this first. So you can also think of it from the bank's perspective. If I'm lending money at a higher interest rate, my loans now become more valuable, right? So that's another way. It attracts the foreign capital. It makes my loans more valuable. I make more when I lend it out, right? It also causes economic activity to slow down. Another thing with the loans, the cost to borrow becomes more expensive. So it slows down lending. So even though I'm actually making more money on the loans because higher interest rates, it also slows the mortgages, the car loans, company credit, all of this gets slowed down. So interest rates is bad on the long term, it's bad for the economy. Higher the rates, the more serious the slowdown can be, right? Now, what about lowering interest rates? If we have a situation where we have lower rates, we now have lower borrowing costs, which is the opposite of what we just talked about. It also devalues the currency, right? It almost removes the foreign investor appeal. It's literally the opposite of what we had just talked about with raising it, right? Loans become cheaper, banks make less money, and now we have more money circulating in the economy because banks, fun fact, when we're talking about private banks cannot create money, but they do increase money circulating in the economy through loans and credit. So private banks can still increase that, right? If interest rates are lower and we're throwing out a bunch more loans now, we're putting more money into the economy, right? We're increasing the demand we're selling more houses. We're selling more cars. We're doing all of these things, right? So it's actually going to be putting more money into the economy by doing that. That's why the economy works in cycles. This is just another headline. As expected, the Fed benchmark interest rates near zero following the conclusion. So this is just another one of, not too sure why I put this here. Interest rates near zero. That's what it looks like. In case you want to know what the headline looks like, this is what it says. They call it the benchmark interest rate near zero following the conclusion of its 2-day meeting. So there's that. That's their interest rate interest rate meeting. So this is good for companies and businesses, right? It's the opposite. Loans are cheaper now. There's a lot more money in the economy. This is good for companies, bad for businesses. If you go look at, I'll show you a quick example in the charts. Oh, I don't have TradingView open. 2 seconds. Let's let this open. If you go look at like US 30, Dow Jones, if you've never seen this before, it's the US stock market. So if I go look at this, what the US 30 was doing, or the US stock market, I'll just call it the US stock market. We go to a higher time frame here. It's just loading a little slowly here. I didn't have it open. I wasn't prepared for this. It's kind of I'm doing this on the cuff and it's not opening. Here we go. So if we were to zoom out a little bit on US 30, Dow Jones, US stock market, let's go to like the 4-hour here, right? The entire time that we were raising, the entire time we had those zero rates and we had the easy money, this is what it was doing, right? This is a COVID lockdown here, and we went super, super bullish the entire time, right? Just to show you an example of what it did. It was very good for companies and good for businesses. Remember, these companies and businesses is what makes, well, you might not know this yet, but US 30 means there are 30 companies that make this up. The stock market is made up of companies. So we're going to dive into all of that in the intermarket analysis when we talk about equities. But for right now, you can just see it visually what happened there. So as far as some tools and resources go to stay on top of this stuff, honestly, if you're not in my private group, we have access. I give you access to all of this stuff through my news terminal, but every central bank has a website. They have press releases, monetary policy statements. You won't get it right away, but you'll get it that day, a couple minutes later, perhaps. And that's something that you can read, right? Another couple resources here, Bloomberg, Reuters, or ING Think, like get on their email list, choose one of them, choose more of them, whatever. I personally am, like my news terminal is with Reuters. That's just what I use. But to get a news terminal is kind of a different story. Pay over 30 grand a year just to have access to that news. So it can be pricey, but to me, it's worth it. So if you want access to that, just get into Wall Street Grunts, join a private group. Oh, I got it right here. See, this is what I mean, man. I get ahead of myself. Your own news terminal or a community with access to one. So there's my plug for Wall Street Grunts. You want access to a news terminal? Just join Wall Street Grunts. So let's talk about economic data and how the economic data is going to impact the markets as well. Economic data. This is all the crazy stuff we see, the numbers, the inflation, and all that fun stuff. without further ado, there is a difference between economic data and news. We're going to cover both of them. Basically, just to clear it up right now, economic data is planned in advance. Economic data is something like earnings reports for Tesla, Meta, Facebook, Netflix, whatever. It comes out, it's predetermined. The result is not predetermined as far as we know, but the inflation data comes out X amount of times a month. We already know this every single time. Same thing with everything else, right? The news is something that we're going to talk a little more. It's more like headlines. It's something that's new to the market, unexpected, right? So economic data, like I said, it's reports released by the government or a private organization that details a country's economic health. That's all economic data is. They're planned reports. They come out weekly, monthly, or quarterly, sometimes yearly. And it's basically a report card for the economy of a country. It helps policymakers. This is where it's key, right? Because remember I said before, everything comes back to the central bank. When we're talking about, talking too fast here, when we're talking about policymakers, we're talking about the central bank, monetary policy. Remember, it helps policymakers guide the government in formulation of an economic/monetary policy. Maybe that's not the right word. Doesn't help guide the government because policymakers, technically the Federal Reserve isn't a government entity, but we're just nitpicking here. So economic data is important for the central bank. We'll leave it at that, right? This is just a few examples. This is not an exhaustive list of all economic data. These are some of the more important ones. Consumer price indexes, inflation. I won't break down every single one of these right here, but these are all important. NFP, this is employment data. We have purchasing managers index, GDP. PPI is also producer price index, is another inflation print. We also have something called PCE, which is personal consumption expenditure. There's a lot of pieces of data I have a ridiculous list here. So there is a lot of economic data. One of the questions we're always asking ourselves, though, is will this change monetary policy? That's what this data means. Well, that's what we're looking at when we're looking at this data. So how do you read economic data? How are we going to look at it, and what does it look like? Typically, you're going to get the data name, and I'm going to show you exactly where you can find these. You're going to get the forecast, expectations, or actual. It's going to be called either one of these. On my news terminal, it's called actual. On the forecast, it's called, on other places I'll show you, it's called forecast. Sometimes it's expectations. You're also going to get previous and country, right? So just to recap, because I kind of ranted on that, data name, forecast, previous, country. So we know what happened the last time it came out. We know the country it's for. We know what the markets are expecting, and we know what the data is, right? The data name. So those are the things that we're going to be looking at, right? Now, the actual release won't always have a hard impact on the markets, even if it's important data. If it's NFP, if it's inflation, it's not always going to impact the market. Sometimes it causes consolidation if it comes out as expected, which we're going to talk a little deeper about that. Market conditions and understanding what the central banks are focused on can help us determine which reports have a higher potential for increased volatility. As of the making of this recording, we are in middle of 2023. Labor market is a very big deal to the Feds. Inflation's been the focus for the last year or so, year and a half. Now they're shifting to the labor market, which has always been kind of important, but there's a lot more focus because inflation is starting to trend to the downside, and the labor market hasn't really given up yet. So they're watching that specifically. Previous Fed statements or interviews. That is exactly how I know what I just said. Feds have actually come out and said it. They've been interviewed on like CNN or Bloomberg or Reuters, and they've come out and said that, hey, the unemployment needs to go higher. So that's how I know that's what they're focused on. This is what an economic calendar looks like when we're getting this stuff here. This is what it looks like on Forex Factory. I don't know if I have the name. No. So this is forexfactory.com. This is a free service, right? You have the actual here. You have the forecast. You have the previous. You have the name of whatever the data is. And then you have the country or the currency. When you're looking at the folders here, this is telling you like a yellow folder is, I call it a tier 1. It's like a low impact piece of data. An orange folder is a tier 2, which is like a medium impact. And then the red folder right here is considered a high impact. So I just call it tier 1, tier 2, tier 3. And it's easier for me, especially because the way I see my economic calendar. So this is what my economic calendar looks like. There's a big difference between the information you get from a free service, which really isn't that much, a couple numbers here, better than nothing. But this is way more information. So you can see here, see how it has the 3 bars? that's considered, it's the same thing as a red folder. So that's why I call it tier 3, tier 1, right? Tier 2. So that's what I look at there. But I have the same thing, right? We have the poll, the Reuters poll, which is this is the forecast. Same thing as the forecast, the actual, and then we have previous or prior on my terminal. And then I have the name of it. I have the country it impacts, the time it comes out, and this is like the red folder right here, right? Tier 3. The extra stuff that you get with a terminal is the minimum, the maximum. I get the count. I know how many people are voting on that. I get smart economic predictions. So, and I also get the surprise number. It tells me if it came out as a surprise or not, to the upside or downside. That information right there that I just told you, super important. Understanding the minimums and the max, and you're going to understand why when we get into the 3-step process for trading economic data. Minimums and max are very important because sometimes you'll still get, like if the markets are expecting right here, like a 5.9, and we get a 6.0, technically inflation just came out higher than expected, but the markets are still okay as long as it's not above 6.3. So it's very likely, unless if you break that 6.3, you're not going to get a big move in the markets. We need to beat expectations. I'm going to talk about surprises in the markets as we get a little deeper. Here we go, trading economic data in 3 steps. So I'll actually make this another video, so that way this one isn't too long. We'll talk about trading economic data in the next video. If I can end this one. Okay, let's take off right where we left off here. Trading economic data in 3 steps. So there's a 3-step process that I always use when it comes to trading economic data. The first thing is the baseline and forecast. What are the markets expecting? I always want to know what the market's expectations are. This can go for anything. This can go to interest rates, which is technically considered economic data. This can go to news, but we're going to focus on economic data, specifically like inflation and stuff. What are the markets expecting? The second question is going to be, did we get a surprise, right? So when we actually, this is what I was saying before, the minimum and maximums. Like, I always want to trade a surprise in the markets because it's going to give us the best moves in the markets. So I want to plan for a higher than expected surprise and a lower than expected surprise. Then the third question, once again, monetary policy. Will this change the bigger picture? These are the 3 questions I always ask. Market expectations, surprise, higher than expected, lower than expected. Will this change the bigger picture? Those are the 3 things most important that I'm always focused on. Economic data helps paint a picture of an economy. I kind of touched on this before, but if we look at everything like 2020, remember we talked about the expansionary environment. We had low NFP. This is payroll data. This is employment data. We had high unemployment. We had low inflation, right? To 2020, that's pretty much what we had. Inflation wasn't high. We had people losing jobs, and that's shown by NFP, unemployment, other job data. 2022, jobs are coming in, unemployment's low, inflation's high, payroll's high, right? Complete opposite, right? That's also what shifts the market's expectations on what the Federal Reserve is going to do. So we end up going from expansionary economy to a contractionary economy, right? So here's an example of some data that came out. This is from my news terminal. So over here, overall, like not to confuse all these numbers, inflation came out higher, right? We got a actual came out 0.6, expected a 0.5, 6.0, 5.9. You can see here, this is also from my news feed, May CPI plus 1%, food and energy. Don't worry too much about all of these headlines. Inflation came out higher. Will this change monetary policy? Once again, this is always a question we're looking at. Let's just look at the market reactions, right? Now, this inflation, at the time of this one, it did, right? Look at this statement that came out. This is June 10th inflation. Barclay, which is a bank, they lifted its forecast for the terminal rate by 25 basis points. That just means 0.25% to 3 to 3.25. So basically, what they were expecting right here, analysts expect the Fed to raise its September by 50 basis points up from Goldman's expectation of 25. So they just increased. They were expecting basis points is just 50 basis points means 0.5%, just to clarify that. Basically what happened is inflation data comes out, right? Bank raises Fed rate calls after hot CPI. Inflation comes out higher. Now the market's like, oh man, yeah, the Fed's going to raise rates more, right? So now let's look at the market reactions. Well, actually, no, let's do a recap. I got ahead of myself here. So let's recap everything I just said. Inflation came out higher, right? Actual was 8.6%, expected 8.3%. Now there's a few different pieces here, year over year, month over month. So don't focus too much on each individual one yet, but inflation came out higher. Higher rates, we're now expecting the 50.5%, right? New expectations. what would I be expecting for market reactions, right? What am I expecting when that inflation comes out higher for US 30, the Dow Jones, the equities, gold, silver, dollar? What am I expecting for all of that to do? Now, we're going to get into this a little more when we get into like intermarket analysis. You're going to learn more about equities, dollar, how it impacts. But I already told you before, how do interest rates impact the US dollar? Think about it, right? Interest rates, higher rates are good for the dollar, right? So common sense would tell me at least I know the dollar should go bullish, right? And I'll just give you a little bit of secret sauce here. Gold is inverse the dollar. I'll talk more along that with intermarket analysis, but I should at least see the dollar gain strength. And this is exactly how we create a bias, right? I've planned ahead. I see the surprise data. I'm planning for a surprise to the upside, surprise to the downside. I see higher inflation. I know that means the Feds are going to raise rates more. I'm looking for dollar strength right off the bat. I also know, like I said, it's bad for equities. It's bad for companies. Remember I said that before? So even though we haven't got to the intermarket analysis yet, you still know it's bad for the Dow Jones, it's bad for the NASDAQ. Higher interest rates, higher inflation should cause a move to the downside. This is exactly what happened. Go look at June 10th, 2022, if you do not believe me, on your trading view. June, this is the NASDAQ. This is US 30, Dow Jones, same thing. This is all US stock market indices here. And then this right here is the dollar. Look how strong it went, right? You can see right here, June 10th, dollar gained a bunch of strength, right? So that's exactly what we're looking for. Those are the type of reactions that we're looking for. And that's how we create our bias. That's how we're trading that, right? Here's another quick example for CPI. This is Consumer Price Index and inflation rate. So you can see here, all this red just means it came out lower than expected. How do you think this is going to impact the economy, right? It came out lower, which means it's better for the economy and the Feds can maybe slow down their rate hikes, right? So this is recorded, so I hope I'm not talking too fast for you. The Feds can slow down their rate hikes as inflation drops, right? So this, I would expect the exact opposite. Dollar weakness, I'd expect gold, possibly mixed. I can explain that a little later. And then US 30 NAS to go bullish, right? So this is the dollar on that reaction. Obviously, this candle right here, dollar reacted as inflation came out lower, dollar weakened. Gold, super mixed, to be honest, but we have the spike right here. Let's make sure it's the same date, the 10th. Yeah. So we have the spike right here for gold as it spiked higher. Still kind of moved sideways though, didn't do all that much. So that is the three-step process for trading economic data. And I look at that for everything. So this is part of this PowerPoint too, but I'm going to make this a separate video as well, because now I'm going to talk about trading news and headlines and how that can impact the markets. Okay, where were we? Trading news and headlines. Taking right off, we're going to go into news. So this is going to be like, this is different than economic data. When we're talking about news, these are statements from political figures or central bankers. It's usually not planned or expected, and it needs to come from someone important, such as a decision maker, right? It needs to be new or additional information, and repeated information will have little or no impact on the markets. This is called pricing in, which we'll talk a little more about this on sentiment analysis. I kind of touched on it in economic data, right? When the markets already expect something, that means it's already priced in. That's usually why when data comes out as expected, doesn't really make much of a difference. If statements come out from a Federal Reserve speaker or from any central bank, it doesn't matter, or a political speaker, and the markets already know this information, typically the markets just don't respond. These are a couple of things that politics would say, right? We're going to war, we're going to lock the country down, we're closing the borders for air travel. Some of that stuff might sound familiar to you guys. These are things that central bankers would say. Inflation's out of control, right? That would mean they're going to look to raise rates. We need to see better employment numbers. Inflation isn't a concern at all. That means, like, I'll tell you right now, right? What would you expect? I'll ask you. If you see inflation is out of control, I'd be looking for stronger dollar, right? Because, oh shit, they're going to look to raise rates. If they come out and say inflation is not a concern at all, be like, okay, well, I'm looking for a weaker dollar, because they're not worried about inflation. They think inflation is going to continue to be fine. So dollar was likely to weaken. Now, I know that sounds counterintuitive, because technically it's actually good for the dollar that inflation is dropping, right? But it's not the case, because the markets like to be forward looking. If they think they're going to start cutting rates or lowering rates because inflation is not a big deal, you will see the dollar start to ease up. So a couple of things you want to understand when you're talking about news or headlines is sentiment analysis. Sentiment analysis is going to be very, very important. You want to understand risk on, risk off markets, as well as what impacts each, as well as how sentiment analysis impacts each asset you're specifically trading. So when we get into sentiment, you'll understand that a little more, but we'll do a few examples here. This headline right here, Putin announces special military operation in eastern Ukraine, right? So just common sense, market optimism, market fear. Would you think this would be good or bad for the markets? Someone announcing war, right? You don't even know what risk on, risk off means yet, but like market optimism or market fear. This is what the equities markets did, right? February 23rd, February 24th. You can see the date right here. NASDAQ. Market fear. NASDAQ drops. Gold. Gold actually did the opposite. It spiked to the upside and then continued for a long time, over 2,000 pips. We broke the $2,000 mark. We went up a lot because of this. And I'll explain exactly how gold reacts to this type of stuff, but these are reactions that we're seeing. And then the inverse, right? Let's see, US President Biden makes an address afterwards, right? This is February 24th. Biden says he's going to do a speech. Biden came out and said this: our forces are not and will not be engaged in the conflict. Our forces are not going to Europe to fight in Ukraine. Basically, all he said was, hey, this isn't our war. We're not going to war with them, right? So now, what do you think? Market optimism or market fear? Probably market optimism, right? This is a good thing. This is better. The markets were concerned about this. Now look what happens. US 30, same thing. The 24th, we have the same drop here from equities on the announcement of the war. We consolidate for a bit. It was around 2 p.m. that he made that announcement. The next day on the 24th of February, huge drive to the upside, a little bit of a pullback, continuations, right? So that is a market optimism move. This is a market fear move, all within 2 days, based off of those two statements, right? So that's why like these headlines are important, and yes, they're considered news, but if you don't understand risk on, risk off, market optimism, market fear, you're never really going to understand which way to trade the markets based off of these statements. So that's super important. COVID. So this is who flags, this is Omicron. So Omicron risk, travel curbs tighten. Basically what happened here is there were border closures. They found Omicron, it was like November 2021. Omicron was discovered in South Africa. All of these countries, which it says right here, South Africa, all these countries decided to start closing their borders. What do you think this would impact? Now, we're getting kind of ahead of ourselves with even asking this question, but just to show you guys, like, these headlines matter. Like, these things really do impact the markets. Think about borders closing. I can no longer fly to the UK because the borders closed. Everyone in the United Kingdom can no longer fly here. This completely destroyed the tourism market, at least temporarily, right? Take a look at oil. Oil is a commodity and it's impacted by supply and demand. This is November 2021. Look at the big drop that we had. Eventually it recovered once they started opening borders back up, right? But this is a really, really big drop that we were taking sells on, and then we get right back into the buys on oil because of this supply and demand. That's all that was. But the headlines is what tells us that. So this is a headline from Powell. He says the Fed could slow rate increases. I kind of hinted towards this before. Jerome Powell is the chair of the Federal Reserve. He just said that they're going to slow rate increases, right? So what do you think him saying that would impact, right? If you remember, increasing rates, it's bad for equities, NASDAQ, US 30. It's bad for, it's bad for gold. I haven't said that yet, but it's bad for gold and it's good for the dollar. So any of those would happen, right? So he just says, hey, we're going to slow down the rates. Look at NASDAQ. As soon as you say, and you can go check the date. There's a date here, November 30th, 2022. Go check the date if you don't believe me on NASDAQ, right? You can see the 30 here for November 30th, 2022. As soon as that headline came out, rocketed to the upside. Very, very good headline for equities when he said that. Dollar, same thing. November 30th, you see the date down here. Dollar ended up dropping, right? Remember I said it was bad for the dollar. So I don't have gold here, but gold, same thing. If you were to go look at gold, it went bullish here. This is kind of just a reminder. The steps to mastery take experience, time in the markets, and paying attention to the right things. Your brain right now might feel super, super scrambled, right? This is a lot of information. It was confusing to me at first, and now I'm teaching it. Now people pay me to teach them. You bought this course. I'm hoping you paid for this course. You're not someone who did some other shady shit to get access to this, right? But my point is, you can learn this stuff. If you're struggling with it, just get into the group. Come do this live with us. But my point is, I'm just ranting now, but like, This will take time, but just step by step, go through this a couple times, ask some questions, go through it again, ask some questions, take some notes, apply it in the charts, go through it again. It's going to take time. So some resources would be, I kind of talked on this before, economic data, calendars, my Forex Factory, my FX books, all these places you can find economic calendars and pip counters, pip calculators, all that stuff, right? A news terminal, once again, or news resources would be Reuters, Bloomberg, or Twitter. And Wall Street grunts. You want the number one resources, the number one resource for any of this stuff, everything I'm going over throughout this entire course, as well as being in contact with me and my team, which we're growing our team and other analysts. Wall Street grunts is the place for that. No lie. So let's get into geopolitical events, how that can impact the markets, and how we can look to trade those. So continuing on with geopolitical events, let's talk about how we can look to trade this and how it impacts the markets. Political factors within a country or between two countries and regions. This is what geopolitics and events are. Reading a little too fast, speaking before my mouth can talk. So geopolitics and events. These are political factors within the country, between two countries and regions, right? Geopolitics or politics, right? Political elections would be one of these examples, right? It can cause short-term volatility and uncertainty. It can change in government can mean a change in ideology for its citizens. This can mean a different approach to monetary policy. What the hell does that mean? So basically, if you have a new president that comes in, that's I want to do a lot of government spending. I want to do a lot of stimulus checks. Like I want to increase something along monetary policy or the opposite. We need to fight inflation. We need to raise taxes. We need to cut taxes, whatever the case. Political elections can impact a currency, right? So if you get someone who's extreme one way or the other, you can see an impact on the currency. Unplanned elections. There's an example. I will see if I have it in here, but there's an example when Boris Johnson was going through a no confidence vote. Boris Johnson is the old prime minister for the United Kingdom. So no confidence vote, corruption scandals, political tensions, these can all cause pressured or consolidated currencies. Unplanned elections, right? Political elections, same thing. Traders don't like uncertainty in the markets. They're more and more likely to see order flows flow out of that country's currency, right? So for example, something really bad happens in the UK, it's very likely to see the pound just consolidate, or you end up seeing it lose some strength and actually weaken if there's a lot of uncertainty in the markets for that specific currency. This is an important note too. Typically, these are short-term movements. They will recover, and after the event has settled. So what that means is, we're going to talk about this a bit when we get into sentiment analysis, but you have long-term and short-term sentiment. So the way the markets feel right now about what's going on in the United Kingdom, if there was something happening, that's going to pass eventually, and then we're just going to continue on with whatever else it was that was impacting the markets, usually monetary policy or the health of the economy, right? So these are typically short-term movements. Oh, here we go. UK lawmaker submits letter of no confidence in Prime Minister Johnson. So this is February 2022. This is what the pound did for a long time. Consolidated for almost a month. Yeah, a little breakout here, a little break back in, but like nothing crazy. It wasn't until, and I've showed you the headline a few times, I don't know if I have it coming up here, but this drop right here was from, you look at the date, 23rd of February, 24th of February, 2022. If you remember any of the screenshots I showed you, this is when Russia invaded Ukraine. This is what happened here, and that's what caused this move to the downside, and then we ended up continuing later. But we consolidated. I wasn't trading GJ this entire time because that no confidence vote was going on. I was waiting to see some type of decision, like something to happen. Took a long time. He ended up passing it. Geopolitical tensions. These are things like real wars. Iraq, your freedom, 9/11 is an example. Russia, Ukraine, 2022, another example here. Trade wars. Brexit is a good example on that one. They're not as likely to impact monetary policy when you're talking about geopolitical tensions. Typically, they'll impact risk sentiment, which we're going to talk on the next section, either the next one or two. I think it's phase 9. So we'll be talking about sentiment. It can impact fiscal policy, right? Fiscal policy is government spending. Monetary policy is the Federal Reserve policy. Interest rates and printing money. Fiscal policy is government spending. Depending on which countries are involved, different parts of the markets will be more heavily impacted. For example, let's see if I have it here. No, I don't. So if I'll show you the markets real quick here, if I go to the US stock market, we really didn't get impacted all that heavily when Russia invaded Ukraine. It was a war, equities dropped quick, but they recovered very quickly. But oil, on the other hand, because Russia is a very big producer of oil, it was over, let's get to it. It was here, right? February 23rd, 24th, super bullish, big breakout to the upside. We ended up recovering over time, but we held that strength for quite a while above the $100 mark on oil. So specifically, we see that impact on oil because Russia went to war and it's going to be a supply issue, right? So it increases the price of it. Physical war. Unlike what we just talked about here, geopolitical tensions, we have physical war, which, like a natural disaster, the impact is brutal. It's widespread. Infrastructure likely to be destroyed. If anyone's been paying attention to what's going on in Ukraine the last year or two, a lot of destruction going on. And the rebuilding efforts are often refinanced with cheap capital. So typically you'll see central banks go down to very, very low interest rates, right? Which results in a weaker currency. So you have two things happening. One, the nation itself getting destroyed, the physical nation getting destroyed, and then central banks lowering interest rates in order to stimulate the economy, in order to refinance the build, right? The rebuilding efforts. Yeah, and here we go here, the uncertainty. Huge level of uncertainty surrounding economic expectations is also another reason for the currency potentially to gain a lot of weakness. So this is right here, the United Kingdom votes. This is Brexit. We can see June 23rd, where they voted for it. And we can see we dropped, if you know how to measure pips yet, this is the pip measurement here, 2,500 pips. Look at this candle. One day. What a crazy move. 2,500 pips in one day. Huge move to the downside when this was announced. This is, I think, 2016. Yeah, 2016 for Brexit. Once again, this is gold. When Russia's Putin authorizes special military, this is basically what him saying we're going to war with Ukraine. We're invading Ukraine. Gold spiked over to the upside. And I will show you intermarket analysis, sentiment analysis. You'll understand market fear, market optimism, why gold goes bullish with market fear. We'll talk about all that. And then going into natural disasters, still talking about like geopolitical events, earthquakes, floods, hurricanes, kind of similar to when I was talking about war. It's going to have some type of infrastructure damage. So yeah, this can impact infrastructure, consumers' morale, and livelihood. Major factories, distribution centers destroyed, combined with the uncertainty that comes with natural disasters. They're all bad for the currency. We saw this happen recently in New Zealand a couple of weeks ago. They had a natural disaster that impacted them pretty heavily, and it caused the government to start spending a lot more, which actually weakened the currency. So you'll see things like this: a decrease in consumer spending, a decrease in consumer confidence leads to an increase in quantitative easing, right? So you obviously have to pay attention to the central bank. This isn't guaranteed, but we'll typically expect the central bank to come in and do something, lower rates or increase spending or something in order to stimulate the economy, right? So we have physical war, we have trade wars, geopolitical tensions, natural disasters. All of these things do impact the markets. Like overall, it depends who it is that's being impacted, what country, and that will obviously dictate the currency. And then when you're looking at commodities, that's going to dictate the commodity that's impacted, such as oil with Russia, Ukraine, for example. So now let's go over some real world examples. I covered a few here, but let's put it all together. We'll go over some real world examples for the final section for phase 7. Okay, let's put it all together. We're going to go over a couple of real world examples. I've shown a few already, and we just want to try to make some of this stuff a little more tangible, a little more realistic, right? So November 4th, 2021, this is one of my favorite examples because it shows both pricing in, like buy the rumor, sell the news type of reaction in the markets. So November 4th, 2021, the markets were expecting a 25 or 0.25% rate hike, and rate hikes mean stronger currency. The markets were already given hints of the rate hike on October 3rd. Now the markets waited for confirmation of the hike. So I'm going to cover this. I'm going a little fast. I want to see what this looks like. Okay, so what do we got here? Here we go. Okay, I want to make sure what the next charts were before I talk ahead of myself. So the first chart we're going to look at is this. October 3rd, 2021. We had a headline that came out and it said that the markets are expecting the first rate hike from the Bank of England. The very first rate hike from the Bank of England, October 2021. Now the actual decision, they ended up not doing it in November. So this is what I want to show you. When we go to this chart here, we look here, this is October. You can kind of see it down there. It says October. So this is October 2021. we had finally broken higher on GJ, and we blew to the upside, 800 pips to the upside. And this was on the weekend that this headline came out. And then on Sunday night, we took off and just took off the entire week for a couple weeks. Now, the actual rate decision is right here. They ended up not raising rates at all. They ended up pushing against rates. They didn't do anything. And GJ immediately ended up recovering that entire move. So that's an example of, even though the interest rates didn't happen yet, the GJ, the pound, still gained a ton of strength and still went super bullish, right? This is an example of pricing in. The markets like to be ahead. And then when we get the actual decision, which was actually a surprise, remember we talked about surprises, markets were expecting a 0.25%. We got 0. We ended up recovering this entire move and then some. Another example here. Let's talk Putin. I've mentioned this one quite a few times. Putin declares war on Ukraine. Expectations of market fear, right? So we're going to talk about how markets react in market fear a little later, but market sentiment, I've showed you gold a few times now. Gold went super bullish, like 2,500 pips or something overall. Like it spiked super, super strong because it caused a market fear. Gold is a safe haven. So I wasn't going to talk about that until we get to sentiment analysis, but gold is a safe haven. So when there's market fear, gold typically goes bullish. US 30. So this is the Dow Jones again. We went bearish. The move was actually right here. This is the night. It happened at night on February 23rd, going into the 24th. So this was the move here. Now we were already looking to sell it. Remember, going into March, we were already expecting the Feds to start raising rates. So we were already bearish on equities. But this move here to happen during Asian session when the US markets aren't even open isn't common, right? So this is what we ended up getting here when that played out. Bottom line. Let's cover some bottom line. Let's recover a little bit of this, right? The technical, even though you're applying fundamentals, even though we're talking about central banks, monetary policies, how interest rates impact all this, your technical confirms do not change. I still want to see breakouts. I still want to see shift of structure, right? I want to see something pushing in my direction. If I'm looking for the buys, like whatever it is, the lower lows, the lower highs, the higher lows, like all this stuff still matters. You got to pay attention to all this stuff still. Technical confirms don't change. All we're doing is we're significantly adding probabilities to our trades by understanding what's actually impacting the currency's strength or weakness. Whether it's a currency, whether it's gold, whether it's the equity markets, we understand what's impacting it. That's what's helping us. This helps us to be able to trade, plan for our trades for the entire market, not just one or two pairs. So you might hear the myth, or the people like to say, like, just trade one pair and learn that pair. I don't subscribe to that. I don't believe that. You can look at my charts here. If you're familiar with what charts look like, I have tons of charts. I'll trade anything and everything profitably because it doesn't really matter. As if you understand economic data for all the central banks, it's not that big of a deal. You can trade anything and you can identify more opportunities. So with that being said, congratulations. We finished fundamental analysis. Let's get right into market analysis. Okay, welcome to phase 8, intro to intermarket analysis. As always, we'll do a quick introduction. Let's talk about why intermarket analysis is important. And yeah, let's dive right into this. So intermarket analysis, what is it? It's basically identifying how one piece of the market can impact another. Believe it or not, the markets are completely connected and one thing will impact something else. And this is actually a superpower in the markets when you can play this right. But here's a little visual here, right? So central bank policies, let's do use a different color here. Central bank policies are going to impact government bonds. They're going to impact unemployment. Unemployment is also going to impact central bank policy, right? Politics impacts wars, which you've already seen will impact gold. Wars can impact a recession. Politics can impact recessions. Wars can impact inflation. Remember oil, like oil goes super bullish, that's going to increase inflation because oil prices go higher. Currencies is impacted by inflation. Inflation impacts currencies, right? Data impacts currencies. Unemployment is a piece of data. So I can go on and on and on. My point is everything is connected, all of this. So don't get it twisted to think that I can just pay attention to gold and I don't have to understand anything else, because the markets are the markets and all of this stuff does matter, I promise you. So the biggest disadvantage, like I was saying earlier, is not knowing what's going on under the hood of the markets. You're looking over here, but there's all this stuff going on over here under these clouds, under this all these squiggly lines here, right? So that's a huge disadvantage. You're going to gain a huge advantage just by going through this simple course, this simple section right here. One of the things I would say, which if anything, I would say this for every single slide, like just don't get overwhelmed. I'm talking fast. I'm going through this relatively quickly. This is recorded. I don't want the videos to be like long drawn out and like 50 minutes long, right? So just go through this multiple times, pause it, take notes, do all of that. Don't get overwhelmed. Ask questions if you want to reach out to me, Wall Street Grunts, any of my team, my partners, like ask us questions, take notes, research this stuff if you don't believe me, right? Don't get overwhelmed. You can learn this stuff. Regardless of the asset class you're analyzing, the starting point is the same. Sorry, that was a little rant. I wasn't supposed to say that on this, but you get what I'm saying, right? We care. Like that's why we say this stuff. Now, regardless of the asset class you're analyzing, the starting point is always the same. Inflation, growth, and monetary policy. These three things is exactly what you're going to be looking at. Inflation matters for currencies, inflation matters for gold, inflation matters for equities. Same thing for the growth of the economy or whatever nation it is for the currency you're trading. Same thing for monetary policy, right? These three things matter. Inflation, growth, policy. Now, if we're talking about these three things, these will help understand where each of the asset classes are going or might be going. Kind of hinted at that already. Currency classes have the exact same drivers as other assets. And like I said, inflation is going to impact the US dollar, just like it's going to impact the Dow Jones, just like it's going to impact NASDAQ. Same thing with interest rates. But when it comes to the markets, it's never just one thing moving. There are no certainties, but there are probabilities. We're just trying to increase these probabilities. That's it. I want probabilities in my favor. So I'm going to do everything in my power to learn every piece of the market I can that might be impacted, right? That's super important. So the key takeaway for intermarket analysis, it's always a whole spectrum of assets that are impacted. And you're going to see this as we move forward. Understanding how they're all connected will help you have a much clearer understanding of the markets and how to trade them. Let's get right into the bond markets. We'll talk about the bonds a little bit, and that's it. Let's go. The bond markets, 8.2. Let's get right into this one. What is a bond? I've said this before. You can think of a bond as an IOU or a loan. When a government or companies can create bonds too. When a government or companies want to generate additional capital, one of the most popular avenues are selling bonds. Now, we're obviously going to be using the government as our main example, but companies can also create bonds if they want to raise money, and they can sell bonds as well. So how is a bond created? You have the bond issuer, right? In this case, we're going to be talking about the government. So you have a bond issuer. They create this thing called a bond, and they have the bond holder. In this case, we'll talk on the Federal Reserve, right, for the US. The bond holder purchases the bond and gives them money back. Now, let's talk about some terminology. Does that make sense, right? I don't want to skip on that, right? They create the bond. It has terms, which we're going to go over the terms and what they look like. And then we have the bondholder that pays for the bond, gives the money to the bond issuer. That's it. Now, bond terminology. This is what terms look like, right? You have a 10-year bond, $1,000, a 10-year bond at $1,000 at 2%. So you have what's called maturity. That's what the 10-year is. Now, maturity is the lifetime of a bond. How long from the issue date to when the issuer, in this case, the government, needs to pay it back. So here's a quick example. If the government gives the Federal Reserve a 10-year bond, that means after 10 years, I need to pay back $1,000 or whatever that dollar amount is, which that'll be the next thing should be the principal, right? So whatever the principal is, we'll talk on the principal now. The amount the bond was purchased for. Also, the amount that the bond issuer will have to pay back to the bondholder on the maturity date, right? Makes sense? So now we have two things. We have the maturity date and we have the amount that it was purchased for. So the government has to pay the Federal Reserve back $1,000 after 10 years. Make sense? And now we'll talk about the coupon. This is also the percentage. This is the interest rate that is payable by the borrower, which in this case, once again, the borrower is just the government, the US government. Coupons are fixed and do not change when issued, right? So this 2% will never change. We're going to go over, I think the next slide, I have a real example of this, but what this looks like is we're for 10 years, we borrowed $1,000 and we're paying 2% on that. So it's $20 for 10 years, $20 at 2%, right? And then we have one more thing, which is the yield. Now the yield can change. The yield is the rate of return when the rate of return you get on a specific bond. The price of a bond and yield of a bond are inversely correlated. What that means is if the price of the bond goes up, the yield goes down, which is my rate of return. Basically, if I pay more for a bond, that means the yield, my return rate, is going to go down. So you have two different markets here, which I don't talk about on here. You have the market you have the first-hand market and the second-hand market. The first-hand market, the typical person cannot buy. It's just funds, private equity. You have to have special access to buy them. But bonds are sold on the second-hand market, right? And called the gray market, I think it's called. But second-hand market for bonds, the prices of them change. So that means the principal or what you're paying might change, but the amount, the coupon isn't going to change. So let's look at what is this really that relevant for trading? Yes. Do you need to know these specifics? Not really. So like, don't get too hung up on memorizing all of this. For me, like I couldn't tell you this exact definition of all of these off the top of my head. I know how interest rates impact it, which we're going to talk about, but for the most part, like unless I don't trade bonds, but they are very, very useful when it comes to intermarket analysis, which we're going to get into because there are some correlations that bonds have that are very important to us. So we're going to talk about that. So let's look at some examples, right? We have the 10-year bond, $1,000 at 2%. $1,000 is paid to the government. The government now pays the Federal Reserve $20 per year for 10 years, right? After 10 years, the issuer, once again, the government pays the holder, which is the Federal Reserve. So the government pays the feds $1,000. Remember that principle. So in total, they've paid $1,200. The Federal Reserve has now made $200 after 10 years. Not a great return, right? I wouldn't be happy with that. But this is how it works. That's what the terms will look like. So let's look at a formula real quick. This should make it more clear on how the yield is inverse what you pay. Like the yield is inverse the price. So you have your annual coupon payment, right? Remember that 2%? It doesn't change. No matter what, I'm getting 2%. And then you have your current market price, which changes. The secondhand market price will change. This is going to give you my current yield of a bond in percentage. Makes sense? So we're going to divide these two and it'll give us this. So let's look at some examples. Let's say $20 coupon. The coupon, once again, like this coupon is not changing. It says 2%, but it's $20 for a $1,000 bond. So it's stuck at $20, not 2% of whatever you pay, just to clarify that. So you have a $20 coupon at $1,000. It gives you a 2% yield. But what if I pay $1,100 for that, right? So that means the bond, this is the government bond, right? The bond goes up, the price of the bond goes up. Now my yield is only 1.8%, right? Because I just paid more for a bond. I'm still only getting $20 of the coupon, but now my yield drops, or also known as my rate of return. What if I pay $900? Now I'm getting a 2.2% yield, right? So now the price goes down on the bond, my yield goes up. Make sense? That's why there's an inverse correlation there. The price of the bond is inverse the yield. That's really the most important thing to understand. Interest rates and inflation have a huge impact on the value of bonds because interest rates are going to determine what the new bonds, like you have the primary market and the secondhand market. If the primary, let's say the Feds just raise interest rates. If the Feds raise interest rates, that means the new bonds are going to be at a higher rate. I'm going to get a higher coupon, right? 4 or 5% or something. If my little 2%, my $20 coupon is, not that great, it's going to end up dropping the price, right? Because now the new bonds are going to be more attractive. So the yields of these actually will go up. You'll see as the Feds start raising rates, we see yields go up. The reason the yields are going up is because the secondhand market for the bonds are actually going down. It drops the price for government bonds, makes them less attractive, but it gets people who want to buy them at a better price because now your yields are better. Your yields are higher, rather. Make sense? The reason bonds are important, they're a fixed payment investment and considered a very safe asset to invest in. I would say probably one of the safest assets to invest in, especially the US. The bond yields are inverse to bond prices, which I just explained. Because, that's the reason this is important. If I bring up my chart real quick, we're looking at yields. Like if I put up, this is the US yields here. The bonds, see on the background says US government bonds. This is the yields. It's looking at it's called bonds, but 10-year yield. So you can see over to the right here, the percentages. It's telling me the percent of the yields on a 10-year bond, right? So they're inverse. And I'll show you some screenshots of this right here, the correlations. It has a positive correlation to interest rates. Remember, I said yields go up, rates go up. Dollar, same thing, because interest rates are good for the dollar too. So typically, this isn't 100%, but typically they do move positively correlated. Inverse correlations, equities, Dow Jones, NAS, SP 500, and gold, right? So if you're talking about interest rates specifically, we haven't gotten to risk sentiment yet, but interest rates specifically, as interest rates go up, yields are going to go up. As yields go up, it's going to pressure gold and equities to the downside, right? So this is the intermarket analysis stuff that's super important. I want to see, like, the markets are all connected. I want to see this playing out. That's what's going to tell me how the markets are reacting. Nothing in the market is 100%. This helps immensely. I kind of just hinted at that, but this is when the Fed started raising rates. March 2022, right? I've talked about this a few times now. You can see down here, March 2022. Look how bullish the yields went. Like, yeah, we get some pullbacks, but overall for the entire year of 2022, super, super bullish on yields. Government bonds just kept dropping because the Fed just kept raising rates. So the yields kept getting higher and higher. US 10-year and the dollar. So this is the yields in the dollar, right? It's not 100%, but you can see overall very, very close correlation. As the dollar goes up, so do the yields. You get a little bit of pullback here, still continues higher, eases off a little here, right? So very strong correlation between these two. Gold inverse correlation, right? Compare these two, right? Look at the dollar and the yields. The dollar is the yellow one, the yields are the white one. Same thing here. Yields are the white and now gold is yellow. Look at the difference, right? It's not going to be exact once again, but you can see how we have this push to the upside, push to the downside, right? We have this push up here on gold, push to the downside on the yields. So there is an inverse correlation between gold and US 10-year. Next, let's get into equities. Yeah, let's get right into equities. I want to make sure, like, I covered everything here, but let's go to equities. And this is recorded. So if it's too fast, go back, play it, pause it, take notes. I'll see you guys at equities. Okay, 8.3 equities. Dive right into the equity market for intermarket analysis. So what are equities? They refer to shares or stocks of an individual company. Apple, Google, Meta. A couple examples for shares or stocks of an individual company, right? Now, we have equity sectors. There's about, well, let's tell you what they are first. A group of stocks that have a lot in common with each other, usually because they're in similar industries. There are 11 sectors. So I'm going to cover them here. Don't worry too much on like memorizing them. This is more like a nice to know thing. If you're trading individual stocks, I guess that's different, but we're not going to be covering that. But I'm going to breeze through these. If you want to pause them, write everything down, fine. But we have materials, right? Construction materials, metals and mining companies. We have utilities. These are all sectors, right? Companies all fit into these sectors. We have utilities, water, electric, gas. It's considered a recession-proof industry. Fun fact. Real estate, we have healthcare, pharmaceuticals, medical devices. We have energy, companies that refine, produce, and sell energy resources. Then we have customer staples. These are companies that involve food, beverages, and tobacco, producers of household goods, personal products, also considered recession-proof industries. We have customer discretionary. These are things like wireless, telecom networks, media, entertainment companies, industrials, companies in aerospace. We have communication services like wireless, telecom, media, internet companies, information technology. We have financials, investment banks, financial brokers, asset management companies. And that's it. I know that's a mouthful there, but you don't need to memorize all these. You want to screenshot this? You got it. It's in front of you. You have all 11 of them right here, right? So that's all the equity sectors. Now, when we're talking about equity index or indice would be like the plural of this. I call it equities regardless, but equity index, indice, whatever. This is created by selecting a group of stocks representing a particular market or segment. The selection criteria varies, but typically includes market cap, sector, and geography. And we're going to cover all three of those, the sector, the market cap, and geography. After the stocks are selected, they're weighted according to the criteria set by the index provider. So we'll cover what that means. These are a few examples: Dow Jones, which is US 30, S&P 500, and the NASDAQ, also known as NAS 100. So we're going to cover those. And if you look at the numbers, remember we said it's a group of stocks. The Dow Jones US 30 is 30 stocks, 500 stocks in SP 500, NAS 100 is 100 stocks, right? So that's what that is. That's what the numbers mean. Equities are weighted in two different ways. Well, or indices, the index are weighted in two different ways. Like I said, I call it equities. It's just terminology, nitpicking, whatever. It's just US equities is what I refer to them as. So we have market cap weighted, which means the stocks with a higher market cap will have a higher weight in the index. The stocks with a higher market cap is going to be listed higher in the index. And then we have price weighted. What this means is the stocks with the higher share prices are given greater weight in the index. So basically it's going to be listed higher. Now these do vary, right? You're going to have one day Apple might be number one, and then the share price drops. Apple's going to go down to number two, right? It's not going to be the exact same companies, number one, number two, number three, all the time. This changes. We're going to analyze equities in 3 steps. It's very simple. Growth, inflation policy, country, right? This is whatever country it is, right? And we're going to talk about these a little deeper for each one. But remember, we talked about growth, inflation policy in the last section. Even in fundamentals, it doesn't change. Sentiment is going to be a big deal, which we're going to talk about in that in phase 9. Market optimism or market fear. You guys have already seen, if you looked at any of the other videos in the fundamentals, I showed you a few times where market fear and market optimism caused equities to drop or go bullish. And then the top 5 companies that are listed in each index is going to have the highest impact on the equities or on the index, whatever you want to say. So the top 5 is important as well. Earnings, well, I'll get into that. So NASDAQ, let's break down NASDAQ real quick. We're going to break down a few more just to give you guys an example of how we'd be looking at this. So NASDAQ 100, the country, United States. It includes 100 of the largest domestic and international non-financial companies listed in the NASDAQ. Reflects companies across major industry groups, including computer, HWSW, telecom, retail, wholesale, trade, and biotechnology. Hardware, software. I was like, what did I write HWSW? It's hardware and software. So I had a little bit of a brain fart there. The index is market cap weighted. So we are market cap weighted, which means the companies with the highest market cap is going to be at the top of NASDAQ. Understanding where the overall expectations for the US economy is will be important, right? Once again, growth, inflation, economy. So this is a quick breakdown, right? Just to show you what it looks like, you can see here, we're 63% technology weighted. Number 2 would be consumer services with 19.56%. This does change, right? It's going to vary. If you looked it up in like a year, it might be different. But for the most part, we're very, very NASDAQ is a very, very heavy tech index. Once again, it's market cap weighted. The reason it's important is because if we know there's an event that's going to happen or hit the tech space hard, we can understand and expect it to impact or have an impact on NAS 100. So it's important to know that there is a very heavy tech stock. As of the making of this video, like I said, this might change. The NASDAQ top 5 is currently Apple, Microsoft, Google. You can see their market cap here, 2.7 trillion, 2.3 trillion, 1.5, Amazon, and NVIDIA, which actually, as of today, NVIDIA's gone over $1 trillion in market cap. So this actually might be different now, this number. They might have actually passed Amazon or something, but NVIDIA is over 1 trillion now. So might change by the time you watch this, but that's, as of right now, these are the top 5. Once again, these are the companies that we want to watch. Good news, bad news can impact NASDAQ because it's so high listed in the index. So looking at Dow Jones, US 30, it's supposed to be a parenthesis there. United States represents 30 large and well-known US companies covering all industries except for transportation and utilities. This index is price weighted. That means the share price is going to determine which companies are ranked the highest. Understanding the overall expectations for the economy, very important. So break this down to, we have technology-based, 47%, right? So we're 47% technology. This is price cap weighted though. And then we have consumer and financials, kind of dead even at 12%. And then we have healthcare at 10%, kind of drops off from there. So that is just a quick breakdown of the Dow Jones. These are the top 5. You can see their share price here, 490, 318, 308, 209, United Health, Goldman Sachs, Microsoft. Once again, this changes. It varies. As the companies have earnings reports or something happens, they're going to go up and down, right? You can see there's a percentage change here. They change daily. So they're not huge variations, but last I checked, I think Goldman Sachs actually is number 6 now, but that's that here. And then the FTSE. So we have the UK 100, and this is going to be, FTSE is for United Kingdom. It stands for Financial Times Stock Exchange 100. So 100 companies in here. A share index of the 100 companies listed on the London Stock Exchange with the highest market capitalization. So UK is for the United Kingdom, or FTSE 100 is for the United Kingdom. If you can hear my dog barking in the background, I'm sorry. I'm not going to stop because I really want to finish this. But if she's barking, you can hear it. I don't think you can, but this mic is pretty good, but she's distracting me. So the UK 100, right? This index is market cap weighted. So this is going to mean that the companies with the highest market cap is going to be listed at the top. Understanding this is the same thing for the US, right? Understand where the overall expectation for the United Kingdom and the economy will be important. Once again, growth, inflation, and policy, except now we're talking about the United Kingdom. This is another breakdown. It's actually much more evenly distributed, right? So we have the equity sectors here, 18% financials, 17% basic materials, 16, almost 17% for consumer goods, and then oil and gas. So much more balanced, right? So this means here, one sector being hit may not really impact the FTSE 100, the same as something like Goldman Sachs would impact Dow Jones. It's much more evenly spread around here. So these, as of right now, these are the top 5 here. Fun to know. You can just Google the top 5 or the FTSE, like top FTSE 100 companies ranking by market cap, right? As of January 2023. You can Google that exact term and you'll find the top 5 or the top 100 in that list. So when we're analyzing and trading equities, you guys remember this, right? We already talked about this. We're going to break this down a little deeper and go into like each of these, the country, the sentiment, and the top 5, how we're going to trade them. Now, let's talk about growth. What are the markets expecting from the country's 3 pillars, right? The growth, inflation, what I have here, growth, inflation, and policy. What are the markets expecting? The best situation for equities is when growth and inflation are expected to increase. So we have both of them going, right? Because remember, these are companies, right? So if growth is going higher, cool. We have a lot of people buying things. We have a lot of economic activity, and we have inflation going higher. That means there's more currency circulating the economy. So there's more liquidity in the markets for these companies. Perfect. Growth and inflation going higher, good for the equity markets. I've got it here. Better economy, higher demand, higher profits. That's pretty much all that is. Inflation. I kind of talked about this. I got ahead of myself here. Inflation, higher profit margins, more liquidity in the marketplace. I just said that. Typically good for equity markets unless it's causing a central bank to act towards fighting inflation. That is the one caveat. Remember, I talked about how the markets are forward-looking in nature and they like to price things in. We'll look at Dow, actually, I like NASDAQ better, but if we go look at NASDAQ, the Fed started raising rates in March 2022. So if we go back to March 2022, August 2022, March 2000, April. Okay, so here we go. It was around February, March over here. Every time we got higher inflation, NASDAQ did something like this, right? Even though inflation, like I just said, technically is good for it, but every time inflation came out higher, the markets were like, oh shit, that means that they got to keep raising rates. Equities drop, right? But if you go look at when inflation was actually increasing in the market, the Feds weren't doing anything. We're going to go back to 2020, 2021. Look what was going on here, right? If I go to a higher time frame even, you can see a lot more here. Look at how bullish, ever since they cut rates down in March 2020, super bullish. And inflation was increasing this entire time. It wasn't until March 2022 where the Fed started raising rates that now we started getting this really choppiness and coming back down to the downside on NASDAQ, right? So unless it's causing a central bank to fight towards inflation. I kind of already explained it, the pricing in concept, so we'll touch on it again in phase 9. Monetary policy. Interest rates impact the actual companies in the index. I've said this already. Lower rates make borrowing capital cheaper. Remember, higher rates do the opposite and can hurt profit margins and earnings reports. This is why it's negative for equities. Quantitative easing, quantitative tightening also impact liquidity in the marketplace. I just showed you that. When it was March 2020, they were doing quantitative easing. They were injecting a ton of liquidity in the markets. That was good for equities. Oh, look, we got a screenshot. Sometimes I forget I put this stuff in here. So I just showed you this, right? SP 500, NAS, US 30, all of them, super bullish. You can see the year here, 2020, the entire time with quantitative easing, very bullish to the upside. And here it is, low interest rates, high quantitative easing, low inflation, although it was rising, and we had high spending and low or stagnant growth. Now, when we look at this, very choppy, a lot more downside happening here, some pullbacks, more downside. We were raising interest rates. We had quantitative tightening happening. We still had high inflation, although we were trying to fight it, right? It was dropping. Slowdown in spending, slowdown in growth. Completely different environments, completely different moves in the markets, right? Now let's talk on risk sentiment. What impacts equities, how to trade them? So we talked about the growth sector for the economy, risk sentiment. Equities are considered a high-risk asset. I'm going to explain this a little deeper on how high-risk assets and safe havens work in the sentiment analysis section, but they're considered a high-risk asset. That's the most important thing to know now. Usually the first movers in sentiment analysis they're more volatile, meaning that they move first. They're usually the first movers. Risk sentiment is universally global, not country specific. What that means is, that's why when you look at my chart here, I have global equities here. This is US, the top 3 here. We'll zoom out a little. So NASDAQ, US 30, which is Dow Jones, SP 500. And then over here, I have Euro, I have China, I have the UK is the FTSE 100 here. And then I have Germany, the DAX 40. And this is a volatility index, which I'm going to cover in the sentiment analysis. Or no, we're actually probably covering it here. No, we'll be covering the sentiment analysis. We will be talking about the VIX, the volatility index. We always need to understand the global macro environment. Risk-off markets, typically, like I showed you the Russia-Ukraine thing, risk-off means market fear. Typically, equities will, I'm sorry, other way around. Remember the Biden speech? I said that too fast because the red is what threw me off. Oh, this is backwards. Oh, this is, okay. Okay, let's scratch this real quick. Don't write that down. Typo. Risk-off markets, equities will push down. So let's just, I'm not gonna fix that right now because I've already gone through this entire thing. So you got to bear with me. Equities will go down, right? Risk-off markets, market fear, Russia invaded Ukraine, equities will drop. Now, remember the Biden speech? When Biden speaks and he's like, hey, look, we're not going to war, that's a risk on market. Equities push up. Remember the example I showed you a couple sections ago? That's exactly what I'm talking about here. Equities will push down risk off, they'll push up risk on. And they're typically the first movers. So as far as examples go, we're going to have tons of examples. I've been giving them throughout this whole thing too. And then let's talk about earnings. Let's talk about the top 5. Earnings reports. You want to understand the following. Which company may impact a certain index? That's basically identifying the top 5, when the earnings reports will be released, and what the expectations are and what the actual report comes out as. Remember I talked about the 3 steps? Expectations, and then the actual, right? And then we can also go deeper into the bigger picture. This is what I'm talking about here. Same thing for earnings reports. So typically during the first month of a new quarter, which is January, April, July, October, typically, not always, typically that's when earnings reports comes out, but it varies depending on which company you're talking about. Where I mean, you can actually look here. TradingView has it too. If I was to scroll, like this is Google right here. You can see on the bottom, there's a little E here. If I click that, it's earnings and revenue. I don't know what happens if I click this. Oh yeah, I've never clicked this before. So it gives you a little bit of data here. But the thing is that this is after the fact. I don't know if it'll let me go back. Okay, here we go. Yeah, so that's after the fact. So I don't know if it'll tell me like a future report. I'll do it right now. Let's see ahead of time if it tells me future. Go to Google. Because it tells me the next one. Yeah, here we go. July. Yeah, so the next one will be in July. And it tells me the estimate right here. The estimate, I'll show you a screenshot too on what this looks like, but earnings whispers or TradingView, those are the two places that you can catch that. So how to read them. You want to pay attention to revenue, earnings per share, cash flow, dividends, stuff like that. That's what's going to give us, because you're going to get an estimate for them. So this is a screenshot of it. You can see here, we have the consensus or the estimate. That's not the best color to use on that. Right, we have the consensus and estimate 1.96 per share. That's and then this is earnings per share. That's what EPS stands for. Revenue surprise 3.7%. Right, so we had a surprise to the upside on this. This was meta earnings. Look at that. Look at the reaction you had in NAS. And then it consolidated. This was at 2 p.m. I remember this coming out. It was like 3 p.m. and New York closed almost. End of the day, not much volume. You can see we got the reaction and then just kind of consolidated. But markets open tomorrow. Now we get that push to the upside, right? We get those continuations. So this is going to be one of those reactions that we got from an earnings report on the positive side. This will be more of a negative one. Meta share price wipe out, shakes out World Tech Stocks. So this is when, let's see if it has the reason here. Yeah, they were blaming Apple's privacy changes and increased competition for their ad revenue dropping, right? So if you look here, this is the only difference. Now they both dropped, but the biggest difference is the percentage. NASDAQ dropped 5.6%, 5.69% right here, where US 30 Dow Jones only dropped not even 2%, right? Bigger difference in NAS, bigger drop in NAS. Meta is listed higher in NASDAQ. So it actually impacts NAS, but it still impacted risk sentiment overall. We got a pullback, right? Here's another one here, just another example. This one wasn't as big of a move, but it's still good to know. Goldman Sachs reported earnings of $8.78 per share with a revenue of 12 billion, right? But then it says the expected was 8.14 a share with a revenue of 12.7. So what happened here is you can see they had a surprise to the upside on the earnings of per share, right? Earnings per share 8.78, they were only expecting 8.14. But the profit, the revenue, 12.2 billion is what they reported. 12.76 is what was expected. So we can see here, analysts pointed to lower than estimated expenses as one of the reasons for bigger than expected profits. So basically, they had higher profits. We had lower revenue, but higher earnings per share, and we had higher profits for that. So you can see the reaction right here. This is when that happened. It didn't hold. It didn't do anything crazy for US 30. US Dow Jones didn't go like ridiculous to the upside. But if you're trading it, you're more likely to be watching this and looking for buys on US 30, not sells, right? Because the data, the report wasn't bad. So how deep and how much the market's going to move off of that, we can't really decide that. But at least you know the direction, right? You have an idea for that. So next, let's deep dive into commodities. I know this was a lot. I know this is a super long one. I try to make them quick. I try to make them short. There's not really a way to do it. So I hope it was helpful. Just go through the recording again, take some notes, hit me up if you have any questions. But yeah, let's get right into commodities. Okay, commodities. Masterclass 2.0. Let's get right into what are commodities. Basically, we got natural resources or goods, raw materials, agricultural products. So let's break this down a little more deep. Well, a little deeper. We have two groups of commodities that we're going to be talking about. Agriculture. These are things you need to farm for: grains, wheats, soybeans, etc. You can trade these. I don't trade wheat. I don't trade grains. I don't trade any of this stuff. So where we mainly focus is non-agricultural. Excuse me. Things you need to mine/drill. These are things like oil, gold, silver, energy-based commodities. Non-agriculture commodities, mainly where my focus is when it comes to trading. The major commodities in each sector, precious metals, I mainly focus on gold and silver. Energy, WTI, oil, crude oil, whatever you want to call it. Base metals, copper. I don't typically trade copper, but we are going to talk a little bit about it here. And when we're looking at the main drivers, like what are the main things that are actually driving commodities? We have the dollar, inflation, supply and demand, risk sentiment. And it's going to vary depending on which commodity you're looking at. So we're going to break a few down, mainly gold and oil. But this, give or take for commodities, this is what is going to determine the direction of commodities. So looking at the US dollar, the majority of global commodities are priced in US dollar, right? Oil, gold, copper, iron ore, these are all priced in US dollar. So if the dollar rises or falls relative to other currencies, that directly impacts the value of those commodities for the countries that must purchase in US dollar. So I'll give you a quick example. Let's say UJ, the dollar gains a ton of strength and the yen loses a bunch of strength, but Japan needs to buy a bunch of oil, right? That oil is priced in the US dollar. That means it's going to take more Japanese yen in order to purchase the same amount of oil now because the dollar has increased in price. Understood? So when we're looking at the exchange rates, it's also going to have an impact on what the countries have to purchase as well. When we're talking about the specific prices of, now I don't typically trade, well, gold I do, so I'll wait before I say that, but typically dollar goes up, commodities goes down, dollar goes down, commodities go up. So what this means is if the dollar gains strength, the US dollar, that means I can buy, let's say barrels of oil, for example, right? I can buy more barrels of oil with less dollars because my dollar has gained strength. If the inverse happens, if the dollar loses strength, now it takes more dollars to purchase a barrel of oil, right? So there's an inverse correlation there between the dollar and commodities. This means the US, I got ahead of myself again. This means the US dollar has a strong inverse correlation to commodities, like I just said. So this is just a chart to show you gold. Now, gold is the white one and the dollar is green, right? So you can see there's now, these are both safe havens, which we're going to get into in sentiment analysis. So there are times where they move together, but typically for the most part, we see the strength you see in gold here. You see the weakness in the dollar as the dollar sells off. You can see it again here as dollar was going up, gold is coming down. And then you even have the cross here where gold drops. And I mean, yeah, gold drops and dollar goes to the upside, and then we have the cross again. Here, we actually have a divergence here where we were getting the, no, this isn't, the divergence is actually there. So that's not that big of a deal. But yeah, we won't talk on the divergence yet because there's something else with the dollar. But for the most part, there's an inverse correlation between gold and the dollar. Now, this is oil and the dollar. I typically don't trade the dollar against oil. You can see an inverse correlation, usually some extreme examples. Like here, oil spiked to the upside during Russia-Ukraine. Dollar ended up dropping. I'm sorry, other way around. This is dollar here. And this is actually COVID. This isn't going to be Russia-Ukraine. That's COVID spike. Dollar spike to the upside. As dollar loses value, oil is gaining strength. Honestly, that's more of a supply and demand thing than it is the dollar, but there is an inverse correlation there. I don't look at it to trade it, though. This is a nice to know thing more than I'm going to trade oil based off of this type thing when it comes to dollar. It's better for gold, and we'll talk about that. So inflation, how inflation impacts commodities. They have a strong positive correlation. Oil has a positive correlation to inflation for one reason. Gold is something else. We're going to talk about both. But rising commodity prices is inflationary, right? Falling commodity prices is considered deflationary, right? So as inflation expectations drop, commodity prices typically drop with them. So you can see here, very, very strong correlation. This yellow line is inflation expectations. Very strong correlation. They almost match 1-for-1. Inflation expectations drop all of 2022. Gold is dropping with it as the Feds are raising rates. It's not the dollar in gold. This is where we see the inverse, the breaking correlation. Inflation expectations were dropping here, but gold was still going higher. That is because dollar was dropping with inflation expectations, but dollar was dropping so aggressively, it was actually driving gold higher, right? So gold has a very strong inverse correlation to the dollar more than oil does. So that's why you see here, it's very, very strong this entire time. But here, you can see how it drops and we get the spike. It's because of the dollar. 100%, the dollar ended up losing a lot of strength and it ended up forcing gold to the upside. Oil inflation expectations, once again, very strong correlation. You can see they follow each other very closely. A drop in inflation, drop in oil, that was COVID again. And you even get the spike here. This was a Russia-Ukraine war, the spike in inflation expectations, the spike, and then we just kind of slowly chugged to the downside along with oil and inflation expectations. Supply and demand. How does supply and demand impact commodities? Now, it can be, when you're talking about supply and demand, I believe we've talked about this before. If not, we're going to mention it a few times. It can be impacted by multiple things. We have weather, politics, geopolitics, as well as distribution and or production. So really supply and demand, I'll explain specific examples here, but yeah, let's get into real examples because we're going to cover gold and oil a little deeper. So those are the main things that really are going to impact supply and demand. When we're talking about commodities, we're talking about things that are used in the real world, especially oil. But gold is used in computer chips. Gold is used as jewelry. It has real world use. So these things, weather, supply and demand, distribution, politics, this is all going to impact the supply and demand of these commodities, right? Typically, this goes with anything, not just commodities, but as the supply of something goes up, and the demand of something goes down, what do you think happens to commodity prices, right? As we get an increase in something, but the demand of it, people don't want it, prices are going to follow demand. Commodity prices go down, right? So supply and demand, we get a demand drop or a supply increase, commodity prices drop. Now, the inverse would be, let's say demand goes higher, supply drops, we're going to see commodity prices increase, right? One thing that's important to note is both do not have to be impacted together. It can be one or the other, and prices will still be impacted. A good example of this is like the demand from a day-to-day perspective, the demand doesn't change for oil. But OPEC, which we're going to talk about, they control the supply of oil. So if they drop the supply, we can see commodity prices increase, even though the demand doesn't have to increase too. The demand's there. Oil is there, right? People need oil for transportation. But then again, if I go, let's take this one step back, because this actually happened this week as I'm recording this, we had really bad data come out from China. China, those fears caused a big drop in demand. I'll show you what the chart looks like, actually. It's called PMI data that we had from China. And oil recovered a little bit of its move because we had headlines come out. That's what the buys were here. But we recovered most of the move. But this aggressive drop here, this came from the China data, and it dropped demand. What happened here, Goldman Sachs came out with a headline. It was just an analysis. It ended up spiking oil during New York session. But this drop here, I ended up taking some sells as we got lower because I missed the move during Asian and London session when that came out. But the buys played out, sells played out. But this is a demand thing. Supply hasn't changed yet. I'm waiting for supply to change as of the recording of this video. But as of right now, the demand dropped, right? Because China is a very, very strong manufacturing industry. If they have bad economic data, it's going to pressure oil to the downside because they demand oil a lot, right? So the demand drops, commodity prices drop. That's what happened to oil as of today. So good example right there to actually be talking about oil and supply and demand, which we're going to talk more on oil. We're just covering the basis right now. We'll do specific on gold and specific on oil. Risk sentiment. Gold and silver are safe havens. A risk asset is oil, and then an indicator is copper. Now, you're going to understand this a little deeper when we get into sentiment analysis. We talk about risk assets, safe havens, risk on, risk off, market optimism, market fear, all that stuff. And Doctor, do I have it here? No. So yeah, more in phase 9, right? So make sure copper, just to give you like a little insight on it. I don't focus on it too much while I'm trading, but it is considered, they call it Dr. Copper. If you ever hear anyone call it that, it's considered an indicator. So I have it here in my commodities tab here, copper futures, HG1 exclamation point. It's considered a forward-looking indicator for risk sentiment. So when we're getting into risk sentiment, it's considered to be one of the first movers. I don't typically use it in my analysis, to be completely honest, especially from a day-to-day perspective. I haven't found it necessary. It's really just consolidating here. This doesn't tell me much, but once again, the markets did kind of consolidate today too. Just getting some pullbacks here. But yeah, for the most part, Dr. Copper, it's considered an indicator. If you want to use it in your analysis, it's going to be a risk sentiment indicator. But oil is a risk asset. Gold is a safe haven. But they do both follow inflation like you've already seen. So that'll be something to talk about. So let's get right into, I'm going to make it a next video. I want to get right into gold, but I don't want to make this like a 40-minute video. So let's get right into gold in the next video. I'll see you there. Okay, let's talk about gold. So we've already talked about a few things, like to give you kind of a surface level on how commodities are impacted by certain things. And let's talk about gold specifically. So gold is one of the most widely traded and watched commodities in the world. It's the most interest rate sensitive commodity out there. There's a lot of times like, we'll get into some examples, but yes, very, very sensitive to interest rates. This is because gold is a store of wealth, which is also considered a safe haven. And it's more than just a commodity. Like I said, safe haven, it has real world use. It's also considered a hedge against inflation. So we have 3 things you just talked about, kind of safe haven. It is a store of wealth and a hedge against inflation. This is why it has a strong correlation to inflation expectations, because it's a hedge against inflation. As inflation goes higher, investors look to put their money into something safe, right? The markets become a little more uneasy. Feds start raising rates. It drops equities, like I've shown you already, right? It ends up dropping the stock market. So people end up going into gold. That's as inflation is getting higher. That's when there's uncertainty. Like if you go look at Russia, Ukraine, like I've showed you the example before, you go look what happened. Actually, I'll show you. I think I just dropped this by accident. I just changed the zoom. Here we go. Okay, so yeah, I'll show you gold real quick. What happened when gold, where are we? Here we go, commodities, gold. We'll go to a higher time frame, like the 4-hour, get rid of some of these drawings here, clean it up a bit. So gold, it was February 24th, February 23rd. I already know what it looks like because I was trading it right here. Right, this is the spike from Russia invading Ukraine. It ended up getting pressure to the downside because the dollar was still gaining strength. So it ended up giving a quick spike, came back down, still as the war was popping off, though, because it's a hedge against, this isn't necessarily a hedge against inflation, but inflation did increase at that time too. Oil increased, gold increased. It caused a lot of what's called the risk off market, which we're going to talk about a little later. So there's that. Now, the things that impact gold, which we'll go a little deeper into right now, is we have the dollar, we have the yields, interest rates, which you already saw right here, interest rates, inflation, risk sentiment, which is like market optimism, market fear, and then supply and demand. Honestly, I'm going to dive into, we're going to touch on each of these, right? So the next couple slides, we're going to cover all 6 of these. So I won't touch on supply and demand yet. Now, talking about gold and the US dollar, there's an inverse correlation most times. They're both safe havens. So if I go back and look at, I won't bring up dollar now, I'll stick to what we're talking about with gold. But if I go look at, actually, do I have dollar here? Look at the dollar. That green line that I just added is the dollar. See how the dollar spiked at the same time, right? Gold and dollar both moved bullish together here during the Russia-Ukraine war because they're both safe havens. So I'm not sure if I have that in the PowerPoint, but just a little fun fact to give you that visual there. Both are very sensitive to Federal Reserve interest rates. Both are considered safe havens, which I've already touched on. I've said it like 40 times now, but we will talk about how to trade safe havens in phase 9. So here's a chart for gold and US dollar. For the most part, you do see that inverse correlation. Remember when I was showing you gold and inflation, and as inflation expectations dropped, but gold went higher, it's because the dollar, right? Look at this. The dollar was dropping and it was driving gold higher. Before, remember, inflation expectations is this one right here, the FRED, the T5YIE, that's the code for it. So that's inflation expectations. And that's when inflation was dropping, dollar was dropping. But even though gold has a strong correlation to inflation expectations, we still saw gold drive higher because the dollar was dropping. So there's an inverse correlation between these two. Once again, most times. Gold and the US yields. I do trade, when I'm trading gold, US yields and dollar, I watch almost all the time. There is most times, once again, an inverse correlation. You remember we talked about bonds, right? Both are very sensitive to interest rates, which we covered in the beginning of this, 8.2, when we talked about bonds, and they're both considered safe havens. The bonds are considered a safe haven, which I also explained that earlier. So you can see here, we do have the inverse correlation here, right? You see this white one here is gold, and then we have bonds, the US 10-year, right? You have that inverse correlation. You have it again here, big spike to the upside, big spike to the downside. This is the yields are going bullish, gold is going bearish. This now there's going to be some differences, right? This is the Russia-Ukraine spike, right? But the Feds were still raising rates. So we were still looking for, remember, I said before, rates are bullish for yields. So it's going to increase the yields, right? Remember, as the interest rates go higher, it's going to increase the yields on bonds. So the bonds are actually going down in value, but the yields are going higher and gold's going lower, right? So there's an inverse correlation between the US 10-year and gold. But remember, if you're looking at bonds, which we're not, we're looking at the yields on the charts. The bonds are actually following gold. Does that make sense? Because the bonds are inverse yields. So you don't really have to worry about that. Just we're looking at the US 10-year when we're looking at the charts. So worry about that. Gold and inflation, kind of talked about this when we're talking about commodities. Gold is considered a hedge against inflation. There's a strong positive correlation, which I've shown you here. Once again, the divergence here at the end. But this entire time, this is all right after COVID, inflation, gold inflation expectations dropped. Gold kind of actually went bullish because it's a fear market, but we initially dropped, ended up inflation expectations go higher, gold goes higher, and then we end up seeing that drop, which was, we're more range bound here. And then we ended up seeing that drop here when they started raising rates. Gold and interest rates. This is one of the most serious things that impacts gold. They're very sensitive to interest rates. Typically, higher rates is bearish for gold. This, once again, this lowers inflation expectations. As the Fed start raising rates, inflation expectation drops, gold drops. Here is an example here. We can see this is a low rate environment, right? So March 2020, when we first got the COVID lockdowns, the Feds, this is a little circle for the rates. We were at about 1.8, 2% here. They ended up dropping to 0 almost overnight. They went to 0% on the rates, and we see gold ended up having a drop here as they ended up dropping rates. This was more of a kind of a freak move here when this happened. But gold ended up spiking higher, right? It ended up going higher and higher because we were in this low rate environment here. So when we started rising rates is the important part because this was the shift in the markets too. So this is where you get your swing trades, is these shifts. The only thing on selling gold, the screw up would have been this if you were holding any buys here, sells, as they're raising rates because the Russia-Ukraine thing kind of screwed up gold for that moment. But March 2022, they started raising rates. You can see we had all the way up to 5.25%. And then we can see the drop that we see in gold same time, right? If I go look at this right here, March, you can see it's 2022, the little arrow right there. Same time here, same time here. As rates go higher, gold was going lower. Yeah, you're going to get pullbacks. That's fine. But overall, this entire year, I was still selling gold. selling it, selling it. Sometimes we get some buys. Right, I'm a day trader, so I'll catch buys once in a while out on these pullbacks, but for the most part, taking the sells the whole time. Gold and risk sentiment. Once again, I've said this a million times, gold is considered a safe haven. Market fear is good for gold. I'm going to break this down on risk sentiment a little more, but we're talking about gold, so I have to talk about this. It's good for gold. Market optimism usually means gold is pressure, right? So it's a safe haven. That means when there's market fear, people invest in gold. So we see it go bullish. Russia-Ukraine example is a perfect example. When there's market optimism, that's when you usually see risk flows. You see market order flows leaving gold and going to riskier assets such as US 30, NASDAQ, or maybe even oil, something like that. So this is here's the example here. Russia's Putin authorizes special military operation against Ukraine. Market fear, we see that pushing the upside there. This March 10th, Silicon Valley Bank. This was actually a really good trade. I made 30K on this trade when over the weekend we had a Silicon Valley Bank failure. So if anyone remembers that, for who's going through this, we had some banks failing in the US. It was later that, like Monday, Tuesday, we had to get some breakouts on gold. Gold went super bullish because we had a lot of recessionary fears that were coming in. So that was actually a really good reason to start getting. We had some pretty good pullbacks here once the recessionary fears kind of like eased off. But for the most part, this was a reason to start getting. You see March 10th is around here. And we ended up getting that push to the upside on gold as those recession fears kicked in with banks failing. It's a pretty big deal. Supply and demand. Typically, maybe I have the text here. I'm going to say it before the text comes up. This is the least traded option. Higher supply, bearish for gold. Lower demand, bearish for gold. Lower supply, bullish for gold. Higher demand, bullish for gold, right? So does that make sense? If you're talking about increasing the supply of something or lowering the demand, they're both bad for gold. If you're talking about lowering the supply of this goes for anything, or increasing the demand, it's bullish for gold, right? You increase the demand, drop the supply, price is going to go up. Now, do I have it here? Yeah, right here. Probably the least probably type of trades to take. This is supposed to say probability. This is the least probability type of trades to take. I don't trade gold based off supply and demand. Now, if you're looking at support and resistance and you're calling that supply and demand, that's different. But the actual supply or demand of gold, typically, it's actually interest rates, the dollar, the yields, risk sentiment that's going to drive gold much, much more. But if you're looking at trading supply and demand, the best way to do it is to pay attention to these countries: China, Australia, Russia, Canada, United States. These are the #1 countries, the major countries for productions of gold, China being #1. But like I showed you earlier, we just had bad data for China and gold didn't do anything today. Gold actually, just to give you an example of like today's moves, I was trading gold based off of US data, but we ended up just getting this kind of let's zoom in a little bit. Yeah, we ended up getting these moves here. The data was mixed today. We ended up getting some volatility like this. I was looking for the sells. I took the sells here, ended up getting caught in this pullback and took a small loss on gold because of this, because I was expecting it to continue. But once again, let's look at today's, this is a perfect example today. Look at gold. I was looking for the sells. At the same time, I was also taking dollar strength, right? The dollar at the time was doing this, blasting to the upside. So unfortunately, it didn't hold. It actually did hold some strength, but we just got some Fed comments that came out just right now that said that was talking about not having to raise rates at the next meeting. We got that, excuse me, we got that dollar weakness. So that's not as related to this right now. But my point is the bad data didn't hurt gold, but let's go look at the bad data for oil. Still super bearish on oil. Even with that spike to the upside, I'm still looking at downside or continued downside for oil. So supply and demand, not as big of a deal for gold, right? So that's everything that covers gold. Once again, for oil, I'm going to make this another video. So let's go into the next video and we'll break down the same thing, but we'll make it specifically for oil. Oil. Let's get right into oil. So oil is used everywhere. I've said this before when we're talking about everything else, commodities, gold. It's used in planes, cars, trucks, transportation, heat, everything. It's very, very important. People are extremely dependent on it, right? Since it impacts so many areas of our lives, as stated here, as stated many times before. So it has a real world impact for what we're trading. So things that impact oil, let's get right into this one. Dollar, inflation, supply and demand, risk sentiment, certain currencies. Interest rates can have an impact on it too. It's less, I mean, supply and demand is going to be the biggest factor here. Risk sentiment, inflation, yeah, like, well, let's just get into each one of these because there's always going to be multiple things that impact the markets. Like I talked about, we're talking about during intermarket analysis, which is exactly what this is. Oil and the US dollar. We have an inverse correlation. I talked about this before, dollar up, oil down, Dollar down, oil up. This is a never 100% at all times. If anything, I would say this is the least likely. Once again, it says it here, not necessarily the best driver for trading oil. I can't say that enough times. I typically don't use the dollar for trading oil. Even though you do see the correlation, an inverse correlation sometimes, I just don't like it. I really prefer supply and demand or other factors when it comes to oil. Oil and inflation, they do have a strong positive correlation. Sometimes it's difficult to tell which is driving which. Now, this is what I meant when I said gold is going to have a different, yes, they both have a strong correlation to inflation expectations, but for different reasons. As oil gets more expensive, what happens to gas prices? Right? What happens to transportation prices? What happens to everything? In order to think about delivery trucks, right? Gas prices get more expensive because oil got more expensive. Now I have to pay more for delivery, right? And now because companies are paying more for delivery, they're going to charge their customers more, right? Oil in and of itself is going to, even if you think about like restaurants using cooking oil or whatever. So this is going to impact so much, but sometimes as inflation gets higher, it could be the dollar weakening, which is increasing inflation, which is also increasing the price of oil. Oil getting higher in and of itself is going to drive inflation as well. So sometimes it's hard to tell which is driving which. It's just safest to just understand there is a strong correlation between the two of them, right? So here's oil and inflation expectations. I think I might have shown you this in the first commodity section, but yeah, very strong correlation. It's very, very tight here, right? So you can see the spike in oil prices here, spike in inflation expectations. This was the Russia-Ukraine. We can see the drop here during COVID, and yeah, kind of hard to argue that they're not correlated. Now, risk sentiment, it's considered a risk asset, oil. Market fear, this is the opposite of what you see with gold. We're actually going to see market fear. Oil would be pressured to the downside. Remember what I just showed you earlier in the last video? Oil was pressured to the downside because we had recessionary fears in China. China had really bad data. Look at oil. This was just today, past couple days. Earlier this morning was this push to the downside here on oil. So market fear, oil will be pressured. Market optimism, oil is typically supported to the upside. Once again, this is, remember when I showed you gold? I made 30K on a buys on gold. I wasn't trading oil. Looking back, I should have taken sells on oil and buys on gold, right? Regardless of what the dollar was doing, I'm looking at selling oil and buying gold, even though they're both priced in the US dollar. This was a Silicon Valley Bank failure, right? Recessionary fears again, oil goes bullish. Gold goes bullish, oil drops to the downside. Oil and currencies. This, once again, I don't typically trade this from a day-to-day perspective, but there is a strong correlation with the currency of oil and exporting countries, mainly Canada. Canada will follow oil if you were to put those two currencies together or currencies against oil. They can trade their currencies as well as equities based off the back of oil. You can try their equity market most likely. Now, we've already been through equities. I don't trade Canada's equity markets, but you could because there's a lot of energy companies in the top 5 for Canada's equity space. So if you were to trade that, you could trade it based off of oil. As oil starts to get more bullish, you'll probably see some upside on the equity markets. Looking forward, that actually might be something I implement here because I'm waiting for the buys on oil, at least as of the recording of this. We have an OPEC meeting coming, which I'm going to talk about. Let's get right into it. I'm going to talk about it, but that might be something worth adding. So much of their equity sectors will be made up of oil companies, like I just said. Here's oil and CAD right here. So a little choppier, but you can see they do follow, right? CAD strength is the red, and we can see oil as it gained strength. We can see as oil dropped. Once again here. Now, CAD, it has other factors that impact it. Interest rates from Bank of Canada, economic data for Canada. There's going to be a lot of other things. Canada is a very strong trading partner with the US. So sometimes, a lot of times, US data will impact the CAD. So you do have other things impacting it. I won't drive it specifically off oil, but maybe the equity markets would make more sense if you're going to be trying to trade something from Canada based off of oil. Supply and demand. This is the big daddy when it comes to oil. Due to its everyday use, this has the highest impact on oil. Once again, we talked about this, right? Weather, politics, geopolitics, distribution, and/or production for oil. So just let's break down OPEC real quick because I mentioned the name a few times. OPEC stands for the Organization of the Petroleum Exporting Countries. It was formed in 1916, currently consists of 13 member states. It holds more than 80% of the world's proven oil reserves. There's now we have something called OPEC Plus, right? Another 10 major oil producing countries have aligned with the group to form an alliance known as OPEC plus. So you're going to see people say OPEC, you'll see people say OPEC plus. Russia's one of them in the OPEC plus category. Now, the goal for OPEC is to regulate global oil prices by coordinating on reductions or increases in production. Basically, they control price. They either increase or decrease the supply, which is what production is. They're either increasing or decreasing production by manipulating supply, and that manipulates price. So like I was talking about with oil here, I'm waiting for OPEC to come out and say something because of how bearish oil's been. I'm waiting for their next meeting. I'm waiting for them to come out and say, hey, yeah, we're going to cut production more. And then I'm going to start looking for buys on oil. So I'm just waiting for that to come out. Now, here's a headline here. OPEC plus agrees deep oil production cuts. Biden calls it short-sighted. So here's your example, right? October 5th, you can see the 5th right here. Look in the background what oil did, right? Nice push to the upside as OPEC does more production cuts, right? If they cut production, they're cutting supply. That's all that means. And they're not impacting demand. Here's just an example from COVID. This is so this one is a demand, right? You cut supply. Demand did not get impacted. Demand's still there. This one, you cut demand, right? COVID-19 prompts border closures. This is when the Omicron variant was found in South Africa. So oil sells, and then as that ended up kind of being relieved from the markets, buys came right back into play on oil. So I actually missed these buys. I was waiting for it, and I'm a little salty I missed it, but still a really good example of the demand being impacted, and then this is the supply being impacted. Just to give you a visual, when you're talking about weather and how weather can impact things, you can look here on the left, you see this key here, bulkers, tankers, containers, vessels, tankers, oil refineries. This is the world, right? This is a global, obviously like a satellite view. This is a live map I have in my terminal. You can see all of the ships in the ocean, ships in the water, the refineries, like all the crude oil. And this is just the US right here. And then we have South America right here. And then if I go to this one, here's Europe and the Eastern region, right? Look at all of these ships, refineries, crude oil, vessels, tankers. This is ridiculous. They're all in these little alleyways here, rivers, canals, whatever you want to call them, right? So weather, if there's a specific area that gets impacted, it can have a heavy impact on supply, right? This can really impact something if there was something like a disaster that really happened. Oil would very, very likely drop, but then the demand of it, if they need to rebuild, could actually increase the demand of oil when the rebuild comes. So this is just to give you a visual so you have an idea of how the markets could possibly or potentially be impacted if oil rigs in the water or something that produces a lot of oil were to be impacted by some type of natural disaster. So with that being said, let's touch on our last section for this phase and get into the Forex markets where we'll break down the currencies. Okay, let's kick this off with Forex markets and talk about some currencies. We're going to break down the main currencies that I typically look at, like the majors, and we have the US dollar. So I'll put the nickname for them. I typically call them whatever you want. Greenback, US dollar. I go by US dollar. Canadian dollar, you'll also hear referred to as a loonie. Great British pound, you'll hear it called pound sterling. You'll hear it called the pound. You'll hear it called GBP. Australian dollar is also referred to sometimes as the Aussie. New Zealand dollar is referred to as the Kiwi, which is after I think it's their state fruit or something along those lines. You'd have to look that one up. So yeah, it's called the Kiwi. And then Swiss franc is called the Swissy. I just call it the Swiss franc. Japanese yen will also be referred to as the yen. And then Euro dollar, just call it the euro. So that's, if you ever hear pound sterling, Aussie, Kiwi, Swissy, you know what they're referring to. Yeah, loonie and Kiwi are the only ones that aren't really like near the name, and greenback too. Like, so it's a little bit of a divergence or a dissonance there when it comes to the name. So anyways, analyzing currencies. Now we've talked about this before, inflation, growth, monetary policy. Remember this, we talked about this with equities. It's not that far off. So we'll talk about how these actually impact currencies though. So inflation, higher inflation is typically bad for a currency strength, right? If the supply of something comes out higher, then the value of it is going to drop. So higher inflation, typically bad for it. The higher, oh, I got it here. The higher inflation goes, the lower the purchasing power of a currency. This is an example here. This was once again, this spike right here is COVID, March 2020. And what happened was we have the inflation here in the blue. As inflation's rising, the dollar was dropping in value the entire time, right? Feds weren't raising rates. They were holding the 0% interest rates. They were pumping money into the economy. Dollar kept losing strength every time we got higher inflation. Inflation expectations just continued to rise, right? Now, monetary policy and currencies. Quantitative easing and quantitative tightening, two different things, will impact inflation. Interest rates will also have the attractiveness of a currency to foreign investors, right? So when we're looking at monetary policy, we're talking about quantitative easing and tightening and interest rates. So a few examples. Once again, this is high quantitative easing and low rates. So once again, you have inflation here, but we had high QE, which is a lot of money printing. We had a low rate environment and it hurt the dollar. So let's see if we have another example here. This is inflation and rates rising. So we were actually increasing rates. We have the inflation here and the rates were rising here. We didn't start raising rates till March 2022. So this is when we started raising rates, and then we started actually dropping here. So this is actually not, we weren't raising rates here, but inflation was rising. It wasn't until over here, March 2022. So let me show you a different screenshot of this then, because this isn't the screenshot that I wanted to show you, but inflation and rates rising. So what happens is, just to break this down, high quantitative easing and low rates, right? So what happens when they go to quantitative tightening and we're at high rates? That would be, let's go to the dollar chart real quick. We'll go, I was just on it. Dollar chart, we'll go to the 4-hour time frame. I'll change it to a line chart. I'll get rid of all these drawings and I will put inflation expectations. So if you're looking at inflation, we're going to go to the daily. Inflation. There we go. All right. So now let's look at this a little differently. Once again, we have, I know this is what time frame is this? Daily? Oh, that's way too far back. Okay. March 2020. Here's the COVID spike here. So yeah, so we have, I'll bring this down so we know what we're looking at here. The blue is inflation. Inflation's rising. And now when we zoom in a little here, we come to when they started raising rates, the dollar was gaining strength this entire time. So maybe that was the right, where are we at? March 20. Okay, so it is March 2022. I'm sorry, I was looking at the wrong thing. March 2022 or 2021 rather is when they started tapering, and then over here is when they started raising rates. There we go. That's what I was looking at. Okay, so yeah, this is the rates right here. So inflation was still high, but you can see here if we line this up, give or take, March 2022, inflation started to drop, dollar started to gain strength, right? So this is when they started tapering. Here we were kind of sideways, and then you can see inflation expectations drop, dollar gained some strength. It's March, they start raising rates. That's where we see the divergence, right? So I was looking at the wrong time, but that's exactly what I wanted to show you. Risk sentiment. Let's talk about risk sentiment and currencies. We're going to dive a little deeper in this when we get the sentiment analysis in the next phase. Your safe haven currencies are going to be the dollar, the Japanese yen, and the Swiss franc. These are more neutral currencies, pound and euro. And then you have your risk assets. These are the risk currencies, AUD, NZD, and CAD. So I have a cheat sheet, which you'll get in the sentiment analysis section that'll show this a little more cleanly, but you have those there. One thing about risk sentiment, I want you to understand as we're getting into this, is that it can be tricky. The reason is because risk sentiment, when we're talking about the market optimism and market fear, it can be there 1 second, it can be gone the next. So it's very, very important, in my opinion at least, to have a reason or a specific catalyst, right? Silicon Valley Bank shutting down is a reason. China's really bad data causing a risk off market is a reason. That's a reason to look for like yen strength, which we actually got. If I show you the Japanese yen over London session, which we just got today as I was trading, this is a Japanese strength indicator here. As I already showed you oil earlier, right? But look what the Japanese yen did too overnight. We got that China data. This is Asian session here. And we ended up getting a lot of strength in the yen, right? We got that risk off market. Yen ended up gaining some strength. Yeah, it pulled back a little bit during New York, but that was actually data that caused that yen to drop. That was US data. So that's your risk sentiment. When you're choosing pairs to trade, you want to choose a strong versus a weak currency, right? You don't want to choose typically two risk assets are going to move together. Safe havens move together. That's why something like UJ kind of consolidates a lot because they move together. So typically you want a strong versus a weak currency. There are two ways to do this: risk sentiment or fundamentals. There are two different ways to do this. So this is an example of fundamentals. The Bank of Japan. So this was in, once again, March 2020. This entire year, we're looking for UJ buys, right? There's a lot of consolidation, but the bias never changed to keep taking buys. And here's the reason. This is when the Federal Reserve approved their first rate hike, and they said 6 more ahead, right? They're going to continue raising rates. And now look, March 17th, 2022, it's 1 day after the Feds. Bank of Japan keeps policy steady, warns of uncertainty over Ukraine crisis fallout. That means that they're not looking to change their policy. They're not raising rates. Bank of Japan, as of right now, is at negative 0.1%. Federal Reserve just raised it to 0.25. They're currently at they're at like 5% right now. So Bank of Japan isn't raising rates. I'm looking for a weaker yen. Federal Reserve is raising rates. I'm looking for UJ buys all day, all year. Yes, we can get some pretty aggressive pullbacks, right? Once in a while, we get some dollar weakness or we get some yen strength here, but it's still a reason just to look for that change of structure, get right back in the buys. That's all. So this is a reason, this is an example for fundamentals. And here's a reason for sentiment. So this actually came out not that long ago after this recording. Initial jobless claims. This was US data that we got that caused a lot of fear in the market, and it caused recession fears. The reason was we had really strong increase in jobless claims, which means a lot of people applying for unemployment, right? So when we get a huge beat in jobless claims, the dollar, this is AUD USD. So these are the cells that we took, AUD weakness and dollar strength. We had two different, right? It's a risk asset, a safe haven. Let me show you what, this is the dollar, right? The dollar initially dropped on that data and then blasted to the upside, right? Because it's actually bad for the dollar when you get bad employment data like that. But because it caused a risk off market, which I'm going to break down in sentiment analysis, we're looking at dollar strength. So because I'm looking at dollar strength, once again, AUD is a risk asset. So let's look at what AUD did. This is the AUD strength, right? Melted, right? So now I'm looking at a divergence there between the dollar and AUD. I'm looking for AUD USD sales. And that's exactly what this was here. You can look at it as like a fake out here, a retest. You could even wait till you get the break of structure here. You can target this, you get your break and retest, like whatever it is you're looking for your entry whenever you catch it. As long as that catalyst is still in play and you catch it before it starts consolidating towards the end of the session, this is the time to start getting in for AUD USD because you have a weak currency and a strong currency. Make sense? We're going to dive a lot deeper into sentiment analysis coming right up. So let's get right into risk sentiment. Congratulations on passing or finishing phase 8. Okay, risk sentiment. Welcome to phase 9. So one thing I want to say before we get started into this is like a lot of this stuff you should hopefully be looking to implement as you're trading and go through this and go through it again. There's going to be a lot of information that you're digesting throughout this course. Just take it one bite at a time, step by step, however you want to look at it, and come back to this stuff because you're not going to get all of it in one sitting. That's all I want to say as we get this started, because I know this stuff might be overwhelming. You made it to phase 9, and I want to dive into this. I want to give you the best that I can give you out of this. And yeah, let's stop ranting and let's get into the sentiment. What is it? The definition of sentiment is a view or attitude towards in a situation or event. A view or attitude. So what about market sentiment? Really, at its core, market sentiment is nothing more than the mood of the market. How does the markets feel about the markets? How do investors feel about the markets, right? So before I get ahead of myself, let's do this. It's our job to determine how the market is feeling about a currency, how the market is feeling about equities, a central bank meetings, or economic data points. Like I've showed you a few things, but in the last videos, how data has actually impacted the dollar, how it's caused some strength or some weakness. We need to determine what the market's feeling about that. Recessionary fears being a perfect example, right? Remember, the market is full of emotional beings, and most of their decisions come from emotions. Algorithms are not. These are people that make up algorithms. So there's a domino effect here. One event in the markets can impact several other assets at the same time. Kind of talked about this in intermarket analysis, but you're going to see that where one thing can impact another. So one of the first concepts I want to talk about is long-term versus short-term. This is going to help you if you know you're in a scalper's mindset, if you're not changing your bias, a lot of stuff like that. So short-term, things like mood shifts, this can be session to session, day to day, week to week. Silicon Valley Bank fallout was a good example. Yes, I held that for a couple of days with the gold buys, but I wasn't expecting it to be forever. I wasn't expecting that to last for months. It's just until once the government stepped in and they started helping them, I took profit on gold and just called it a day, right? Not looking to hold that forever. Long-term would be the underlying theme or driver over direction of an asset or group of assets. So monetary policy, growth, and inflation, they're usually the baseline underlying sentiments. If I show you this real quick, let's go to gold for a second. I've mentioned this a few times, but The Fed started raising rates March 2022, but we got that spike right here from the Russia-Ukraine. But it's not going to happen forever. Eventually, it's going to still continue bearish because the Feds are still raising rates. It's still bearish for gold, right? That's a short-term sentiment versus long-term underlying theme. The war isn't going to go on. I mean, even if the war is actually still going on, but the Fed's rates is going to supersede gold. So the challenge with sentiment, I've said this before, but it can be one of the strongest drivers in the financial markets. It can also change frequently. That's something you want to understand. The best way to trade sentiment is if you have a reason to trade sentiment. If you see a risk on market or risk off market, which I'm going to show you how to identify, and it's just random, you might get some scalps, but your best probability is going to be having a reason for it. Once again, right here, is there a reason the markets feel a certain way about an asset? Is there a reason oil is dropping because China's demand dropped, because China's data is bad? Is there a reason oil is going bullish? Well, supply and demand issues, right? So is there a reason I bought gold, Silicon Valley Bank? So there are always reasons behind the sentiment trades. Now, things that can impact sentiment. You don't need to memorize this list. This is more of a nice to know thing, but there are a lot of things that will impact sentiment. Honestly, it's just going to come with time, experience, and actually seeing these things play out. So monetary policy, rate expectations, policy adjustments, hawkish and dovish central bankers. This can be like, think about very, very aggressive interest rates causing recessionary fears or something, right? It can cause a risk-off market. And I'm going to show you what a risk-off market means. So I don't like using words that I haven't gone through yet, but these are things that can impact sentiment: fiscal policy, tax hikes, cuts, government spending, stimulus package, geopolitics, wars. I've showed you a few examples already for Russia, Ukraine. Intermarkets, remember, they're connected. And then market themes. Attention usually comes back to the major market theme and remains the key drivers. That's the underlying sentiment, right? Underlying theme, you can call it underlying sentiment, long-term sentiment, whatever you want to call that. The strongest sentiment shifts occur when there's a combination of factors driving a positive or negative sentiment, or when there's been a massive change in the market's baseline expectations. There's a lot of theory going on right now, right? So I know this is like, what the hell is this dude talking about? What's a combination of factors mean? What's positive and negative sentiment? This is why I say, like, go through this whole thing, take your notes, pay attention, go back through it again, because this will make more sense, especially when you're actually trading. When something in the real world happens, like if you actually experienced the Russia-Ukraine war or the Silicon Valley Bank and you saw what the markets did, all of this would make so much more sense. So you do need to experience these things in real life and then apply the theory to those real life scenarios. So what I guess I got ahead of myself again. That was a lot of theory. We'll get into real world examples. Real world examples will make more sense. I kind of just said this. So I said this since the beginning of the course. I get ahead of myself on the PowerPoints because I don't remember if sometimes I do have these statements, sometimes I don't. It just comes to my mind and there it is. So let's talk about the ultimate guide to sentiment analysis going into the next section. The ultimate guide to sentiment analysis. I'm going to dive into this one. Sentiment breakdown. So we have two asset groups and we have two market environments. This is like the top of the tree right here, okay? We have two asset groups. We have two market environments that we're going to be talking about. You've already heard me say some of them going through this entire course because it's hard not to use these words. So first thing is risk assets. These are considered riskier. They're more volatile. They give greater returns, but they also provide greater risks. Then you have safe havens. These are considered a safe store of value. They're normally less volatile and the returns are average and much less risk. Market environments, right? That was the asset groups, right? Now we're going to talk about market environments. You have risk off, market fear. Same thing. You're going to hear them spoken about the same way. Market fear, also known as FUD, fear, uncertainty, or doubt. And then you have risk on or market optimism. Market optimism, greed, right? These are greedy markets, optimistic markets, fearful markets, risk off markets. So I typically just say risk on, risk off. From here on out, you'll probably hear me say risk on, risk off, okay? So determining which environment the markets are in will help us identify the market direction. I can't tell you how important this is. Like, learning sentiment analysis changed the game for me, 100%. This will help us capitalize on short-term and long-term moves, or it'll help us identify when to stay away from an asset or the markets as a whole. A lot of times you can identify mixed markets, and typically that's a time when I'm like, yeah, I'm not going to trade today, right? So understanding that stuff. Intermarket analysis and sentiment really kind of intertwined here. So risk off market, right? This is the market environment, and now we have our two assets. We have risk assets, we have safe havens. In a risk off environment, you are going to see order flows leave risk assets and go into safe havens. What that means is safe havens gain strength, risk assets lose strength in a risk off market. I'm going to show you how to determine this, but you need to understand this first. The second risk environment, risk on, we still have the same assets, right? Risk assets and safe havens, but you're going to see the safe haven assets flow into risk assets. What that means is risk on markets, market optimism, safe havens drop, risk assets gain strength. Okay? The markets are a zero-sum game. When something goes up, something else must go down, right? It's not going to be like when people say, oh, the markets are bullish. It's like, I'm always like, what do you mean the markets are bullish? Like, which part of the markets are you talking about? Because one thing going bullish means something else went bearish, right? Which assets belong where? So now we're going to cover, the next slide will cover whether each asset we trade falls into either the risk asset or the safe haven category. I think we've covered just about all of them up to this point. If you've been through the intermarket analysis section, hopefully you have, but let's talk of these a little, we'll talk about these a little deeper. So equities, they're considered the riskiest. They're the most volatile, usually the first mover. So equities are considered a risk asset. In a risk on environment, where do you think they go? Right? They're going to go bullish. Risk on environment, market optimism, they're going to gain strength. Risk off environment, they're going to lose strength. Well, you always want to remember, I think you can put this on all of them. You always want to remember individual impacting factors. Interest rates, sentiment. Well, this is sentiment analysis, but there's always going to be other things that's companies. Remember, we talked about earnings reports for NASDAQ, US 30, any of these, right? So you want to pay attention to that stuff too. There's going to be individual impacting factors that do happen. This is specific to sentiment analysis because you do want to combine this with everything else. Now, commodities. Let's start with oil and copper. These are the second most volatile after equities. They're considered a risk asset. Copper, I've said this before in the commodity section, is considered a leading indicator, right? It's referred to as Dr. Copper. So because these are risk assets, what do you think for a risk on? The same as equities, right? It's going to go bullish. Risk off market is going to go bearish, oil and copper. Once again, individual impacting factors is always going to be something that we talk about here. Let's go to the other part of commodities, gold and silver. They're considered a safe haven, right? They're still commodities, but now these are safe haven commodities. So you're going to see the opposite here. Risk on, that's going to drop. Risk off, that's going to gain strength. We're going to see investors put their money into gold and silver as we see market fear come in. Once again, individual impacting factors will always supersede this stuff, but this is still important to know. Government bonds and yields. This is considered, I talked about this in the bond section, but this is considered the safest asset money can buy. Massive economic uncertainty will drive demand for bonds. The opposite can be true for emerging markets. So typically, I always stick to US bonds. I'm not looking at Italian yields or Japanese bonds or any other emerging market. Not that Japan's an emerging market, but I'm not looking at Italy. I'm not looking at Russia's yields or bonds. US is really the one that we use for our analysis. So in a risk on market, we would expect the bonds to gain strength. We would expect a risk off market, the bonds to push to the downside. Now, one thing you always want to remember is we're looking at the yields, right? So when you're looking at the yields, this is actually what you're going to see. Think about the bonds, right? The bonds are a safe haven. So if the markets are optimistic, if the markets are like, we have a greedy market, safe havens are going to drop, right? Risk on, though, you're looking at yields. So you're actually going to see the yields increase. This is an environment where you would see the dollar dropping, but the yields are increasing. Remember before in the intermarket analysis, the dollar and yields actually have a strong correlation together. Pretty sure I said that, but dollar and yields typically move together. But if we're looking at sentiment, that's when you see the dollar and yields moving away from each other. So the bonds will drop with the dollar, but we're looking at the yields on the charts. Just remember that. You're looking at the yields. Volatility index. We haven't talked about this yet until right now, because this is considered more of an indicator. When an asset's volatility rises, it's a higher chance of bigger price fluctuations in the future. Expected uncertainty. So basically what that means is you have a volatility index. It's called the VIX. I'll show you what it looks like right here. This is the VIX right here on this bottom right. So volatility index. As it goes higher, it gives us more uncertainty. If the volatility in the markets goes higher, it tells the investors are like, I have less idea where price is going to be. There's a lot of volatility in the markets, right? So it's actually an indicator for sentiment. In a risk on market, you'll see it go down. Less volatility, market optimism. More volatility, market fear, right? So another way to look at it is just it's inverse equities. So if we were to look at it's still a little choppy here, but we look at this push to the downside that you see in VIX here. Look at the upside that we had. That's actually probably correlated right here. Let's see. Friday. It's Tuesday. That's the beginning of the week. Friday, right? So look at this push you got here on NAS, market optimism, and then the drop in the downside on VIX, right? So you have a drop in volatility. You have an increase in equities. US 30 did the same push here on Friday. Remember, strong inverse, once again, I got ahead of myself in the PowerPoint again. Strong inverse correlation to equities. So looking at the currencies, we have two different kinds. We have risk currencies. We've covered this before in the last section of intermarket analysis. You have AUD, Kiwi, and Canadian dollar. Risk on market, they're going to go strong. Risk off market, they're going to go weak. Now, the reason they're considered volatile or risk assets is because of their dependence on commodity prices. Australia, New Zealand, Canada has a very strong dependency on their commodities because they export a lot of commodities. Safe haven currencies, US dollars, Japanese yen, Swiss franc. Risk on market, they're going to drop. Risk off, they're going to gain strength, right? So market fear, they will gain strength because they're safe havens. Market optimism, they will lose strength because, once again, they're safe havens. You'll see risk flows go into the risk assets. Medium beta is kind of Great British Pound. I do typically see it follow risk currencies a bit. Really, Euro and the pound, I trade them mainly off fundamentals. If I'm bullish on the pound because of Bank of England or because of good economic data, that's typically what I look at. But if we see the yen losing a lot of strength, I'll still look to buy GJ if I can get it, right? Or if I see a risk off market and I see yen gaining a lot of strength, I'll look to sell GJ. But yeah, the pound is more of a medium / neutral. Same thing with euro. Here's a cheat sheet. So I'll make sure we have this cheat sheet. We'll probably just change the Wall Street grunts, put it to Operation Wall Street. If I don't, you guys will still have this cheat sheet here downloadable on this page here or one of these sentiment analysis pages. I'll make sure we have this so you guys can download it and have access to it. So how do you identify risk sentiment, right? We just talked about a bunch of stuff. Okay, the markets are moving this way, the markets are moving that way, but how am I actually going to tell you this is a risk on or this is a risk off market? So there's a few steps. You need to look at the asset classes as a whole, right? I'm going to start with global equities and then I'm going to go to currencies. I'm not isolating individual currencies or individual equities, and all assets are interconnected, right? Stronger signals, higher confident trading opportunities. So let's see if I have how can we trade it? Okay, so let me show you what this looks like right here. Like for me, what I do, this is why I have my chart set up like this. Global equities. I can tell you what's happening because I'm looking at the markets globally, right? I can see the risk off market here. I'll zoom in a little bit. The markets went risk off when we got some data earlier. It didn't last, but I'm just looking at this 30-minute candle here, right? I'll point an arrow to them. There's NAS, US 30, SP 500. Now the data was mixed. We ended up getting a recovery. It is what it is. But we did see that reaction here. And I showed you in the last video too. I'll actually show you again, since we're on the same video, the dollar on the lower time frame here. Let's go to the candles. It recovered its move as well, but look what the dollar did. The dollar went bullish. It's recovered the move now, but the dollar did still do that when we got the data. Once again, the data was mixed. But basically, just to get back to this, I'm looking at my equities first. Time frame, not a big deal. I will look at the most recent 30-minute or something. I'll see how it's pushing. If we're breaking anything, I just want to see all of them moving in the same direction. And then I go to my currency chart. So this is a custom currency chart I have. If you're in our private group, I'll show you how to make this. But this is a chart that I have. I have my US dollar, I have the Japanese yen, Swiss franc, and then those are all my safe havens up top, right? These are all the risk currencies down here. So I can see, even if you look at AUD, look how weak AUD got because it's a strong trading partner with China. We just had bad China data and AUD has been very weak because of it. We're just getting a little bit of a pullback, right? NZD, same thing. It got weakened off that data because AUD and NZD strongly correlated. So long story short, I'm looking at my charts like this. I want to see markets moving in the same direction. That's going to tell me if it's a risk on or risk off market, depending on which one's strong, right? If all my safe havens are strong, if they're all weak, that's pretty much all I'm doing when I'm trying to identify that. So how to trade it? Kind of talked about this before. I want to pair a strong currency against a weak currency. You want a high beta or a risk. High beta is also called risk assets. So if you hear someone say that, you want to pair it against a safe haven. So let's think about a risk on market. These are going to be my bullish pairs. AUD JPY, NZD Swiss, AUD USD. This is just an example, right? So, and then the bearish pairs, USD CAD, right? I'd be expecting CAD strength. I'd be expecting dollar weakness. Risk on market, I'm looking for all the risk assets to be strong, and I'm looking for the safe havens to be weak. So I'll be looking for buys on any of these. Risk off market, bearish pairs, exact opposite, right? And bullish pairs, UCAD. Makes sense? I'm looking for AUD, NZD weakness. I'm looking for yen strength if the markets are risk off. And that's pretty much it. And I showed you an example, I think in intermarket analysis on the currencies, when it came to sentiment and currencies, right? Sentiment and currencies, I showed you the AUD USD sells that we took because we had dollar strength. So it was actually not AUD JPY, but it was AUD USD right here. Just another a risk asset, a risk currency versus a safe haven. So a couple things to remember. Short-term sentiment shifts. They can literally, like if you're looking at the markets and you're getting pullbacks, let's say like I'm bullish on AUD, but I'm seeing a risk off market and AUD's losing a bunch of strength. I'm like, oh, this is a risk off market. I gotta sell AUD JPY. Remember, they can just be pullbacks, right? So always remember the underlying theme or the overall, like don't get too zoomed in, as I like to say. Always pay attention to market structure and don't, man, I'm always getting ahead of myself here. Don't get too zoomed in. Exactly, right? So it's almost like I made this course since I'm saying it ahead of time. So let's go over some real world examples in the next section. Let's make this a little more concrete. Okay, let's hop into some real world examples. And yeah, we'll make this a little more concrete. So this is the chart that I was showing you before, risk off currencies. We talked about this before, the initial jobless claims. You can see the little spike in the downside we had in the dollar at first, but overall, I'm looking at, look how strong the dollar became, yen, Swiss franc, and then you can see the NZD, AUD, and even Canadian dollar all dropped to the downside, right? So not too worried about euro and the pound. Once again, the pound did follow here. So like GJ sells played out for that. But for the most part, I was looking at the dollar strength that we had here, right? So that dollar strength, the safe haven strength, the risk assets, this is what gave us that risk off market. And let's look at another screenshot here. Risk off currencies, I showed you this before. This is the AUD USD sells that we were taking after the dollar kind of gave us that spike. AUD gave us a spike to the upside because the dollar dropped real quick, ended up coming back below, taking AUD sells right back down. So a few examples of that here. UCAD, this was that dollar strength again. We ended up getting, this is the same day. You can see here the 11th. So we ended up getting that dollar strength coming in, CAD weakness, UCAD buys is another one, right? Equities, if you're trading, like this is the thing, like you can trade all of these. You can trade currencies. I wouldn't trade all of them at the same time, but pick your poison, right? We end up getting US 30, the Dow Jones. We get a break below support here, nice 30-minute candle closure, and still even breaks the lows to the left here, right? So all that ended up happening because we got a risk-off market. We had those recessionary fears, all based off of that jobless claim data that we got. This, I've showed this example before. I brought my charts up, so long-term versus short-term. We had the Feds expecting to raise rates here, so we're getting consolidation. It wasn't until they actually started announcing it, but we had the spike to the upside first because of the Russia-Ukraine war. So this is gold here. We ended up getting that spike around that time. A couple things that I want you to remember here. All asset classes are interconnected. If only one is different, try to identify why. If I'm looking at my charts here and only the dollar is strong, but maybe yen and Swiss is weak and everything else on the risk asset side is strong. So I'm like, okay, how come the dollar is strong, but all of my risk assets are like, what's going on, right? So if you see something different, I want to identify what's going on here, right? These are guidelines, not rules. Always remember that. Nothing is that black and white in the markets where everything needs to be 100%. So currency and assets can still go against sentiment. Sentiment can change quickly. I can't say that enough. Be aware of these shifts. Knowing why helps to know how. If we don't know our why, we have lower confidence trading opportunities. If we do know our why, we have higher confidence in our trading opportunities. Basically, All we're doing, like I said in the beginning of this, we're just trying to increase the probabilities of our trades. That's all we're trying to do. So the more you know, the better, the more you can connect, the better. And this is exactly like connecting all this stuff is exactly how you're going to do it. So the final piece is I'm going to give you the 3 steps to trading sentiment, and we're going to hit this thing home. Let's get it. Right, here's our 3-step analysis, and we're also going to talk about the pricing in concept a little bit. So I think we've touched on it a few times, but we'll dive into it here. So one of the important terms we want to talk about is priced in or pricing in. Popular slogan you'll hear: buy the rumor, sell the news. When hints or assumptions of an event is happening, the markets will typically price in that event. The markets, what that means is the markets will tend to react as if the event had actually just happened. This is because the markets try to stay ahead of the curve, right? So this is called pricing in. Basically, it's the markets trying to stay ahead of the curve. Assuming rumors come from a valid source, the markets have a higher probability of reacting. Then, when the event actually occurs, the market moves, typically, they're less volatile. Once again, because it was already priced in, right? This is why we talk about market expectations. The markets are already expecting it. Or if the event does not occur, then it's likely to see the markets recover the rumor, right? So if we had, let's say we had a huge bullish run somewhere, the markets will consolidate until that event. And then if it doesn't happen at all, we usually recover that whole move. And we'll show, I'm pretty sure we have some examples of that here. So there's a 3-step process when we're looking at trading sentiment. This can be put to economic data, interest rates, but once again, I think we talked about it on the economic data side. This is for sentiment. The baseline, number 1, market expectations. Number 2 is the surprise. This is where we're doing scenario building. We want to plan for a surprise to the upside, surprise to the downside, right? So you can say risk off, risk on, like whatever. The bigger picture. Is this going to change the bigger picture? That's how we catch our swing trades. The first step is to figure out how the market is currently priced in for an event, theme, or asset you're trading. Now, when we're talking about an event, I'm talking about a physical war, economic data, news, headlines, right? Those are events. A theme would be policy and growth outlook. Like, is there something that happened that's going to change? I don't know, maybe recessionary fears, right? Assets. These are the actual things that we're trading. Safe havens, high beta currencies, high beta assets, commodities, equities, right? So those are the assets. So what is the market currently priced in for? An event? What are they expecting? What's the expectation for policy or growth outlook? What's the expectation for assets, right? That's all we're looking at. This is critical to understand because this tells us what type of news will be market moving and which won't. Super, super important. So once again, this isn't just for sentiment. You can also look at this for economic data as well. So now we're talking about surprise. I'm going to slow down a little bit. We're talking about scenario building here. We want to plan for an upside or a downside. So let's explain that a little deeper. After step 1, you're going to have an idea about what you would need for a change in the markets to make a more dovish or hawkish view in the case of events or themes. So what that means is the markets are expecting this, right? We're expecting a 5.0% for inflation. That means if I can see a huge miss or a beat, something above or below, I can expect some type of deviation in the markets, right? As well as what happens to take a more bearish or bullish view in the case of assets. Gold going bullish, safe havens losing strength, etc. When you're planning trades, you want to create scenarios for both sides. This is step 2. This will prepare you to trade either direction with higher confidence and probabilities in your favor. I'm not guessing when data comes out or headlines because I see the market spike one way. I'm not going to guess and chase it because there's a good chance, like we saw in the dollar before with that initial jobless claims, the dollar spiked. Most people probably took dollar sells or something. And I actually was waiting for that dollar strength to come back in for those recession fears. The third, bigger picture. This deals with the sustainability of the moves, right? We're talking about how long is this move really going to last? Once a shift in sentiment occurred, whether positive or negative, the question is whether that will change the bigger picture or not. You want to ask yourself, was the news or change in step 2, right, the surprise, significant enough to change the policy or asset outlook? So I'm being vague when I say asset outlook, but you can replace asset with gold or GJ or the pound or the US dollar, right? Any currency or asset you're trading, this is how you would look at it. So here's a little example. One of my favorites, Friday, October 9th, 2021. This headline came out. Brace for interest rates, warns Bank of England rate setter. So this headline came out on the weekend. It was like Saturday or Sunday, October 9th. This was the first rumor we ever saw for Bank of England raising rates after the COVID lockdowns. Look at what happened. This is GJ. So we were holding this area for a long time, always rejecting it. kept hitting it, taking the sells, kept hitting this, taking the buys. It happened multiple times, right? Finally, we blasted to the upside for 700 pips. It was about 800 from the lows. So man, I'm sorry about that whiteout button. So we blasted to the upside on GJ. This is the market's pricing in interest rates. We didn't get interest rates, right? The markets are pricing it in though. The interest rate decision wasn't until here, right? This is November. So this is the actual rate that they came. This was the rate decision. Bank of England surprises markets by holding rates at record lows. So they didn't raise rates. So think about this. We just had that huge run to the upside on GJ, and now we ended up getting no rates. So what do you think is going to happen to GJ? Right? We got some consolidation, very corrective looking pullback here, and then bam, we ended up recovering that entire move, right? If I was to circle this, it took a little longer, but the initial move was here, and we just recovered this whole move that we had here. Same exact size, it just took a little longer, right? So that was going into December. Volume was a little lower that time of the year, but we had the Omicron variant. They didn't raise rates. Now, what happened is on Thursday, November 27th, this headline started coming out. So Omicron variant. You guys remember I showed you oil with the Omicron lockdowns? So the prime minister came out in UK and started saying that they're going to start locking things back down. Temporary precautionary measures following the emergency of Omicron. They're going to, he announced like, hey, look, we're going to start locking bars back down. We're going to close this back down. We can't stay open. Omicron fears, all this crazy stuff. This makes the markets think like, hey, look, there's an interest rate coming in December. They didn't raise in October. They've already fooled us once. There's no way they're going to raise rates in December. Why would they raise rates if they're locking things back down, right? So the markets were not expecting an interest rate hike in December. Here's the market expectations, a lot of consolidation here, right? We weren't really moving all that much. Holiday season 2. Now look at Thursday, December 16th. You can go Google all these headlines if you don't believe me. Bank of England surprises again, except this time it's a pre-Christmas rate hike. They actually decided to raise rates in December. And now take a look at what happened to GJ. Once again, this is the move here when they didn't do rates, right? We recovered this entire move. And now we did it once again. If you go look at GJ on the monthly time frame, October, November, December are the exact same size candles, those 3 months, because one of them super bullish and then super bearish and then super bullish, right? We drove 800 pips up, 800 pips down, 800 pips up in those 3 months. And we had fundamental reasons behind all of them, right? So that's it. I got to this before I knew it was coming, but congratulations. This is the Operation Wall Street class. I hope if you have any questions, don't click X yet because you're at the end of the course. If you have any questions at all, hit me up. Talk to me, talk to Sakeem, my partner. Get in our private group. If you're not already in the private group, just ask us some questions because this is a lot of information. Don't go through this and still be lost. There's going to be a lot of videos in here that's going to help you. So I really, really, really hope this was helpful for you. We have so many more mini courses coming out specific on each commodity and all that stuff, but this is like the overarching everything you need. Congratulations on going through the entire thing. Proud of you. Now let's go kick some ass in the markets.